Guys, how are you? Let's do a sound check. Let me know if you can hear me. So we can start in 3 minutes. Good, thank you. Good day, everyone. How are you? Please let me know if you can hear me. So we can begin. Perfect. Okay. So today we're going to do a webinar on the very big topic named risk management. Risk management is, I would say, one of the very most important components that should be in any within your trading plan, and that should be your odds to win the market. Risk management is something that many people don't care to study because it's boring, because it's less graphics, less intuitive, and also there's so many lack of understanding what are the different methods and what are the different ways to approach risk management in a way that anyone can find its own solution, individual solution that is suited best for his personality. So let's jump into this huge subject. I do want to ask you for being very much in attention for what we're going to talk and cover today, because it's going to be something very, we'll jump from subject to subject and we'll try to make an order from it. One thing that you should be mindful about risk management is that each single one of you is a unique person, unique personality with different features in your behavior, and therefore you need to find your own risk management method that suits you best in terms of your personality, your goals, the time that you invest in your trading. Everything should be combined into one conclusion and finding the right method. So what we're going to do today, we're going to cover and highlight what is a risk management and what are the different approach that you can find in risk management, and how you can start investigating for yourself what suits your needs with the most effective way. So let's start with this. First, why do we need risk management? Risk management is, if you think about it, it's everywhere. It's every decision you make in life is a risk assessment decision. From what you decide to go to learn in college, you are taking a huge risk of if you will like it, if you love it, if you'll be good at it. You don't know when you enter that journey if that will if that will be the best thing for you. And lucky for us as human being and living in the Western world is that we have a lot of opportunities to change and switch careers, like most of you guys are doing when trying out for being traders. I know I did change careers few times in life. So, but we've made decisions in life that had taken risks. If you decide even to marry somebody, it's a risk. If you go and doing a business, you don't know if a coronavirus will hit the world and that will kill your business and your investment. So everything is about risk management. And why I'm saying this is because we as traders are living in a greater environment where the unknown and the unexpected is likely to happen in higher magnitude from almost anything else in life. If you are playing sports and you're going to face an opponent, you would have better broad figure idea if your opponent is going to be better than you or less good than you or equivalent to your skills, and but you would have this information when you come to the market. Your odds are very, very um, obscure, and understanding this and understanding the fact that we are not going to be able to actually predict what the market is going to do. We can only play by statistics and by the studies that we've learned and by ideas that other people had created and patterns that other people had found in the market. And we're trying to rely on these new information. We are still putting ourselves in as a subject to a great unknown, unexpected. And for that, we should be waiting all of the time to the worst case scenario. Um, so what does it mean to be always on the worst case scenario? Worst case scenario means that at every decision that we're making in the market, the worst can happen. We can have the maximum loss and being surprised that whatever we were analyzing, whatever we were thinking, whatever we were wanting to do, that would happen the opposite. And to be honest, everyone should be honest about this. It happens quite a lot, right? So having understand this, that it happened quite a lot, we need to first think when we come to play with the market, we have to think defense first. Right? So we like, and I really love to talk about sports. I think sports has a lot of resemblance with trading because both are performance, both are competing for something, and we should and we should always have a good combination of defense strategy and offense strategy, and that would be giving us the odd for the whole game. If we don't have a defense, our opponent will score us. We'll find that as our weak spot, and this is what we need also in our trading to first have the defense. But indifferent for trading, in trading we have less control of everything. We have less control of what the market is doing. Unlike in sports, where you can impose on your opponent to do something or to put him in a stressful situation. Here, as traders, most of us as retail traders, we don't have that significant amount of money like the huge hedge funds and the big banks. And so we cannot really play with the market and create situations on the court for trading. So we're playing a really different game. It's more like being a sailor on the ocean and being exposed to nature, to weather, to whatever, and you have to perform with whatever situation Earth puts you through. And that's exactly what we have to do when we are counter trading. So, um, so in trading, we really have to be more reactive to things rather than having the ability uh, to be proactive and create things on the market. We can only act of what we're seeing, and therefore we cannot forecast. So let's talk about a few things on the mindset that we need to figure out. So first, we have these things that we control, and we have the things that we do not control. Okay, if you're bored now, stay with me, it will get better. Okay, so first, the thing that we do not control. We do not control the market, pace. We do not control, market patterns. We do not control the market pace. We do not control volatility. We do not control manipulation in the markets, right? These are the tools for the bigger players. What we do control, we can control only those things. The size of our trade, we can control only the time we are in the market, right? We control when to get out. These are the only things that we actually have control of. All the rest are not in our ability to actually control. So therefore, we have to always be prepared for the worst case scenario. So how do you being prepared for the worst case scenario? You have to map all the scenarios that you're familiar that is related to your own trading strategy. Each strategy mapped the market in a different way, and therefore you have to look at different scenarios. You would see if, let's say, if you trading indicators, momentum indicators, you will be measuring the market in momentum measures, metrics. So so these are the scenario that you'll be looking at. If you're looking at key levels, like I do with the supply and demand stuff, then I'll be looking at the market different, so my scenarios will be different. If you're looking for price action, you will be searching for these price action patterns. You get my other point, okay? So what you have to map all the scenarios, all the familiar scenarios that you had faced and experienced with, and create for them action plans. So you will be always prepared for whatever happens. Whenever you see a scenario, you will have the immediate definition for what is that scenario that you're looking at and what should be your action plan in terms of what you're doing. Are you holding that trade? Are you exiting? What is it that you do? What type of management would you apply once you are facing scenario A, B, or C? Okay, so being prepared for the worst case scenario, You have to prepare yourself with action plans that's driven from having all the scenarios for yourself. You would also, so these scenarios will have to include the sizing, the, the exits, the entries, right? Bailouts, trailing, stops. All the tools that you're familiar with should be included in your action plan. What is it that you're doing? Do you stay in the market? Do you do something? Do you reduce your sizing? Do you add up for your sizing? Is that scenario goes on your favor or against you? Everything should be there. And then you really have to have the maximum loss that you allow yourself. And that goes without saying, but unfortunately, many traders do not do this. We all know about the maximum loss allowance, but we don't really are able, maybe it's a psychological thing, but it really needs to be, we have to be aware of this because most of us, when it comes to when our trade is hovering around our maximum loss, we will start trying to rethink, well, how bendy is that actual definition of maximum loss? Can I, oh, I see this good price action and I think I'll have a break if I'll just extend that maximum loss a little bit more and a little bit more. So I think most of us were in that scenario before. So is it the worst case scenario? Are we prepared for a major announcement and a major crisis in the world that will just go against us while we're exposed on a trade? We really have to be there. So that means that we cannot really risk a big size in the account. We really have to apply patience. We really have to understand that even if we have a great strategy with great performance, with great statistiks, things like worst case scenario can happen all of the time. We can be ready for 99.9% of scenarios, but that one thing that will happen once in a million can hit us tomorrow, in the next hour, or never, but it can hit us and we have to be prepared for that. Okay, so defense first, and so this is the mindset that we need. Another thing on the mindset is that we really have to be modest about the market. I like the phrase that I know nothing about the market or where the market is going to go. Many people that are studying trading, they would go to teachers and mentors that say that they can predict where the market is going. I think even if we predict where the market is going, so much can happen in the time between it actually go there and before that, it can trick us, it can waste our time, it can wear us out, it can put us in great frustration until that, and we can be correct, but it's not the tactic. It's not how we actually take money from the market. Okay, so so predicting where the market is going or trying to be a prophet of what is going to be just will put you in a bad ego situation, state of mind that will that will badly affect your decision making. You will be too overconfident of what you think, or you'll be too stubborn to actually face the reality of what the market is trying to tell you. So we really have to observe and react on the market, and that's all. Okay, so in terms of the risk strategy, what we want to, the tools that we actually have in terms of that strategy is that we can have different approach that should be matching our goals, our needs, our abilities, our knowledge, all these things that we bring into this profession at the very current stage of what we're knowing and what knowledge do we have, and what abilities we have to face the market. These are what will help us to define what should be our best risk strategy to work with. So first, we have to reassess what we are actually having in our basket, in our tool set, before we can actually define what risk strategy we are going to be using. Okay, so this is how much experience do we actually have in our strategy? How much solid is it? How much are we familiar with the different scenarios and different market situation that this strategy can put us, and how much agile and flexible we are in reacting to these different situations. Second is what's our realistic goals. Okay, are these goals comply with the resources that we have in terms of knowledge, experience, funds? If we want to make 5K every month, do we have the sufficient ingredients for that? Do we have a big enough account for this? Do we have enough experience for this? Do we have statistics for this? Do we have the market situation, the market conditions to be equivalent for that? So how long do we hold the trade? Are we swingers? Are we day traders? Are we scalpers? Are we high frequency? How many trades how many signals can we find in a day, in a week, in a month that can be comply with realistic goals? And with realistic goals, we really have to find what are realistic, or what should be our maximum risk allowance. What would be the most total loss that we can actually face and not being frustrated and throwing everything away and saying, okay, I'm changing my profession? What would be the absolute lowest point that after that we say, okay, I give up? Okay, and what will be, and when you have this catastrophic risk allowance, go further and ask yourself, what would be a comfortable risk. A comfortable loss. It's a comfortable loss is something that if I go today on a street and I lost a $1 bill on the sidewalk, and I go back home and I see, oh, I lost $1 bill. For me, it's something that I'm comfortable of losing. But if that would be $100 bill, maybe I'll be very upset, and it will actually would affect me emotionally or even financially. Okay, if I would be losing a suitcase with $1 million, it's something that I can absolutely cannot afford. I will have to sell all the assets of my family to repay that. Okay, what is a comfortable loss in terms of my portfolio that I can live with? So once you define this, you would know how much you are able to risk per trade. So let's say you have a trading account, and with this trading account, you have only 4% maximum loss. Sounds familiar? So with a 4% maximum loss, with a 4% maximum loss, let's say we say that 4%, that $400 on a 10K account, that's the maximum loss that we can afford, because this is say it's game over for us. So we have to split this for, let's say, 8 or 10 portions, or 15 or 20, whatever we are comfortable in losing, because losing is part of the game. Losing in trading is the business expenses of that trading business. Okay, unlike business, it's you always have that feeling that this expense didn't have to be. So this is why it's harder to take that as an expense, and it's more looked as a loss, but it is an expense. So if you know your statistics, and if you have that number, let's say you know that you have a 60% win rate. Okay, so you have 40% loss rate, and you start trading and you're collecting all these losses, and you see that you're still at 28, at 25, at 16, at 30, 35, you know you're still in that zone that lets you live freely and comfortable. Okay, so it's very important for you to understand where you're at with this. The next thing about your risk strategy is, what is your actual performance? And this is a very tricky thing, and please pay attention for this, because when we are considering loss rate or win rate, it has many different ways of actually measuring this. Let me give you an example. Is a win rate when you started a trade and you were aiming for 1 to 2 risk reward ratio. Okay, so you were setting your trade and you set 20 pip stop loss, so you're expecting to win 40 trades. Okay, if you were actually taking that 40 trade win, that would be count as a win for sure. But what happened if your trade came to the point where it was like 25 pips, and now it starts retracing against you? So you shift your you trade your stop loss to a break even plus 5 pips, just to be on the safe side and not to and to have some pips from the market. So you won 5 pips. Is that considered a win rate? Is that trade of 5 where you were aiming 40? Is that considered a win rate? It is, because it's above 0. It's not a loss, but is it a win? So if you are measuring your win rate only with the trades that were hitting your target, is easy. But if you have something in between, if you have a partial win and partial loss, then you have an extra 4, you have an extra 2 variables to include into your formula to actually understand what is your actual win rate, right? So let's say you were winning 5 pips, that's 1/8. Okay, so maybe you can just consider this as 1/8 of your win rate. Okay, so you had a full trade, but you actually it's 1/8 of the of to add to your win rate. Okay, so in order to actually learn your statistics, you really have to understand how do you actually trade, and how you actually perform while taking losses or taking the profit. Do you take the full of it? Is a loss that didn't take fully, is it considered a loss into your statistics? And why is it important? It's important because if you're looking for the right balance between risk reward ratio and your success rate accordingly, if you're not taking the full loss or the full target, that will mess up your statistics. Your statistics will not be accurate. So what do you know about yourself? And then again, acting in the real world and actually taking partial is good, is a good behavior, responsible behavior. Why taking a winning trade and make it a loss if we were seeing that price action had made the market retrace on us, right? So just for sake of having a comfortable statistics is not reason good enough to actually lose money in the market. But then we don't have good statistics to learn about ourselves in order to figure out what methods and what action plans we have to build on for ourselves in terms of that. So we will have to figure out how to actually measure things in a true and realistic way, for in order to actually build a good risk strategy. So having said that reality is more complex, let's get back into the laboratory and see when nothing really interferes, when reality doesn't interfere with theory, what should we expect? It's a laboratory situation is a good thing. Oh, sorry. Is a good thing, just to understand the theory and to know what you are expecting from reality to be, but you have to be more flexible than that. So let me bring it up. And I'll be changing my screen share to this. Okay. So this is a table that I've built and presented before. If anyone follows me you probably know it, but this is a simple laboratory that everyone can do um, for himself and find out what should be the expectancy of his current skill in trading, and to be able to start building the fundamentals of your own risk um, method. So let's first start with what is this table. This table is, I call it risk reward ratio for break even. Okay, this means that based on your performance or on your back testing, on your demo trading, on your simulator trading, whatever you do in a laboratory situation, or by the way that you are actually counting your win rate, what win rate you have to perform in order to be what win rate versus risk reward ratio you would need to have in order to hold and be just a break-even trader. Okay, so if you will be risking the same amount of pips that you are expecting to take from the market, let's say 20 pips. Okay, so 1 out of 2 trades will be a winner, 1 out of 2 trades will be a loser. That's 50% win rate. And that will make you a break-even trader. Okay, you're not winning any money, you're not losing any money, just on the theory, right? Okay, so if you take 3 trades and you have a 1 to 2 risk-reward ratio, meaning that every time you risk 20 pips, you are gaining 40 pips, and you're capable of doing that, you will have to be only 33% win rate in order to be a break-even. If you want to be more than break-even trader, you have to be more than that. More than the 3.3%, 33%, 1/3. Okay, out of 4 trades, you will have to win 60 pips for every 20 pips you're risking, but then your win rate would drop to only 25%. Only 1 out of 4 trades should be profitable just to be a break-even. So if you're trading 1 to 3 strategy and you're winning more than 25% of the times, then you become a profitable, consistent trader, right? So this would map for you how much you have to be with your risk-reward ratio target versus the win rate. The hard thing here is that as much as you expecting to earn more based on your risk, as much as you're looking for a higher risk-reward ratio, the tendency of the market is also to be against you. Okay, so it's always a zero-sum game. Okay, you'll always be risking probably the same, but you should be aware of the mathematics behind it, so you know where you stand, so you know where you're comfortable in terms of your win rate and in terms of your targets in the market and in terms of what you're risking in the market. Okay, with that you would know what is your break-even pivot point. Okay, and for the very same thing you can do the very opposite. The things that no basic trading school will teach you or ask you to do is to actually have a negative risk reward ratio, meaning that you will be maybe risking twice as you're expecting to take. Okay, so but there's also mathematics that resolve this. Okay, so if you are risking 20 pips and wanting to take only 10 pips, you have to be right 66%, like 2/3 times, just to be a break even. Okay, but maybe if you would know how to, and this strategy is very good for scalpers because they are taking impulsive moments of the market, and it's really easy. I can tell you that I trade negative risk reward ratio quite a lot because with that, this is the patient that I have. I'm very short patient in terms of trading. I don't like trading to ruin my day and hold on long trades. I don't have the guts for it. So I really looking for places where I see spiky reaction, and this is where I want to just scalp. And with that, I know that I can take, let's say, be 75% of the time while expecting to take half of what I'm risking. So if I'm 75% right while I'm doing 2-to-1, I'll be a profitable trader. So maybe it's not as efficient of being a trader that can take 1-to-10 or 1-to-20 or 1-to-3. It's less efficient, but it is profitable. Okay, so I'll be working on the short term, and that will be very exhausting, very tiring. I'll have to look at the screen a lot. Okay, you get my point. You get my point that if I'll be trading negative risk reward ratio, I will have to have a very high win rate. Have to be very attentive to the charts, as contrary to the people that are going to swing for higher risk reward ratio. So that to show you that we are all being built by different characteristics, features, and therefore we have to figure out what is our risk reward ratio in that sense. Okay, so if I know what is my break even in terms of risk reward ratio versus my win expectancy, then I can return to to building my my risk management strategy. Hold on, I'm looking for a way to go back to that mind map. One sec. Okay, so you know what? For some reason I can't present this, so I'll show you. Okay, so in terms of okay, in terms of risk management, we have a different approach for different scopes on of our trading. First, we have the portfolio level of how much do we actually risk in the overall portfolio. Then we would probably also have a definition for how much risk and how much and what will be our features on terms of a session or a sequence of trades. Let's say a weekly sequence or a daily sequence. It really depends on the magnitude of your trading and how you would, what should be your checkpoints for actually measuring yourself. And then we have the lowest resolution of things is, and this is how you actually manage a trade. And with managing the trade, we would have more things to it because this is our daily. This is what we're actually doing, producing. It's actually managing a single trade, deciding where to get in, deciding how to hold, how to get out, deciding what should be the sizing, should decide how we should manage the trade on itself. So we have basically two different approach in terms of the money value of a trade, and that goes for both the portfolio session and this, the single trade resolution. One is that you would be risking with your risk reward and definition, but you will be risking a fixed value of money or points in the market, saying that you want to risk only $20 per trade. Okay, you will be that would be your maximum comfortable loss for each trade that you're going to take. Okay, or you can say I'll be risking 60 pips, 60 points for every trade, not more than that. Okay, that will be your thing. And if you are fixed on your points or on your dollar value per trade, then your equity curve, when it's on a win, it's going to look like a very nice, it's laboratory, right? You will see just a straight line going up, okay? And this line is just, like we said, it's a laboratory condition, so it's just the expectancy line, okay? But it just to, we'll go to the next slide and then you understand why I'm showing this like this, not realistic. Okay, so, but if you're losing, you would have a losing strikes, then your equity will go as deep like this with a straight line facing down. Okay, so that would be a fixed point value risk. Okay, but if you would be risking a percentage, you would be rewarded by two things, one on the upside and one on the outside. If you be winning and every time you'll be compounding because you're risking percentage from the market, from your equity, from your equity worth, then every time you'll be compounding, the same percentage will represent more and more money, and therefore you'll create an exponential growth. So that's something really, really lucrative that we're looking for in trading. And that's great if you're always risking percentage and building up upon your success. That's a great thing. The other side, which is also beneficial on the losing side, is that if you're losing, your percentage now worth less money, so you will be always protected with the same buffer, and that will have this shallow down curve that will also protect you, because as long as you're losing, you are actually having less money involved, but it's still the same percentage. So once you be able to recover by gaining more points from the market, they will compound and will bring you back to exponential pattern. So with risk percentage, you will be very much protected. So let's say it's only 2.5% of the account. Okay, so you will always at any given point will be risking only 2.5%. And let's say you started with 10K, now you're at the 7K, now it's still a loss of only 2.5%. You will never get to the point where you actually took 100% of your account, because if you keep doing this, okay? And once you recover, you will be always able to compound on your latest win. So if you put this on Excel, you will see just amazing results on this. So this is why I like percentage risk compounding. I can tell you that within the 5ers, you don't really need to do this. You can also be more easy on yourself by trading a fixed dollar value per trade, or pop or point value per trade, because in a very short while, even before the percentages start showing significant, we will double your account while you're making this your target. So so that's another good thing about our program, that it allows you to play both and find out what are you more comfortable in seeing. In having a fixed point value, it's very easy for you to always understand and see where you stand in terms of your achievement, because you know, okay, I'm looking at my journal and I see 40, 40, 40, 40, 40, minus 40. You know the numbers by heart, and it's easier to accumulate. So, but with this, if you would be managing 100% of your margin, maybe with your own self account, stick to the percent. That will be very helpful for you on the long run, even if you have a bad strike sequence. Let's get back to our chart. Sorry. Second, I got to organize my stuff back. Okay. So what are your risk strategy components? And again, it's I'm talking to you about this on a very high and theoretical level. Why? I explained it before, but I'll say it again. The reason for that is because each one of us is individual. So what I'm expecting from you to do is to actually summarize for yourself these ingredients, these components, and try to figure out what kind of blend combination you can do for yourself. Just being aware for these and build your own strategy, your own action plan, right? According to your scenarios, in order to find your way. And then you have to experiment this. So the risk strategy components are like this. First, what type of we're discussing risk reward ratio, right? And win rate. This win rate is spreaded on what sequence, on what circumstances. You can have a different approach for this. Let's say I call it the entry profile. Okay, so your entry profile could be something like cherry picking, I like to call it. It's meaning that you will be analyzing and finding only the highest probability trades, but you will have less than that. But you can also have the spraying method, meaning that every time I see a signal that qualifies my a potential, I'll enter, and with that, I will have enough statistics. I will have maybe a lot of trades, but I will meet my statistics by the quantity and not by the quality. Okay, so we have the cherry picking, which is the quality, and the spraying, which is the quantity, and both can work. It really depends on you. It really depends on what type of trader are you. Do you want to be missing out good trades on the inside? Are you capable of doing that? Or are you willing to take many trades and you are okay with losing many but winning more than many? And what works for you? And maybe you can have something in between, meaning that if you follow my trading room, sometimes you would notice that I have different profile for different things. If I would notice it's a cherry picking trade, I will risk my full portion that I dedicate for this. But if it's something in between, I will have a definition for why trades with less with with less risk, because or with cherry picking, I'll be set and forget because it has more tendency to work. And with mid-range trades, because I'm trading edges, I'll be apply confirmation, right? So what would be my entry profile in that sense? Okay, we can do also the, I'll write the combination. The combination of both, we put it in between. And so if quality, then we take a full risk. If it's not quality, if it's for quantity, okay, we'll take half risk or less, or we apply more confirmation. Okay, so your entry component for the risk management is your profile. What type of trade is it? Not all trades are equal in their risk assessment. Okay, and as much as you figure this out for yourself, then you could blend this into and create your own working plan that is more and more sophisticated to what you're doing. Then after we have a good assessment of what we want to do with that trade, then we have the entry, the entry method. So the entry method can be in terms of size. It can be, you can take the full in, that you were expecting. You can enter gradually as the market show it's okay for you. You can enter full, but if something doesn't work, immediately take some portion out, some exposure away. If it's do you enter with confirmation or not? What how did price came to your level? What was the approaching pattern, whatever it is for you, if your indicator, or if your price level, or if you're even fundamental, everything has significance and variations that you should be aware of, and that will derive drive different decisions of how much risk and size you want to use for your entry. And then you have the holding, how much attentive you have to do it. Is it set and forget? Are you letting the trade going all the way to your TP or to your stop loss, or will you join in the action while you see it? Do you actually have the time for this, to actually monitor your trade and trail your stop and do everything? And how does that affect to your statistics? Okay, and then and more to that, you can also, if the trade rolls in your favor, do you scale in? Do you scale out? Do you take partial profits, or do you add on to your profits? What will be your risk management? Because if you would be adding on, you're now risking all the profits that you're making. So that eventually can get you into to bring you to the situation that you've done nothing or even made a loss from a win. But if you win, you're going to win more, but maybe you can afford this. Maybe you know something, maybe you understand the market in that way that you can do that, or you can just take partial profits. All these are tools that can build you up into your risk. And then you would have the exit, which is also being partially covered by the holding component. So the exit, would it be at a fixed price like you've said before, or that is just the minimum? What you do when price get there and you're not taking that profit? Is it partial? Is it the full thing? Is it, how do you exit? Is it because price get there, or is it because the pattern had shown you that you have to be out? Is it an EA that managed this for you? Everything should be there lined out for you. You know best, and with that, you would have the information of how you actually need to manage your risk for that. Now, the next thing is, so we have our entry profile, we have the entry, we have the holding, we have the exit. But then remember, we were discussing these scenarios and the action plans. And the scenario and action plans is something that not many people understand they can actually do. And that's another very important component of your risk strategy. It's what you do for catching a loss. Okay? Should you go all the way to your loss, whatever what, or can you do something to make your trading more efficient? Meaning, a loss should not be as big as you have planned if you see, if you recognize the market has a different pattern that you were thinking at the beginning. So what would be your cutting a loss strategy even if it didn't hit that maximum loss. So if you would be mapping, and I think I will make this highlighted for you, because if you are going to write down your scenarios and you will then start to um, resolve these scenarios with action plans, then you would be able to create a very effective trading way, because our trading is not just one strategy. We always on the verge for learning more and being and having new ideas, and also the market changes. We always need to be on reassessing the environment of whatever we know, whatever the market is. Everything is changing constantly. So we always need to be working on these two things to be better, to be more perfect, to be more agile for changes. All these tools will help you out building an immune system for your actual trading, um, um, with whatever strategy you come up at the first place. So to wrap things up, risk management is a huge subject that you really need to dive deep inside and learn how you are within that. What's the tools that you actually have handy? Maybe we didn't cover a lot of things that are related to risk management. There are so many different ways of reassessing your trade probability, and there are even a lot of very aggressive ways to manage the money on these trades. I've seen Fibonacci sequences of risk management where you can just double account with like 6 trades. It's just amazing. I mean, with mathematics, you can do amazing stuff, but you always need to be aware of the risk of the risk, and be prepared for the worst case scenario. It can work out for you, and we'll see so many heroes on the forums telling you that they are making zillions of dollars and they driving the best cars and they have the best haircut. But you know what? When something goes wrong, are they protected? Do they have that seat belt, that helmet, that vaccine, that immune system for the system? Or is it just a temporary success that they are showing off? Don't be dazzled by this. Be honest with your own self if you're looking for a consistent success in this, because we're always at the risk of having the worst case scenarios, and therefore we have to be modest. So thank you so much for being here today. And if you like this specific webinar, just write us and we can go deeper into this. Each one of these branches can go on and on and on. We can discuss this, but it's very important for you to take it from here and start learning and diving in and see where you can find yourself, your existence in trading for actually finding your odds in terms of building a good defense first for your trading strategy, and then on you'll be profitable and consistent. So thank you so much, guys, for being here. I'm not able, I wasn't too much concentrated to actually find out questions here on the chat, so please forgive me if there's something that is not being said or being clear enough. You can write us to help desk at the Fivers, and maybe we can just elaborate this more on the on email or maybe on future webinars. I would like to take this opportunity to tell all of you that we are having our new feature on the website, which is Trade Ideas. It's a great opportunity for all of you to share your ideas and share your thoughts about the market, and to actually meet people that think like you or maybe even contradict your thoughts, but that will get you in a very healthy debate on how you looking at the market and what you're expecting from the market, and that will actually excel your self-learning and progression in trading. In many years that I was in education, I was sharing endless all my journey from the very beginning, and just being involved with community and people reacting to my ideas, and then later on even complimenting my ideas. It's brought me confidence. It brought me, it got me more solid with what I know and what I want and how I see um, um, my trade, and I also got a lot of good friends where I can consult with them just because of the fact that I was sharing and being exposed um, with my ideas. So please use it. It's under trading resources, trading ideas. Share your ideas, comment to your friends, find friends, and at this point, I'll have to go. And I really want to thank you for being here and spending 1 hour with us on this. Risk management, that was the webinar for today. Thank you so much. Bye-bye.
Okay, hi everyone. Thank you for joining me today for this relatively short webinar about the wonders of the spinning top. Just a quick disclaimer, this webinar is for educational purposes only. I'm not going to give any advice, any trading advice or signals, and everything here is only for education. And let's start. So just a 1 or 2 words about myself. I joined the 5ers last month. I've been trading since 2008. Started with Forex, but trading also other financial instruments and markets, mostly technically. And in today's webinar, we'll review what I think is a very nice setup or signal for that gives, let's say, a hint about what the market is going to do, and it's mostly in the long-term or high time frames, but it doesn't mean that you can't find it in lower time frames as well. We'll see some examples, including some very recent and amazing examples. So for short parts of this webinar, we'll discuss the spinning top candle itself. We'll talk about references to see where the spinning top candle is found, because it's not relevant just anywhere. It's mostly relevant when the deviation is large, or where it's adjacent to moving averages, or around supply, demand, or support and resistance zones. We'll talk a little bit about how to trade it, and we'll see an example, a recent example with the pound dollar. And of course, we'll talk a little bit about risk management and trading mentality at the end. So let's start. And again, as I've mentioned, this is not like a magic entry signal. When you spot it, you immediately enter. And most of the examples you'll see here are on the daily, weekly, and monthly charts, but it's definitely applicable for any time frame. It's just that on the higher time frame, it works really, really nicely. It's applicable to all markets, so I'll show you some examples also from commodities and cryptocurrencies. As I said, we will add some reference points which will increase the validity of the pattern of the signal or the candle, and it really gives you the opportunity to recognize ahead of time where the market could be going. Mostly for reversals, like major reversals after a long trend, but sometimes it's like a minor reversal within a trend. So like after a correction, it can signal trend continuation. It definitely gives you an edge over the market, which means it can tell you, if you're in a position, it can tell you, listen, maybe you should close a position, or at least move your stop loss closer to protect your profits. It can give you a hint to enter the other way, and of course to take the other direction of the market after some confirmations or in lower time frames. But again, it requires patience, because definitely we're not going to trade the weekly or the monthly charts, maybe not even the daily, but in lower time frames, you can start looking for places to enter. Patience is a virtue, especially in trading, and with the spinning top, you will need patience, but it pays, and it pays big time. I will give you maybe also an example, or talk about some things I've seen in the last week or two from our traders that eventually, managed to take very, very big gains, but because they weren't patient, they had some losses before these big gains, and with patience, they could have avoided these losses. So let's start with the candle, the pattern itself. The spinning top candle, definition from Investopedia. It's a candlestick pattern that has a short real body. Okay, it's short. It's not a line. It's not like a doji candle with a long-legged doji candle. It has some sort of a body. Okay, that's why it's called the spinning top and not just a simple doji. And the body is vertically centered between long upper and lower shadows. And the keywords here are centered, so it's not at the bottom, it's not at the top, it's in the middle of the, like in between the wicks, and the wicks are pretty much the same size, and they're usually long. Okay, we're not talking about short wicks, we're talking about long wicks. The candlestick pattern represents indecision about the future direction of the asset. It means that neither buyers nor sellers could gain the upper hand. But again, as we'll see, usually when it comes in with specific setups, it definitely shows you or can tell you where the market is headed or who's going to have the upper hand, the buyers or the sellers. And we'll see plenty of examples, including examples from this week. The spinning top candle can appear anywhere on the chart and on any time frame, as I've mentioned, but the pattern is mostly meaningful when it appears as part of long trends. And I said at their potential end, because when the trend is there, we don't know that it has ended or it's about to end. But when you see a very long trend, usually at the end also with big candles, like there's strong momentum, and then this candle appears, usually this candle has a very significant meaning. So don't look at this candle anywhere, but usually after long trends, we'll see examples, and of course around supply and demand zones or support and resistance lines. And I've also added here examples of other reference points, such as moving averages. Maybe it can also be Bollinger Bands, but in this case, I'm using moving averages, either when the spinning top candle appears far away from the moving averages or adjacent, like on top of the moving averages. If it's not too far away and not adjacent, then probably doesn't mean anything, or it doesn't necessarily mean something, again, unless it's in a supply or demand zone. But if it's very far from the moving average, which means that there's a big divergence or a big that the price has gone way too far with its sorry, I forgot the word now, then it usually means that we're expecting some retracement. It was standard deviation, that was what I was looking for. So if we have, like, I don't know, 1, 2, or 3 standard deviations away from the price, then usually it means a retracement is due. And if the spinning top is deviated long way from the price, then it is stronger. And again, the longer the wicks, the stronger the candle and its following reaction. So don't look at small bodies with small wicks, but long wicks, and the longer, the better. Let's look at a few examples. So you can see here, let me just turn on the mouse. Okay, you can see here this spinning top after a long run. You see this is a weekly chart. Okay, this is from a long time ago. As I've mentioned, I started trading in 2008, and I've noticed this pattern already back then in 2008, just before the end of 2008. Look at this spinning top on the weekly chart and look at this huge candle right after it. The trend didn't go straight down afterwards, but it definitely went down quite a lot in the following weeks. But this was the initial signal after a very long run with big bullish candles. Here too, you can see the spinning top, not so long wicks, but again, it's the weekly candle, so it's still not too small, and it's within or right below a supply zone. So this is another significant thing. Here too, you can see hesitation candles above the demand zone, but these are not classic spinning top candles. Here too, you can see sort of small spinning top candles, but again, relatively small. This one is definitely, and I show you this because I always kept this pattern in mind with this specific example of the euro pound. So this is classic. Another example, huge wicks. Look at this small body and this huge wicks right at the bottom of a very long move. This one is a monthly chart. Okay, huge move down, very strong, and then very, very big wicks and a confirmation candle. It doesn't, we had a move up, okay, of about, I don't know, 3,000 points or pips afterwards, but then again, it continued going down and went up again. So it was already a hint for what's to come next. And you can see that at the bottom of this spinning top, the bottom of the candle was the area of demand, after which the buyers came when the price condensed or compressed into the bottom of the demand zone that the spinning top candle formed. So again, as I said, it gives you an edge. It doesn't mean you trade it. Obviously, you don't trade the monthly candles, but it gives you an edge. It tells you where the market could move in the following days, weeks, or months, sometimes even years. Here's another example of the euro dollar monthly chart. Again, strong moves, spinning top candle here after long moves. Another move here. This one is not a very long move, but again, it gives you some hint about where where it could go, and you see the strong candle confirmation candle afterwards. And again, we'll talk about how to trade these patterns from the lower time frames afterwards with a specific example. So this is just a quick overview of the spinning top pattern or candle. Now let's talk about the second part is about references. As I've mentioned, two possible references: moving averages, and of course supply and demand or support and resistance zones. Let's start with a moving average. Moving averages. So moving averages can serve as context for the spinning top to have a potential meaning or a potential reaction, because not every spinning candle or spinning top candle is relevant when you identify it on the chart. What I'm using usually on my charts, and I've mentioned it in my previous webinar, is moving averages, 3 moving averages, mostly exponential, the 9, 29, 21, and 50. Some use 10 and 20, or 9 and 20 and 50. Some even add 100. And when the spinning top appears after a long, strong trend and runs away from the moving averages, which usually serve as dynamic support or dynamic resistance, and we have a strong divergence or a strong runaway from the price, then a deviation, then we usually expect a mean reversion, that the price will come back to its mean, to its average. And then with the spinning top, it's even stronger. So when the spinning top appears far away from the moving averages, it usually signals the end of the trend, and we'll see some examples in a minute. When the spinning top appears in adjacency to the moving averages after what appears to be a corrective move, then it usually signals a reversal for continuation. Here's a relatively recent example. This is the gold futures. It's the same on the XAU dollar. A spinning top after a strong move up. Okay, the monthly chart, a strong, very strong bullish move up that's been going on for almost 2 years on gold. And then the spinning top, see how far away it is from the moving averages. The first moving average is the 9 EMA. Okay, you can see how the 9 EMA serves as sort of support, but then the price runs away from it and forms a spinning top, I can tell you that when I saw this spinning top, I started shorting in the futures market. I started shorting gold, but I also sold my gold stocks, the gold mining stocks that I had, because I realized that after such a big spinning top candle, far away from the moving averages, gold was going down, and I had some gold mining stocks that I was holding in my portfolio, my long-term portfolio, my investment portfolio, and I just sold them. And yeah, I've made some money. I didn't, I didn't trade it a lot. I was working at investing.com at the time, very busy there, but still took some shorts on the futures in the futures market, and just got rid of my gold stocks and gold mining stocks, and that's what I said about having an edge over the market. Even if you don't trade it, but avoid buying there, or entering at this bad point, or even selling your gold mining stocks just before they go down, because you see this pattern. Even this is a nice edge. Edward is asking, would you say the spinning tops only have significance on the higher time frames? So yes, as I've mentioned at the beginning of the webinar, I'm mostly focusing on the long time frames, because that's where the spinning tops are the most significant. They have time to give long moves, but they're relevant also with these patterns, with the long runs and the spinning top at the end. They're also relevant on short time frames. It's just that for some reason, maybe I've missed, maybe I didn't notice the right setups, but for some reason I see these spinning top patterns mostly on long time frames, and I love short time frames as well. The H4, H1, even 2-minute charts. When I traded futures, I used to use the 2-minute charts. I didn't notice this pattern so much, but again, maybe I just wasn't aware of it on the shorter time frames. And you say 5 candles prior. Okay, yes. Okay, so the question that Hartmut is asking is about this candle, the green one, which is sort of a spinning top, somewhere in between a spinning top and a doji candle, because the body is very small. As I said, if it's adjacent to the moving averages, I will refer to it only if it comes after a corrective move. So I will show you an example with Bitcoin in a minute, but here it doesn't have much significance, because there was no correction and it's not far away from the moving averages. So I didn't give much significance to this specific candle here. On the third wick after the reversal, where it went back up and rejected the open, you would enter stop slightly above the high. So here again, I don't know if you're referring, Chris, to this chart, but here it's a monthly chart. I don't trade the monthly chart. I just start looking for the opportunities on the lower time frames, and I will show you an example, an elaborate example on how to trade this pattern, or how to start looking for entries and exit after you. And that's the great thing about this technique or this pattern, that it gives you a lot of time to get ready, but it requires patience. But patience definitely pays with this pattern. Look at the Bitcoin. When you look at it from on a log chart, logarithmic chart, it doesn't look this imminent or this impressive, but on a regular chart, it definitely looks impressive. Look at the spinning top, and I told my colleagues at the time that with such a huge spinning top, it's definitely the Bitcoin is going to go down, and it went down immediately. I mean, it didn't even wait for a few more months. This is again a monthly chart, It's amazing how it dropped from 65 at the top to 30 at the bottom within a month and a bit. It dropped from its peak by more than 50%. Okay, and so yeah, this chart, I mean, watching the cryptocurrency charts is always mind-blowing, but after it went down, also look, before it went down, here's another nice example of the spinning top here at as a continuation pattern, and this is what I mentioned earlier. If you see a move and then a retracement, and then you get the spinning top adjacent to the moving average, which serves as a dynamic support in this case, then it can give you a hint as to the reversal or the trend continuation. Okay, so this is like a minor reversal after you have a retracement back to the moving averages, and the spinning top is sitting on top of the moving average. If you want to wait, you can still wait for a confirmation candle, but again, this is a weekly chart, so anyways, you have to go down to the lower time frames and start looking for the entry, but it gives you an indication of what to start looking for. In this case, start looking for a long move up. Another question from Benjamin, referring to the spinning top in the previous question. Would it be wise to trade it for continuation? If you're referring, so again, if you're referring to this one, I wouldn't say it's a continuation candle so much because it's because there was no real retracement here. I mean, it's on a monthly, yes, there was maybe some retracement, but I would look for a real retracement here. It doesn't look like a corrective move, not really. Here, by the way, maybe I should have circled it. This sort of spinning top, it's a small one because you see the wicks are not very big, but it's still a small spinning top. This one is more of a continuation pattern. You have a corrective move, the spinning top, a small one on the moving average, in this case, the 21 moving average, and then even a confirmation candle, and you have a move up. Again, this is the monthly chart, so you have plenty of time to start looking for buy positions after this candle. Another example here, the pound dollar on the weekly chart again. So you can see a long move on the left side, a long move, a spinning top, and a move down. The trend doesn't immediately go down, and you can see that it was sort of a hint before forming a double top and then moving dramatically down. You can see an example on the very most left of a sort of a spinning top after a corrective move, but again, it's not a classic one. A few more spinning tops here or indecision candles, so you have a move down, a corrective move to the moving averages, a spinning top here, and continuation down. You have here some sort of a spinning top. The ones that I've circled with the dashed circles are the ones that are not so strong or not the classical ones. But again, you can see here a spinning top coming back to a small supply zone. Here, a spinning top on top of the demand zone. Okay, here some indecision candles, but you know, not in the middle of anything really. Okay, maybe a small corrective move and a move up, but not. Again, that's why I'm looking for the really classical ones after a long move or within big supply and demand zones. Here, by the way, you have a spinning top which is relatively far away from the moving averages. It comes after a long move. Again, this is the weekly chart. And it's also within this supply zone. Okay, you have here a supply zone. Let me just draw it here. You have this supply zone, something like that. Okay, so this is a supply zone, and you have this spinning top within the supply zone, which brings after it a corrective move, but it, it found support around here, the moving averages and the previous resistance, which was broken up, so it didn't continue much longer. Okay, so that was the first reference. Either after a long run, a long move up or down, and far away from the moving averages, this means usually a reversal, or if you have a corrective move back to the moving averages, and then it finds support or resistance there before continuing to with a trend. The second option, if you don't like moving averages, or you want to have something on top of moving averages, but obviously this is even a stronger reference, is of course the supply and demand zones, or if you have a local support or resistance area or support or resistance lines. So what we're looking for here is for the spinning top to appear inside or next to or on top of or below the supply and demand zones. And the spinning top itself serves as price action for the supply and demand. Of course, the bigger or the wider the zone and the higher time frame the zone is, the longer it may take for the price action or the price to turn. And of course, for the pattern to complete, and also sometimes it will take a longer time, for accumulation or distribution in these zones before the move to the other side. But again, these are very strong and very rewarding. Does the market create the patterns so traders can push the price, or is it just a case of buyers and sellers fighting until the candle closes? So that's always, Chris, that's a good question. And I've always wondered if these technical patterns that work so beautifully, if it's like, I mean, do people somehow create it to signal everyone this is what's going to happen, or that, it's, or is it just because somehow it happens and then everyone sees it and then the price moves? I think basically when buyers and sellers are, we call it fighting, but yeah, and also obviously algorithms see patterns and levels and act accordingly. But I think it's not just about buyers and sellers fighting. It's, I remind you, like I said, if it comes within the zone or next to the zone, it's usually around areas of accumulation or distribution. So it's not really fighting, maybe even cooperating. Some are buying, some are selling, buying, selling, buying, selling. And eventually what happens is you have an indecision area, but it's, maybe you can call it indecision, but maybe you can call it a decision to accumulate or a decision to distribute in these zones. And eventually once the big, institutionals and the big traders finish distributing or finish accumulating, then the price moves in the direction they want. For example, let's look at the ASEAN monthly chart. You can see this huge supply zone. And when the price went back to the supply zone and formed this spinning top, it's somewhere between spinning top and doji. Look at this huge move down. It's absolutely amazing. This is during the 2008 crisis. Okay, everything went down, commodity prices and housing prices, of course, and the dollar became very strong. And look at this huge move down after this signal from the market. You can actually see even before this red spinning top or red doji, you can see already some sort of another spinning top, the green one. And I wouldn't say doji is significantly less indicative than a spinning top, but you know, it's just I think they're pretty much similar, but I think the spinning top, you know what, in places like this with a huge supply or huge demand, and with on a monthly or a weekly chart, I would give importance, or I would notice either the doji or the spinning top the same, but the spinning top is very strong. So this is why I'm referring specifically to the spinning top, even more than the doji. You can see here this demand zone, which was respected several times. And again, a spinning top, even a few of them, this is accumulation, okay, the monthly chart. So you can see how the price came back to the demand zone, accumulation for several weeks, okay, three months or so, accumulation, and then continued up. You can see here, by the way, a small, not a classic spinning top, but again, an indecision candle on top of a reversal area that was previously resistance, and then came back to test it as support with this candle, sort of a spinning top. And yes, and the webinar is recorded and will go live on or go online on our YouTube channel. Another example from crude oil. This one is H1. Okay, so hourly chart. It doesn't necessarily have to be monthly or weekly, but again, obviously the moves here are much shorter. But again, for day traders or scalpers, whatever, it can be good enough. So you can see here a nice move up, a spinning top or a doji candle, and then a move down. You can see here a very nice move back to the demand zone, okay, and spinning top in a few in pin bars, and you can see all the candle wicks showing how the buyers are coming in, and it's on top of the demand zone, so it gives you a nice opportunity to take, and even a double bottom gives you an opportunity to go long. The moving averages I was using were 9, 21, and 50 exponential. Satish, can you please explain how to draw supply and demand zone? Yes. So very quickly, how do I draw, or how do I decide where to draw the supply and demand zone? So if I have two candles, let's look, for example, at these two candles here. I look at the, okay, I look at the price, the place where the two candles have the same price, and I look at this, the place, the closing bodies, and I take the place where they meet. So in this case, it's here. Okay, the closing body of the green candle meets the body of the red candle, and this is for me the base of the supply here. Okay, so sorry, so this is the supply zone. Let me show you another example. Let's move to the next chart, and I'll show you another example. So here, for example, you can see I take the connection, the place where the two bodies meet, okay, and then the opposite point. In this case, it's the higher point. If I took, for example, here these bodies, okay, I would. This is where they meet here, and this is the opposite point. So that would be the demand zone here. In this case, the demand zone is something like this. Okay, and supply here, for example, this is the supply zone of these candles. Okay, so I always look for the place where the bodies meet, and the opposite high or low is um, the other side of the supply or demand zone. I hope this is clear. I hope it makes sense. And the spinning top doesn't have to be a candle of the opposite direction. It's obviously it's stronger, but it doesn't have to be. I mean, for example, if we have a move up, the spinning top can be green or can be positive or bullish as well. It doesn't have to be red or negative or bearish. Okay, if we have a move down, the spinning top doesn't necessarily have to be bullish, but obviously it's a stronger indication if it's of the opposite direction. Okay, so here we have the pound dollar, and we are talking about right now. This was taken today, and this candle here, the spinning top candle here, is from 2 weeks ago. Okay, and you can see the demand, sorry, the supply zone. First of all, you can see on the left side of the chart, you can see a spinning top candle after a long move and then a move down again. We saw another example how it doesn't necessarily create the move immediately, but in this case it went down and then up again before a double top, and then the big move came. But the second move created this big supply zone, and we came back to the supply zone in the recent weeks. And 2 weeks ago, we had a nice spinning top, not a very big one, but still a nice spinning top. And we saw the moves in the last day, a very strong move, but the move down started even earlier. As for Santosh, as for your remark about the second spinning top that should have been avoided, as the trend was broken from 2 previous highs. I'm not sure what you mean. The trend was broken from previous 2 highs. You mean maybe? Okay, I'm not sure what you're referring to. If you're referring to this spinning top candle, again, it's after a long move. Okay, right, coming right into the, sorry, right into the supply zone around here. So it's still valid. And if I draw a trend line from 2018 to 2020, yeah, so if I draw a trend line, obviously, if you're referring to, I don't know, something like this, then yes, it went up, but maybe the trend line is not accurate. But yeah, we have some sort of, maybe the trend line came here and then it broke. But you see, it still broke. It still broke into the trend line again. So even if you don't trade the spinning top, even if you don't go short here and sell, you still say, okay, I have to be careful. I'm not going long here because I have the spinning top. Maybe I should wait for at least, look for lower time frames and look for a better entry, or wait for the price to revisit the trend line and see if I have a good entry at the broken trend line that could continue up. In this case, it didn't happen, but still, it gives you a warning signal. And like I said, we're not going to trade the higher time frames anyway. We're looking for lower time frames, and we'll see that in a few minutes with an example. Euro dollar also. This is from now. This is an updated chart, so you can see here also supply zone from the monthly chart or from the weekly chart. Supply, you can see here distribution, a very strong move down, a very long move down, coming back to the supply zone. This is more of a shooting star candle, and here one or even two spinning top candles right at this supply zone, even another supply zone, a recent one. We can say we have some sort of a supply zone here, something like that. And then the spinning top candles give us a hint of what is to happen, a double top here and a very strong move down. So let's see how we can trade the pattern. So first of all, once you identify this pattern in a high time frame, you don't take the trade there. You don't trade the monthly or the weekly chart. You switch to the lower time frames and start looking for the signals in the lower time frames. That's why I said you have to be patient. You wait patiently for low risk areas to enter, where you can place your stop loss more tightly, where you can take the stop loss or set the stop loss without violating any risk management rules, without risking too much of your account, and without placing the stop loss too far away or too close, just because the risk is too big. Of course, the spinning top candle gives you direction. Okay, if it's at the end of a long run up or in a supply zone, then you're looking to go short, to go to sell. If it's at the end of a very long move down or in a demand zone, you're going to look for entries to buy. So this is the direction. And then you set your stop loss in the lower time frames. It can be an hourly time frame, a 4-hour time frame, or even daily time frame for those of you who trade longer time frames. But your take profit can be even longer because we are talking about long moves. And if you have patience, then while your stop loss is relatively short, relatively small, your take profit can be much longer, which gives you a great risk reward ratio. As for fundamentals, I usually trade the technical charts, but if we are talking about fundamentals, then yeah, everyone knew that inflation was very strong. We saw the PPI, the purchase or production price index, and how everything, like the manufacturing prices are going up, inflation is going up. Obviously, the Fed cannot ignore the rising inflation for much longer, and people are expecting that either QE or the purchasing program will start being tapered at a certain point, or even interest rates rising, and then the dollar will go up. So you can look at the fundamentals, and you can see that the euro dollar is within a supply zone, that the pound dollar is in a supply zone, that the Aussie dollar has been moving sideways inside a supply zone on the monthly chart. So you can add the fundamentals to the technicals. And I agree that you can also look for divergences even on the higher time frames and definitely on the shorter time frames. So pound dollar, the daily chart, here you can see, okay, again, the weekly chart is this chart, okay? We saw the weekly chart of the British pound versus the US dollar. This is the very big supply zone. And now we can see this is where we're at on the weekly chart, and this is the daily chart. I can tell you that I've been tracking several traders of the 5ers, and they weren't patient, unfortunately, and they were trying to go long and short on the pound dollar, even though it's been going sideways for about 3 weeks. And unfortunately, people were losing money just because they didn't wait patiently for the price to show some decision rather than just moving sideways. And well, at least one of the traders that unfortunately was losing money, sometimes making money, sometimes losing money. Finally, the pound broke down, and the this trader made a lot of money. Currently, this trader has on both accounts a profit of about I think $10,000 or $11,000 on each of his accounts just from the pound dollar, which is very, very nice. Yeah, he opened a position of 6.7 lots on the pound dollar on each account, and the accounts now have a floating equity of around $10,000 on the pound dollar. But unfortunately, he was losing money all the way, well, sometimes making, sometimes losing, just because this pound was moving sideways, and it could have been avoided, or at least managed better. And what we see here in the dashed rectangle is the doji itself. This doji candle, the weekly candle, this is how it looks on the daily charts. It goes up, up and down, up and down, up. Eventually, it closes as a spinning, as a spinning top candle, not a doji, a spinning top candle. And now we go down to the 4-hour chart. Again, this rectangle is how the spinning top candle looks in a lower time frames. You see the indecision, but once this is complete, once this spinning top candle has been formed, and you say, okay, I have a long move up, I'm inside the supply zone, I have a spinning top candle, I should start looking for a short position. Now maybe you can start looking for short, but where are you going to look for a short position or short entry? You're not going to look for a short entry inside a demand zone. You're not going to look for a short entry somewhere in the middle. Look and wait for places where you can have higher chances of success. For example, at the top, okay, you have here sellers coming around here. You have sellers coming around here, coming around here. Here, very strong engulfing candle. So sellers are waiting around this area of around 142, 140, 190. This is the zone where you can start looking to go short. If you want to wait a little bit longer, then wait for the price to start moving down. It has demand here, okay, the demand from this area, the blue line below the demand zone is this blue line is the weekly demand zone. Okay, so we have a weekly demand zone, we have a daily or a 4-hour demand zone. So if you feel uncomfortable taking short just above the demand zone, wait for it to break. It broke, it retested again, and now it gives you an opportunity to go short. Okay, and it went even lower after taking this screenshot earlier today. So this is the 4-hour chart, which is obviously a much lower time frame than the weekly chart. Already a good place to enter, and you can go down to the hourly chart. So you have the resistance area, you have supply zone around here, you have supply zone here, you have even a lower, you have resistance here, you have supply, so you have plenty of places to go short. Here, actually, I wouldn't go short because it's right above the demand zone. Okay, but once the demand zone is broken and consumed and the price is retesting, this is a classic place with a very small risk, but look at the reward, the potential reward. So this is amazing, and you have the hint coming here after breaking or consuming this demand zone. So this is what I mean by looking for the opportunities and waiting patiently. Okay, again, the doji, the spinning top candle, you see the edge of the spinning top candle here, this red rectangle, this is the end. This is on the hourly chart. Okay, this is the 4-hour chart. This is where the spinning top candle was formed. This is the daily chart, and this is the weekly chart. This is the spinning top candle. So after it's been formed, we have 1 and 2 weeks, almost 2 full weeks, or to really give you a very nice profit. But even after, even right after the candle has been formed, you already have opportunities to go short. If you go short here, remember the price doesn't move immediately. So, if you take short here and the price goes all the way down and all the way up, it can be very frustrating. So remember that the price, especially coming from big time frames, from big demand zones or supply zones on higher time frames, it takes time for the price to move. It's a big ship. Okay, the weekly, the monthly chart, it doesn't turn around immediately. So give it time. And if you already have some profit, don't hesitate to take it. Okay, start with like starter positions, take profits on the way until eventually it gives you the the long-awaited move. And as for 1 million account traders, no, we unfortunately still don't have 1 million account traders, but some are showing very, very nice trading skills, and I hope we will have someone trading a 1 million account in the coming months. In this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. Definitely not 10 times out of 10, unless maybe you're using a martingale. But in this case, eventually you could blow up your account. So, so really don't expect to be right all the time. Take your losses when they come, and take your profits, of course, when they come. Think on a series of trades basis. Don't forget, and I will, Pascalis, I will answer that shortly. Don't forget, always use a stop loss. Okay, use the technical levels, see where the price has support or resistance or supply and demand, and set the stop loss beyond these levels. Be sure to be comfortable with the risk. If you don't feel comfortable with the risk when you open the trade, don't open the trade or close it immediately, because if you're not comfortable with the risk, you'll start and the market moves against you, you'll start doing things that are bad for your account. You will remove the stop loss, you will move the stop loss eventually, and I'm talking from bitter experience, you will eventually lose a lot more than you've planned to lose or wanted to lose. So, so just be comfortable with the risk. Comfortable enough so you can sleep tight at night, or that you can turn off your computer and not watch the chart. This is what I mean when by comfortable. That you don't care if the market hits your stop loss, you're good, whatever happens. Remember to think on a series of trades basis. Don't think that each and every trade is the most important trade, because like I said, or like Peter Lynch said, 6 out of 10 times is good enough. Remember to look left, look for the supply and demand zones, look for where the buyers and sellers are waiting. This is your edge. The price is everything. It tells you where to look for long or short. Be patient. Don't chase the market. There are always opportunities. Just wait for these opportunities. And if you have a spinning top on your weekly or monthly chart, be patient. Let it, evolve. Let the price on the lower time frames give you the signals. I've just shown you on the pound dollar from this week how you had plenty of places to go in. When you leave trades overnight or over the weekend, take into account that everything can happen. So again, if you're not comfortable with the risk, just close the trade so you can sleep tight or enjoy your weekend. Use a trading journal, aim to improve, to become consistent. Don't try to become rich immediately. It doesn't work this way. and focus on the process, the money will follow. Let me just stop sharing and share the live chart so I can maybe reply, give you some answers. So let me share the chart. And of course, if you have any other questions, feel free to ask. So basically, a question about the pound dollar, if it's still good to enter short. So again, if you're looking to enter short on the pound dollar, look for places where you can enter safely. For example, you have here a temporary supply zone. So wait for the chart to, or for the price to come back to this zone. Okay, you have supply, or you have even another supply here, or if the price comes even higher, you can look for places like this. So it's always definitely possible for the price to continue down. And like I said, the this is a weekly chart. So, and we might see here a double top. So it can definitely go all the way down to this area first. Okay, we have here the first demand on the weekly chart, and we have another demand here. Okay, here on the weekly chart as well. So we have two very adjacent demands. So it can go, from 139.50 or so to it can go down at least maybe 100 more pips. But don't just enter here. Okay, look for entry places like intermediate demand or supply zones. This is a nice place maybe to take after a temporary support, and then a strong move. So maybe this is a potential resistance. If you're using moving averages, then you can see how the 9 EMA served as a moving average dynamic resistance. If the price comes back up here, you have the 21 or the 20 moving average that can serve as resistance in addition to this area. So this is a pullback towards here can be an interesting entry point again, but wait for the price to stop here. Don't just enter, because it could move a little bit higher and just take your stop out or your stop loss. But basically, yeah, the pound dollar could move even much lower, especially if it's a double top, but obviously not immediately. By the way, you can see here that the 20 EMA or 21 EMA, which is sort of, let's just clear these. You can see a very nice area around here. This is a nice area. You have resistance, you have support, you have potential support from this 21 EMA around here, which is also, like I mentioned, demand. So this is a first place or an initial target for short. And this is an initial target maybe, or a nice place maybe to look for long. How much do I risk per trade? People normally say 1 to 2%, but I watch these financial movies. They usually make. So when you watch. Yeah, so usually I don't think risking more than 1% per trade from your entire portfolio is smart. I think it's 1% is already a lot. But yeah, 1 to 2%, so that even if you lose, let's say, 5 trades in a row, which is definitely possible, you don't lose more than 5 to 10% of your portfolio. You still have plenty of money to continue without affecting your psychology. you try to risk 0.2% per trade and 0.5 when very confident. Lately been trying to flip accounts. That's always okay. Yeah, Chris, so definitely learning from your mistake is smart, but sounds like you know how to manage your risk. And again, don't haste, don't try to make a killing out of 1 or 2 trades. Maybe you can do it once or twice. In the long run, it doesn't work this way, and your goal is to become consistent so that you can really survive in this market for a long time and know how to make money in this market over and over again, and not just, you know, once or twice. If I can suggest a trading journal, well, actually, a very nice trading journal, which is not for free, but it's not too expensive, and it's just a one-time payment, I think, of around 100 or 100 something dollars, is the Edgewonk trading journal by Trade Society or something like that, Edgewonk. So that's a nice trading journal with lots of features, and it can show you like your psychology progress and things like that. Yeah, and let me just write it down for you. So the name is Edgewonk, something like that, or Edgewonk. Yeah, so I think, well, yeah, just look for Edgewonk. If I'm not mistaken, this is the how you spell it. Yeah, great. So basically, this is it. Thank you very much for attending. And again, trade patiently, trade well, manage your risk. Always, you have plenty of opportunities, plenty of trading methods, but your edge is your mentality, and you should really just be patient and focus on the process, not on the money. Pascalis, you would like to ask how often you can expect a reliable setup in the majors and crosses. When you're talking about, but a setup according to what? According to the spinning top, because spinning top doesn't appear too often. So, and again, it depends where you see the spinning top. If it's on the weekly chart, then obviously not sure you will see it every month or so. On the daily chart, maybe you can see it, and on the on lower time frames, obviously you can see it much more frequently. As for other setups, I mean, you have other great setups all the time. I gave a webinar like a month ago on you know, setups with supply and demand and with moving averages that appears all the time on all time frames. But yeah, spinning top is relatively rare. It doesn't happen a lot, but when it happens, it gives you, you know, it gives you great opportunities to ride the market. All right, guys, thank you very much. Trade well. May the God of Pips be with you. And I'm happy you learn from these streams, from these webinars. So good luck to all of you. Thank you for joining me today. And you're always welcome to try the free program, the summer plan, and, you know, see how you're doing with this challenge. So this webinar will go live, will go on online on our YouTube channel, and glad to hear you passed one, Lucien. So yeah, see you next time. Thank you very much, guys. Take care. Good luck.
Okay, good day everyone. This is Gil, and today we're having a public webinar um, about one of the things that is less spoken, but if you on the verge for or aiming for being a professional trader, you should be considered. We are trading not just for fun. We want to make it to be a profession, and for that we need to adopt all sorts of skills and concepts that will help us overcome the unique features of what it is being a professional trader. So this webinar is all about these aspects, and it's based on my years of experience and the things that I've been um, learning throughout my course of being a trader, and through my course of educating traders along the years. I've collected a lot of insights that I gained for myself, and I was trying um, to create um, ways to deal with the unique challenges that trading is facing. So let's just start with this, and we'll see where we're going. Feel free to ask questions, and let's move on. Okay, so what is the attitude that we need to for becoming a good trader? What is it that we need to embrace in our thoughts, to change the way that we think in order to be a professional, successful trader? One thing is the things that we're going to discuss today is what is a professional trader and what are the unique features of um, this profession. I will talk about some paradox that are in the profession and some similarities to different professions, and and uh, I will try to map out things that we need to consider in the way that we develop ourselves as professional traders. And as much as we can reach out and the insights that we can collect and find solution for all these features that will help us to grow into for being a good and professional traders. So let's start by simulating what it is, what it takes to be Leonardo Messi, what it takes to be Jimmy, what it takes to be Serena Williams. You know, all these professional athletes that we're seeing, they are just um, exploding on the courts, and they are highly professional, but we have something in common with them. The thing that is common with you and Serena and Jimmy and Leo is that when you are trading on a real life trading account, you are trading the major league. You are competing, Serena Williams. You are playing guitar with Jimi Hendrix, and you need to be at least as good as him in order to have the audience listening to you. You need to be as good as Leo Messi in order to take money from the same court that he's playing against you. So just imagine, and this is something that I say maybe to scare or to shock you, but this is how serious this business is. When you put your first real dollar in the market, you are playing the major league. You are playing the Premier League, and that only. There's only one league in the market. You don't have little league. You don't have amateur leagues. You have to excel on this major professional league from your very first dollar in the market. So just mind who are the players you're playing against, okay? And you cannot afford yourself to be an amateur because they will eat you alive. They will play tricks that works for years, for decades. The same tricks are being played on amateurs and they're taking their money all of the time. There's only one league you can join when you put your dollars in. This is what makes it different from almost any other profession. If you think of maybe, let's say, open a restaurant, you can be an average restaurant with good location and you'll have business and you can make a living. But in trading, you have to compete Serena Williams, right? You have to compete Leo Messi in order to make money on the market. There's only one league, okay? I hope you get my point. So the things that are challenging us in the things that are challenging us in this profession are things that we need to resolve. And if we resolve them, then we will have the edge for succeeding. And one thing that puts a lot of people in stress is that is the definition of what is success. And if we are stick to this example of professional high-end athletes or very highly skilled guitar player like Mark Knopfler, David Gilmour, Jimi Hendrix, just name it. They are all being on the stage and we love what they're doing and we're just being so impressed with how professional they are. But just remember how many years are invested in practice, in exploring, and in try and error. All these things are mostly not available for us when we are being entertained by their master's skills. So in order for us to develop ourselves to be at that top level, it takes a lot of learning and self-development for us to do before we can actually being on that professional court. So I was mapping a little bit of things parameters that I think that if we resolve them, if we understand and if we acknowledge them as our challenges and if we can resolve them, then we can start building step by step a success path toward absolute success. And one thing that I think that is the most insightful thing that I can tell you today is that when you define success, you should define it not just by a binary way, just let's say I'm earning money on the market or I'm losing money on the market. Success should have more shades to it. It really depends on what stage you are at the moment. Let's say you are now a losing trader. Your next goal, your next success will be to be a break-even trader. Okay, if you are a break-even trader, your next goal will be to be a profitable trader. When you are a profitable trader, your next goal, your next success will be to gain more pips, more money than pips. Okay, because you know there are some ways that you can just compensate for losing pips, but still winning money. So maybe your trading is not that efficient. You can be more efficient even when you're making money. So there's always a new horizon that is expanded from the hill that you're standing on. And these are should be your shades of success. It's not just about making money or not. It's about progression. It's about what is the thing that you need to work on in order to achieve the ultimate success that will come within a few years. And there is this saying that there's this rule of 10,000 hours. If you invest 10,000 hours of something, then you become a master of it. I think in trading, it's sometimes works and sometimes it don't, because it really depends on your personality and on the way that you perceive success and fail, and how stubborn you are, and how and if you were taking the good path. I can tell you that from my experience at the beginning, I had today I know, but back then I didn't know. I had at first um, not so good teachers that taught me the basics that I needed, and they were teaching me the wrong things. I don't know if these are the wrong things, but they were wrong for me until I've found the thing that made me successful. It took me a few years to find that. So that was my goal. So for my success at the beginning should have been not making money, but finding the right strategy or the right method that it makes sense to me and that I can work with, and be creative and adaptive to whatever the market is challenging me with. So until then, it took me about 4 to 5 years to find the right thing that actually made sense for me. And then I needed another year or two to master this. And then, so just imagine and just plot this to yourself. There are many shades of success, and this is something that we're trying to do also in the 5ers. We're trying to define success with different shades. It's not just about if you make the challenge for the first time. This is why we're very tolerant and letting people competing once or twice or even a few times until they make it to PM, and then they make it to PM 1, 2, 3, and so on. It's because it's all about progression. We are humans, we are gaining skills, and this is the very essence of how we should consider ourselves as traders. Trading is not technical task. If you do this and that, you'll have success. It's not working like that. It's a skill. We all have the information. We all have the teachers that will teach us how to play tennis, how to play soccer. We all have the courts. We have available all these. We all can put our hands on a guitar, but we cannot play like Jimmy unless we've put the hours, we put the knowledge, we've learned everything, we have the right insights, we progress step by step. So same thing with trading. Trading is a performance skill profession. It's not about doing the right thing. You can do the same thing, the same algorithm, but it's not work. If you're not adaptive enough for things that are changing, you're not going to make it. If we both enter the market at the same price, and I'm greedy and I'll wait for a bigger wave, and you'll take your profit half of what I did, I can just close my trade at break even or hit my stop loss because the market didn't hit my target, but it hit yours. So you're a winner, I'm a loser, and we both enter the same price, the same direction, the same asset, right? So it's all about your patience, your humbleness, your awareness, about knowing what are your limits, what are your strengths. All of these elements should be learned by yourself, and that will configure the way that you actually embrace success in trading. So let's start by, I've been mapping a few elements of what it is to be trading, and this is only my opinion. Maybe just let's move on through this, and think you'll get the concept, and you can add your own and try to analyze and how you bring more ideas to this, and try to resolve this with your own self. And okay, so first, the market puts you in an environment that has a lot of uncertainty. So to deal with uncertainty, you have first to be humble. What it means to be humble? It means that you don't say to yourself, I know where the market is going to. I'm not about trading is not about predicting. You know, we are sometimes associating with I think they call daily FX. They are very big and considerably one of the leaders media for our industry. And they were asking me before the beginning of 2021 to give them predictions of where will be the euro dollar, where will be the pound dollar within these quarters, and they asked me to specify rates for where the cable will be at the end of the third quarter of 2021. I told them that I'm not participating in this. I'm not about predicting. I think trading is playing tactics, is playing what you see, is playing about is looking at what you have and looking what the charts are telling you and playing upon this. I don't know what's going on. I don't know where it's going to be because of many things. We'll cover this in just a few, but we have to be humble. We have to admit that we don't know nothing. We can only play about what we're doing, and we cannot be arrogant and saying that we can predict and stick to that position because we're thinking that the price must go in our direction. The price won't listen to us. The only thing that we can do is play tactics. And what is playing tactics? It's like when you're riding waves on the sea, you don't say, I know where the waves will be and where it's going to break. Every milliseconds that you are on that wave, it's decision making and acting with the situation that the ocean gives you. And if you're talented enough and skillful enough and experienced enough, you will know how to ride that wave all the way through. And if you're not, the wave will take you halfway. You won't get to enjoy the pipe. You know, all these things that are the positions of the skillful and the people that we're very jealous of. So we can only play on what we're seeing. And one way to resolve this uncertainty thing is to have a scenarios action plan. I think I've covered this about 2 or 3 years ago in a webinar. I think it's part 4 on the first webinar series we've done with investing.com about supply and demand. And we've described how we can have our trade and still get into our trade and still be very attentive to what's going on instead of just entering the market and just waiting for the market to resolve our trade to a win or to a loss. Because when we decide to enter, many things can happen. You know, the market can jump away from you toward your winning side. It can chop you always around the break even. Sometimes you're on a little plus, sometimes you're a little minus for very long time, and then it wear you out. You'll be tired. You'll take yourself out on a break even, and then price spring to your direction. So you were right, but you're not in the trade anymore. You know, all these things can happen if you learn about all the scenarios that you have experienced, and you write them down, and you say, okay, if I enter the market and the market do this and that for me, I will do 1, 2, 3. I will have scenarios and action plan. So when the market puts me through a certain scenario, I will have a ready-made scenario, a plan to act upon. Okay, so and maybe not all of the time, and for certainty, it's not going to be all of the time that your action plan will work, but it's a plan. And if you stick to the plan, and you know the plan is right because you've studied it and because you've back tested it, you should have the odds to win it by the statistics, right? So if you map your scenarios according to your understanding of what the market is doing, and then that's one resolution of how to deal with uncertainty. We've covered this. We're playing the Premier League, and there's only one league. So what it means for us to resolve is that we really have to have a plan. We have to have a trading plan. We have to know how to find the best trades. We have to know how to not taking bad trades. Even if these trades turn out to be good, we should not be dazzled by this or by the result, because if we have a profile of what is a good trade, because we have reasoned this profile by backtesting, the market is always going to confuse us with bad entries that work and good entries that won't work, because taking losses is part of the game. Taking losses is part of playing statistics with the market, because this is only the only tool that we have. We play statistics. So this is why we really have to stick to the entry and take only entries where we know that we have a very good probability, or maybe the best probability to take them, unless, I mean, this is my way of doing things, unless your probability is taking a lot of trades, and then few of these trades will work wonderfully, and you know how to make the extra, the premium from that way of trading. So I'm not very good in managing a lot of information in front of me. It's get me confused. So I prefer to cherry pick my trades, and I think with my method, I have enough opportunities for the time scale that I'm working on. So I find my comfort zone on that. But if you think that you want to experience and enter the market many times until you find your bonanza, that's good too. But that will be your way of finding your high profile trade. Okay, and you should know that that should work for you. But whatever strategy that you have for your entry, you have to have a good and solid and non-negotiable loss strategy. You should take losses with pride, and I think I've taught this also in my webinars that if you are having hard time taking losses, try to train yourself that every time you take a loss that was pre-planned or it's within the parameter of the loss that you are planning to, meaning let's say you're risking only 0.5% of the account, and you've taken that 0.5% and you never shift that stop loss against your agenda, and you've taken that loss, go to the mirror and celebrate with a big smile because you've done the right thing. So every time you take a loss that it is within your parameter, it's not a fail, okay? Because the market is not predictable. So, and we're playing risk management. So you were doing a great job by taking the loss that you were pre-planning, okay? And if it's a reasoned one, and if you know why you've taken it and why you've placed that stop there, and it makes sense to your trading plan, then you should go and celebrate a loss. Train yourself to love and respect the losses that you're taking, because taking losses is a very, very hard job. It's practically, and we'll cover this in 2 topics away, it's practically a counterintuitive challenge that is unique to the market, and we'll talk about this in just 2 topics away. Next thing is that you need to be very adaptive. You know, you're playing the pros when you're on that court, and they have a lot of tools that you don't have. We'll discuss this in a second as well. But just know, be very much aware that they have tools that you don't have. And we can only look at the current and the history, and we have no way, no effective action that will actually create an impression on the market, or something that can change something in the market. We can only be responsive with the amount of money that we're trading, most of us, right? Unless we're a big fund where we can just manipulate the market. So we can, they will play a lot of tricks, and sometimes they will be aware of different methods that in the market we are all seeing the same charts, we are all seeing the same news channels, we're all seeing Bloomberg and Reuters and reading the same feed of news, and so they know what the mass of people will think about the information that everybody's seeing, and they will play with it. Sometimes they will let you feel that you're right, so next time they can trick you. Okay, so I'm not trying to scare you, but this is, just imagine that if you had that ability to influence, you would do that too, right? Because it's a game of chess, it's a game of mind. So you really have to be adaptive. Sometimes your system won't work, and you need to figure out why. Maybe it's a higher time frame point of interest for the big players, so that's why it's not working anymore. And then when it's over that zone, it will return to act normal in the terms of your strategy, and maybe not. So you really have to be adaptive. This is why robots and EAs won't work for very long, because the market is ever changing, and every time market is reaching to an interest point, different tricks are being played. And so there's nothing to compare with the human mind or the human way of processing information faster and more efficient and more creative and more understanding than just the human brain. So we've just mentioned this. The market put us through an ever-changing condition, and we really have to manage this. So in one way, we can not always spot the right moment where the market is changing. So this is why we really have to have a very solid risk management. We should enter every trade and consider the worst can happen. The black swan will happen against our position the very next second after we've entered. How are we going to protect ourselves from devastating months or weeks or days or money of effort that we've put through? We cannot allow ourselves to invest many years and then lose everything on one trade just because we were not wearing a seatbelt. So a seatbelt is a stop loss, and lucky for us on the Forex market, stop loss is mostly respected around the prices that we've asked, unless there is a major news and there are gaps in the market. But unlike the stocks market and the futures, we have more opportunities to receive the price that we've put for our stocks than than from other markets. So just use it. And even if you say, I'm using hidden stop loss, I'm using conditional stop loss, do use a hard stop loss at a catastrophic level, way beyond where your logic would be taking you out, where you should be, because sometimes the market will be so much faster than you can operate, and so you have to have that another tire of risk management. Every time you enter the market, it's in terms of position size. Don't trade too much, be humble, take it step by step, the turtle way to grow your account, and don't be greedy. And also in terms of stop, put your catastrophic stop way beyond and let your mental stop loss or your algorithmic stop loss work for you, but do have that extra measure of risk management. And then you should have the action plan. The action plan is something we're trying to promote and educate quite a lot here with the 5ers. If you know about our risk management booklet that we've sent to all our traders last month. If you didn't, you can go and you can have your own copy of this. We send it to your home. It's actually a physical booklet with a lot of instructions where you actually being dictated how to write your own trading agenda and plan, and it will challenge you to really deep think about your strategy. And then it has a lot of logging papers where you can just learn and analyze and summarize your activity throughout the time. And that is we got a lot of great great reviews about this booklet, and people were very happy and find it very efficient for their their daily routine. And if you want to get it, just sign up for Saul um, risk management course. And if you complete this, then you can sign up and we will send you that booklet. So it's really valuable. So you should have a very solid action plan where you think of all the different elements and you become aware of things, and then and if you write down your manifest of how you're trading, this is actually become the policy of your business. Just imagine that every business has its own routine, its own way of doing things. It's knowing the system, how it works for them. Just compare this to any type of business. They have policy of how they do things, and so do you. And unfortunately, not many traders do that because it's a one person business. So you don't have to report to anyone. And so you don't have that conversation that actually brings new ideas and ignite new ideas or challenge your thoughts, sometimes for the better, sometimes for the worse. But you don't have that um, um, environment where you can learn from the experience, or you can refine your experience by explaining to the less experienced people. You don't have that thing that um, an office have, because you're working just for yourself. So working on your paper and being interviewed by a paper like we've done, but you can also look up in the internet all these templates for the trading plan. That will make you smarter and more solid and more defined with your action plan. Next thing is you really need to learn new tricks. You should know what tricks are being played on the markets that you are mastering, and you should learn new tricks yourself, how to actually take advantage of what you're knowing. So always be on the side that learn new things, explore them, but there's a downside for this. Try not to get confused with this. Okay, don't try to take new ideas straight away into the real market situation. Try to demo test this, try to combine this slowly. If you have new things, and even if you're really trusting them, start slow, start with very low positions, so you just can sense how it works for you, how it makes sense, because only when you're live with these ideas, you will understand what it really means. So you really need always to reinvent yourself, learn new tricks, learn new stuff, more methods, more tools to collect to your toolbox. One thing a lot of people are doing wrong is that they are putting their trust and their money on logics that they were never trying themselves. And I'm speaking of downloading all these indicators that give you signals, or EAs that you don't know really who had coded this. And even if you know the logic or the concept behind this code, you don't know what bugs are in this code and what the true limitations are in it. Don't trust all these things. I know it's a shortcut, and we are all of us are very eager to participate in this exciting market and making money and everything. But be modest, be more slowly with your learning, be more cautious, be less naive with what other people were doing. Just remember that the market is ever changing. A code that was written a year ago is not necessarily going to work good at these days. If you have a code that has too many specification, you know, if it's a 0.1 factor versus 0.2 factor just on the pound Japanese yen, and it won't work on this, this is no good because the pound Japanese yen will change in a week. It will change its behavior and it won't work anymore. So too many people are trusting these shortcuts, and it's just a wrong thing to do. Trust only yourself. Trust only your backtesting and understanding. If you don't know why this strategy work, don't go for it. Just learn and find out what stands behind it. So now let's go back to the counterintuitive. So this is my one of my favorite things that I talk to people that are new to the market, and I'm always surprised that people that are many years in the market are not truly understanding this in full. Just think about how much agony you are experiencing. Each one of you think, if you're 1 year or 5 years or 8 years in the market, I can tell you that I'm in the market since 2006. For me, taking a loss or seeing my trade getting into the stop loss is painful, even today. Okay, cutting loss is a counterintuitive feature of the market. It's so hard to take. I think it's one of the hardest things to that this profession puts you through. And I tell you why. Because from the very early age, we are being educated to be like Serena Williams, to be like Roger Federer, to be as good as possible. We are put into a symmetric court where we both have the same conditions, let's say on basketball. And if the team against us are winning, what are we going to do? Are we going to surrender and tell them, okay, take the game. We still have like 15 minutes of for the game, but I know you're going to win, so I give up? No, the coach will tell us fight, 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 right? So this is how we are trained. If we are seeing a loss, we are trained not to give up. But in the market, it's really the other way. If the trade goes against us, it will be very hard for us to take a different mental approach and say, okay, I'm losing that trade and I need to give up. I need to cut this loss now. Why? Because I will do after the entry analysis, and I will see as much as possible, as much as clear, as much as non-conditional, and it's very hard to do so, that the trade is going against me and I really have to cut this loss. And there's another thing, that there is no coach or crowd or my father on the sideline that will tell me, cut this loss. Okay, I have to take that decision myself against the way that I was trained and cultured since I'm a child. We are being taught to fight all the way to the end, but it's not true for trading the market. if we're seeing the trade is not going our side, and we have the ability to cut all our emotions and do new analysis and see, well, this trade won't last. We have no control over what the market will do. But if we have all indicators telling us that it's going the wrong way, most people will ignore these flags and signs and alerts, and they will say, okay, I will give it another chance. I will fight for this. I will maybe shift stop loss a little bit lower, so I will let my trade breathe and come back to break even or so. Believe me, I'm doing this mistake every now and then, even today. It's so hard. It's so counterintuitive. I think it's the hardest thing to do. It's to take your own decision against your previous decision for entering, admitting that that the trade won't go and not letting go. It's everything against what we were brought on. So cutting a loss, it's very hard. How we can resolve this, I think we've discussed this before. We really have to train ourselves to respect losses. And if the loss was cut at the right time within our trading plan parameters, we should go to the mirror, smile and celebrate and say, we've done good, because we were protecting our portfolio. It's not about one trade, it's about the whole portfolio. It's about the whole month of hard labor and time and effort and emotions that is put through. And we really have to cut this as soon as possible, as soon as we know that it's going the wrong way. It's really hard, but every time I cut a heavy loss, I just take off this heavy weight from myself and I say, okay, I cannot return this loss, but if I had to suffer this a little longer, that would be even more painful. Now I'm relieved because I can continue doing the things that I'm doing. I can continue working on my well-proven statistical way of trading, because I know I have good risk management. Few of them will lose. It was within my parameters. I'm happy, I'm celebrating, even if it's artificial. I really have to train myself to respect losses, and it's hard. So you should work on this. Fear of missing out is another aspect of a lot of people doing. It will prevent you from being, people are backtesting systems, and when you're backtesting, you would really wait for the signal to blink for you, right? But then on real market situation, if you've seen that signal and you've missed it by a few moments or by a few hours, depends on the time frame that you're working, you would jump on it because you're fearing to miss out. Maybe you get too early, maybe you get too late, but this thing happening all of the time, and that's the difference between backtesting or demo trading and in real trading, because in real trading, we are in the real world. We say, okay, we had this opportunity, we're waiting for it. We spend the time, we spend the thoughts, we did the analysis, we talked about it, reasoned with it. Now we've missed it. I can't afford not to be in that trade. And the worst thing that can happen to you on this is if that works for you, because then you'll do it over and over again. And that's a wrong thing to do, because when you're getting in too early or when you're getting in too late, the drawdown and the risk reward ratio factor will damage you a lot. And also the time spent in drawdown will put you through so much agony, and your margin will be caught by this trade. Everything is wrong about this. Stay away from it. Be aware of it. We're also over competitive. It's part of what I've explained with with the issue of cutting loss. We are trained to be competitive. If something don't work, we try harder, right? The teacher tell us if you're not good in math, try harder, work harder. It's counterintuitive on the market. In the market, you don't need to work harder. You don't need to overtrade. You don't need to spend more time or more effort or work harder. You just need to do the right thing, and the right thing will appear when it's appearing. So you cannot apply over competitiveness on this. You really need to just wait for the next true cherry-picked signal. So you can't be over competitive, but we are. If a daily or a weekly target haven't reached, should we stay more on the screen? Should we enter more reckless trades because we want to achieve that goal? You know, so over competitive is something people are not really aware of, and it's over intuitive. If I work at I don't know, and I try to satisfy my boss, and I'm working and I'm not delivering enough, I will stay over hours to complete the task and make my boss happy, right? This is how all the movies on Hollywood works, right? But it's not right for the market. The market is always giving you the opportunities when it's right. So every time you're out and waiting for your next trade, just wait for the right time where your system blinks for you with the most probability cherry-picked profile. Confidence is also an issue. Overconfidence or lack of confidence. If we have a good strikes, then we're overconfident and we can be reckless. And if we had bad strikes, we can be unconfident, and maybe we won't get into the signals that we're seeing. We should learn how we are actually being affected by this. But this is actually not really counterintuitive to a real life situation, but it is a counterintuitive to what you're feeling. Your feeling telling you that you should be aware next time you enter the market because you're uncomfortable. Your feeling telling you that you have it, and every time you click on the keyboard, you'll have a winner trade. That's what your feeling are going to tell you and signal to you, and that will make you reckless or too much careful for not taking your signals. So, and one of the things that most people are not aware of is the lack of authority. Most of us would come to trading because we want to leave our boss. We want to have our own business. We want to be responsible to our own financial future. And we want to hone that profession ourselves. And that put us into an environment where we are just myself and the computer. And every time I have a question or a doubt, I have actually nobody to talk to. Maybe I do have a mentor, maybe having a good trading pal that I can cooperate this. This is part of the solution. But for the major part, I have to take the decision myself. And the worst thing is that so many times I will do repetitive errors that I might not be aware of that they are errors, because nobody is looking over my shoulder and sharing his experience and saying, you know, that you're doing this over and over, and that puts you through bad results, right? The overcome is because you're doing that and that. This is based on my 20 years of experience. Nobody's telling you that. You have to learn this yourself and find out this yourself. It's really something that it's almost impossible to be aware of something that you're not aware. Because it's a lonely thing, we are trying to educate ourselves, and it's much harder and much longer. And until we get the insight, maybe we gone through a lot of frustrating periods of times until we actually had this ringing bell and understanding what's going wrong. So because of we're working like this in an isolated workspace, our awareness and the blind spots that we are facing are sometimes very, very critical, and we are not very sure about this. To know how to cope with this, we really have to keep ourselves always in learning, always find mentors, always do courses, always learn broader aspects of what you're doing. Don't just spend your time on working on the analysis or working on the strategy or creating tools that help you resolve very specific issues. Learn on the broad aspect of the markets, of psychology, of yourself, even do yoga, do meditation, whatever works for you in order to be more complete and whole when you come and aware of how you feel and what this profession puts you through psychologically and mentally, and how it's actually motivate you or put you through. These things really need to be learned. So always be in learning and expand your awareness to all different aspects, to knowledge, to strategies, to your own psychology, to your own behavior, to your own way of acting. Write a lot. All these things will help you to find out blind spots that you weren't aware of and find good resolutions for them. Because we are retail traders, after all, we're just small insects on this market. We have less access to information like the big players do. I think it's really obvious for me to say this, but it's not just that we don't have the access and the subscriptions to good information. It is that we also are being exposed to too much information, noisy information, and deviated information, that it's really can be a daunting task to filter out and trust that information and what's their interest behind it. So that's one part of it. And the other part of it is that we're just a single person. And just imagine a trader that works on a big fund with another 50 traders, and he comes every morning and he sits on a round table with another 50 traders. Some of them are very, very experienced, and each one of them will say their own view on the market. Each one of them is working on a different aspect of information collecting. The amount of information that you have to reason with your decisions on the market is so much greater than you can have it your own, even if you could have filtered all the noisy and all the deviated information in the market. So just being yourself is puts you in a very, very inferior position of access to information. So my way of doing this is playing statistics, playing probability. I will only enter key levels. I will only learn about the price action signals that tells me, okay, at this key level, I will look for this price action event. And if that works, I will enter, I will take that risk. I mean, having that plan of how to actually being tactic in the market is will help me find my probability environment so I can extract money until I'll be big enough or talented enough to get into that big room with another 50 traders and maybe contribute and get their own contribution for my odds. But until then, I really have to be tactic. And you know, something that I always being opposed is that people calling uh, um, their trading way a strategy. It's not strategy. Most of the trading systems that we are dealing as retail traders are not strategies. They are tactics. Okay, strategy is understanding the bigger picture and try to deploy a plan with different tactics to create the outcome that you want. We are just playing tactics. We just want to enter at price A and exit at price B, and that's it. That's tactic, not strategy. So it's a word too big for what most of us have. So if you want to have a strategy, then strategy is about the brain. It's about analysis. It's about a whole different understanding of what's going on in the market, and then you deploy one tactic action to actually exploit what you understand. Okay, so let's talk about what the big players are having. And again, the answer for this, I'll give you the spoiler. The answer for this is having your very solid trading plan, risk management, and mental awareness. But do know that the market is a serious court. It's where the professionals are playing. You know that the big funds, they are participating in the very same court that you are. And you know that they have a lot of power. What power do they have? They have enough deep pockets to do trial and error or to create impressions in the market. They can invest millions just to make an impression that price is breaking a level, and that will bring so many people buying at higher price, and they will sell them this. Okay, so that's called manipulation. They will invest a lot of money for bringing price just 10 pips or 20 pips high to make an impression of something going on. They will freak out your indicators that will tell you that you have a good momentum to enter, and they will sell on you. This is manipulation that they can trick by injecting a lot of orders into the market, and they have the big enough pockets. And this is strategy, by the way. They invest. They can buy with millions just because they know they're going to sell you in 20 pips distance because their position should be short. And this is why we see so many choppy price action so many times, because these are little manipulation playing out or being tried out by these, and they have a lot of pockets for this. And we are so desperate to win each and every trade of ours. Every time we are missing a trade and it's not working, it's, I mean, it's devastating, right? We just enter one trade, it's not working. We say, okay, we didn't get it. We don't have a good strategy, right? But they are doing this all the time because they are playing with their deep pockets. Another thing is that they have the ability to actually feed the media with deviated information. Let's say Warren Buffett is having a full transparency with his portfolio. Everyone see his portfolio, and so a lot of people are taking his word and say, okay, if Warren Buffett is buying this, I will buy that too. But what is he doing? He already bought this, and he know his name has influence, right? And so if he say that he bought Tesla stock, everyone now will buy because the genius says so, and they are feeding his stock higher, and he can sell now. Okay, so just every time you hear somebody on the news saying something, he got an interest. So it's a tool that only people that have access to the media can deploy, and they are already positioned in a way that once their announcement will come out on the media, they will just take the fruits of it. Okay, so that's a tool. This is what feeds Reuters and Bloomberg and CNN and CNBC Money and all these magazines. They are getting a lot of free items all of the time because these people that feed them information are just biased with their positions already. So sometimes you can ride on this, sometimes it's a trick, sometimes you can earn with it. You would never know. But the thing is, the lesson that I want to learn from it is that because we don't have these tools like they do, we have to be tactics. We have to play tactic, we have to play probability, and that's it. This is the only tool that we have. We cannot predict. We cannot justify our trade because Warren Buffett says so. We cannot justify our trade because somebody said something very, very smart and convincing. Because if it's convincing, it could be also manipulated and biased. And so don't buy any information from anyone because everything is biased. Be tactic, look at what's going on now, act, respect your losses if they come because everything can happen. We know nothing, we're just an insect on this thing and we can only play probability. And I think I've mentioned that we're just one person, we're one-man band that's doing analysis, we're entering the trade, we're managing the trade, we're spending the time, we're doing the monitoring, we're doing everything, and we're collecting information, and we're trying to make decisions. We don't have a boss, we don't have any more experienced people, somebody to teach us or to get us aware of something. All these are going against us. So we really have to be better and better all of the time, continue learning and just be better. So I just remind you that we cannot afford being an amateur because we're playing on one league, which is the Premier League. And if we're getting there not ready, they are going to eat us alive. This is why we really have to be all of the time in control of what we're knowing, not giving out the control to other people that will tell us don't buy information from anyone, even from your friends or from your mentor. If it doesn't make sense to you, if you don't fully understand this, don't do it. Work on it until it sinks, until it makes you, until it really makes good logic for you. And so you understand and you know that you master this. For this, you have to practice and backtest. And this is one thing that athletes do and not, and many traders don't. How many of you are actually practice? You go, you trade live. Some of you are trading with us, with the 5ers, and you trade with us with real money. How many of you at the end of the day or during the weekend will take yourself and practice your trading and refine your trading plan and do all these mental procedures that you need to do? How many of you are doing this? But you can trust Serena Williams that when she's not on the court on a tour, she's lifting weights, she's running, she's working on her shots, she's working on her placement, she's working on tactics, she's working on mentality, she's doing massages and therapy and whatever. She is being prepared for the next time she's going to step on the court. How many of us are actually practicing and not just waking in the morning and playing on the court? Remember, trading is a profession of performance, of skill that is being collected through years and experience, through learning. So we have to practice all of the time. We have to experience and explore more ideas, right? So a good way to practice is to backtest our ideas, is to forensic ideas. We know, you can work only 6 hours a day or 8 hours a day or 4 hours a day. Whatever hours that you're working, you probably missed signals that were at the time that you were doing something else or asleep or partying or whatever. Okay, so do go and backtest all the events that were happening that you weren't there and see how you were reacting. Maybe you can find new scenarios that you can map and create action plans for them. Practice. Maybe you've learned, you've seen something new and you need to and you think it's complementary to what you're doing. Maybe you want to incorporate this sometime soon. Go and practice. You can go and buy a Forex tester and try live testing. You can do it on TradingView. You can do it on MT5 with their back testing thing. Do this occasionally. Go to the gym, go to the trading gym, because this is your profession. Go and practice. And yeah, preparation meeting opportunities is the really phrase I really like. Maybe you hear, I don't know if you brought it yourself or you heard my interview, because it's the quote that I really love. Thank you, Nirmal. Learn new stuff all of the time, because the market is constantly changing. It's constantly creating new forms, new tricks are playing, different incentives and bias, and participants are joining at different times. So everything is changing. Try to develop yourself and be more skillful all of the time, and explore. It's part of learning. Explore. It's learning and practice all together. These all together will bring you the control that you need, at least in our size. So overall, like Serena, like Jimmy, it's working hard, practicing hard, so we can perform in the money time the best way that we do. So we're working hard for making the trading easy. This is this is the essence of the mentality and and the the concept that you need to bring when you are come to trading. So thank you so much for being here. If you have any questions, I'd like to hear. Um, and if not, thank you so much. This yes, this session will be recorded and placed on our YouTube channel, so you can review this later on. But I think it's more conceptual presentation where you just need um, to intrigue you in thinking of trading as something that needs to be very much invested all around on your own qualities and build it around your skill set, and this will also help you find the right attitude for finding your own success, because the way that I find success is not going to be yours. This is why so many people are being disappointed of mentors, because they seeing them success, but we're not, because we're not built the same in our personality. So that's the reason for it. Anyway, I hope you enjoyed this session and it intrigued you to rethink. And I remind you that if you go and do our risk management course on our website, at the end of it, if you finish it, you will be entitled to request the trading plan notebook that will be sent to your house at the end of it. So please do it. It's free for anyone who's within the 5ers. And thank you so much for being here.
Hello traders, a little bit different of a setup today, I know, but it's because I wanted to discuss a bit more serious topics when it comes down to trading. Now, if you haven't been able to tell already, I am a little bit under the weather, so my voice is a little bit deeper and I am lacking a bit of energy, which is actually what led me to coming up with the idea of us having a sit down and discussing the more serious and detrimental part of trading, which a lot of the market out there doesn't assess. What I wanted to talk about today is the inability to find the strategy. Now, a lot of you will probably relate with that, as I did in my starting days as a trader. And this constant hunt for a holy grail strategy is a complete fraud, and it's actually what leads so many traders to fail. So what I'm going to talk about today is what it is, how we can address it, and then how we can move forward knowing that that's an issue, and how we can battle it and become a consistent and profitable trader. I've had I've had the privilege of chatting to so many traders from professional to beginner over my career, and my position at the firm is I deal with traders every single day, traders from all over the world with all types of backgrounds, and they all trade individual strategies, and it is fantastic to see. And what I want to get to is, especially for you beginner traders, is a lot of people focus on finding the right strategy. A lot of the talk we do, a lot of the stuff on YouTube, a lot of stuff on TradingView, the internet, is all about different trading strategies. Now, the issue with that is it leads traders to believe that the answer to all their questions and all the profits is in the strategy, which isn't completely true. While it is important to have a good strategy, it only makes up about 10 to 20% of your whole trader performance. And I'm going to explain exactly what I mean by this and how we can battle it and understand this on a deeper level moving forward with our trading career. We've all had a strategy at some point in which we believe is finally the strategy that is going to make us the money. We believe that we finally found that super hole we've been looking for. It feels right. It feels good. It makes us a bit of profit. We get overconfident. We run in. We take prop firm challenges. We look to increase our amount of money. And then we hit the first drawdown that strategy delivers. And we get angry. We get frustrated. We think this is a load of baloney. And we start looking elsewhere for more education because we believe we didn't understand what happened. This right here is a common cycle in the market and something I've seen and been a part of for quite some time. I was stuck in that cycle. I would pay someone to teach me how to trade their strategy. I would take parts of their strategy, make a new one, half-ass the back testing, believe it showed good results, trade it live forward testing, achieve good results, get overconfident, fall into a drawdown, throw out the strategy, start again. And this is a common theme with a whole range of traders out there. And I see it still to this day with traders getting stuck in this pattern. I can tell you now with so much confidence, there is no one strategy out there that is going to fit you perfectly to exactly what you want. Trying to understand this market in a way that you want it to act and a way that you want it to make money, very difficult to do. You can hunt for years and years and you still may come up unsuccessful with what you're looking for. The issue with everyone bouncing is they're never trading their own strategy. They're never trading a strategy they came up with, that they tested and understand and then trade. They're always looking for what that professional's doing or what that professional's doing or what this educator's doing. And the issue with that is you never come to full term and synchronization with your strategy. And that's one of the topics I wanted to touch on today, and something that you definitely need to work on if this is relating with you. When you find a strategy, whether it be the one the educators provided, whether it will be a wherever it may have come from, maybe something you made yourself, we're going to have to sit down for hours and hours on end, back testing and fully understanding that strategy. Now, I don't mean going on one chart and back testing for the past 6 months, taking that data and assuming that that is something to go off. I mean, let's sit down for hours of testing, days, weeks, whatever it may take, and fully understand what drawdowns we could see, what profits it can make, what's its Kalma ratio, performance factor. If you're at the 5%ers, these different little hints that we can give you on what firms look for when it comes to good traders. And once we fully understand the strategy and we know it is a profitable strategy, once you've sat through that hard work, you'll start noticing that you don't care what that educator's doing or what that strategy is, or you stop looking outwards because you know you have a golden strategy and you start looking inwards. And the moment in trading you start looking inwards for self-improvement, that is when you start making progress as a trader. Everyone, if you have a job, okay, and you have some type of work, whether you work in retail, maybe you work in finance, maybe you work in business, whatever it might be, there's always some aspect of your job that you don't really like doing. Realistically, it's a bit time consuming, you don't enjoy it, but you still get it done. And you still get it done properly. Why? You get it done because in order to complete the project that you're working on, it needs to be done. In order to get that project successful as a whole, that work needs to be done. Same goes with trading. In order to get your system complete and to help you as a trader improve, the work needs to be done. The work that you don't want to do has to be done. And that comes to understanding and becoming synchronized with your strategy. It doesn't have to be complex. It doesn't have to be a out-of-the-box crazy strategy. It could be something as simple as moving average crossovers. I don't like the idea, I don't like the concept, but I've seen traders be extremely successful off of that idea. It doesn't take a lot of work in building a successful strategy. Anything can work if the trader knows its boundaries and knows how to trade it. The only difference factor in all of these strategies is who's trading it. If you can get you to the point you can trade a strategy successfully, whether that strategy is good or bad, you will see profits. Because then you will actively be able to analyze different strategies and know which ones will bring you profit to the point that it will only make 10% of your gain, and you know the rest of your game is built up on what decisions you make and how you make those decisions. It is paramount that you understand synchronization with your strategy. Don't look for the next educator. Don't look for the next guy saying he's making $6,000 a day. It doesn't matter. It doesn't matter what everyone else is doing. Let's look to improve you. Let's get you to that next step. Stop looking outwards, start looking inwards. And once you've fully and done the homework and fully comprehend what trading strategy you are doing, as simple as it may be, pick one, just pick one and do some hard work on it. You'll be able to turn a profit. Then you can start reading your emotions in trading, understand the market on a deeper concept. If you understand what drawdowns your strategy can bring, the next time you go into a little drawdown, you're not going to be able to panic. Why? Because you understand you've accepted that risk in bringing it in, and you've changed your risk levels to coincide with that possible drawdown. It's a very simple concept when you talk about it like this, but something a lot of people need to hear. And that's why I wanted to talk about it today. That's just a small topic on this. And with that, I want to leave you a challenge. I want to challenge you to do that. Pick a strategy. I don't care what it is. Make it up yourself. I don't care if it works. I don't care if it doesn't. I want you to pick a strategy and do some serious, thorough work. Spend a week, 8 hours a day, a week testing it. If you can't find enough time to fill 8 hours a day for a week testing the strategy, you're not doing it right. There's always more data. There's always more testing. I challenge you. Sit down. I understand some of you won't be able to do that type of time. Extend it. Do 2 hours a day for 2 weeks, 3 weeks, 4 weeks, whatever it might be. I challenge you to do it. And your eyes will open, not only because you'll get used to doing the nitty-gritty part of trading, the hard work, but also because you'll get a better understanding of the strategy you're trading. And if you have a better understanding of the strategy you're trading, you will understand how to trade it properly. Then you'll know when mistakes happen, where the mistakes come. Is it part of the trading strategy that you didn't understand, which usually you are to blame because it's an outside factor? Or did you make a bad decision? Were your emotions at fault? Once you have all this data and this understanding, you can progress yourself further. The more data we have, and I tell traders every single day, in every aspect, trading journals, emotions, life in general, the more data we have, the better educated decisions we can make. The same with trading. You use indicators, you use the chart patterns, you trade technical analysis. The more data you have on that technical analysis chart, in those candlesticks with the volume, the better educated decision you can make. It is the same thing with all concepts of life. Get more data about yourself, about your trading strategy, about everything in that market. The more data you have, the better the educated decision. So the challenge I set you is that. Go away, spend some time seriously testing your strategy that you're currently trading. One, you stopped trading 6 months ago because you thought it was a load of shit. Whatever it might be, find it, learn it, backtest it. Thoroughly backtest it. Not like backtest a couple trades, yeah, it worked. I want to see journals on journals of data backtesting. Like someone's going to give you $1 million if you get it right. Because if you do get it right, it opens that door for you to make $1 million. This is some of the hard work that I see the difference between our successful traders and our non-successful traders. The people who are willing to sit down and do the serious hard work when it comes down to trading are the ones that take it to that next level. Because when I sit down and do a portfolio analyst meeting with them, and I go, okay, what's the issue? What do we want? They don't even start to blame. Oh, I just misunderstood this concept of supply. I missed the support resistance there. It wasn't part of their strategy. They sit down and they go, I entered this trade when my strategy was telling me not to. Why did I do that? And then we can sit down and we can go, okay, you had a fear of missing out. This is how we're going to battle a fear of missing out. Is there something else? You know, there's a whole range of different ways of battling those emotions, but they came with clarity and they understood their strategy so in depth that their strategy works long term. So that's not the issue. They knew the issue was within and they wanted some help to find that issue within. And that is something I guarantee is an amazing feeling when traders come forward, not just for myself, but also for them, because we can sit down and we can discuss that and we can battle those bridges, not just in trading, but also in life. It's sometimes they might feel FOMO, they might feel guilt, anger, whatever it might be they feel in life. We can battle those together because it does relate into trading. A lot of becoming a successful trader, all of the work, almost all of the work is in here and up here. The strategy is a very small, very, very, very small addition. Okay. Stop hunting for the next strategy. Stop hunting for the next educator, the next golden bridge, whatever you want to call it, that's going to make you millions of dollars. It's not out there. It's not out there. Just find one that's consistent. And I guarantee some of the strategies you traded over the past 2 years, they've been pretty damn good strategies. And they probably are consistent enough to make you a lot of money. The only moving factor was your decision making. And it's time to address whether the strategy is the issue. And there's only one way to find out, is by putting the work in to find out. No more jumping. Listen to the challenge, do the challenge. I look forward to hearing your feedback. If we get enough likes and enough comments on this video, I will do a follow-on and a bit more in depth on how we can battle this feeling and how we can get out of that beginner loop of just looking for the next holy grail strategy. Because I've been there and I got out. And I talk to people every day who have also been there and have also gotten out. Guys, I hope you enjoyed this video today. It's been a little bit different. It's been a little bit more personal, but I think it's a topic we needed to address. And it's something I wanted to talk about with you guys because I've noticed it with a lot of you guys. If you have any questions, the comment section's right there. There may be someone who's too shy to ask that question, so please don't hesitate. Ask away and they can read it later as well. It might relate to them. Have a fantastic trading week, and as always, happy profits.
When we exit the trades, we always know what we did wrong, but when the trade is actually occurring in the moment, we just lose ourselves. I don't know how many times everyone's done it as a trader, where you exit a position, you go, why did I do that? That didn't make any sense. So that's why I think having a written trading plan that you can go to and a checklist that says, I am looking for this occur. And when I go through that checklist, if I can check all the boxes, then I hit the button. I think that really, really helps, because when you're in periods of drawdown, like I just was, I can take that break and I can go back and I can say, my plan works. I'm just, going through a rough period right now. Make those adjustments, lower your trading size and go from there. But the trading I did was the exact same. It was the exact same process. It was the exact same plan. It was just, again, staying alive until you get that moment where you hit it and you go from there.
So hi everyone, thank you very much for Michael, one of our funded traders, trading 2 funded high stakes accounts, for joining us today so we can pick his brain and talk about some of his success, some of his failures, and how he has got
Absolutely
to the place that he has now. So Michael, thank you very much for jumping on. How's everything going?
Things are going well. We have a new baby in the house, so that's kind of tiring, but so if I slur my words or misspeak, that's on a little bit sleep, and you'll see me probably go after my iced coffee a little bit here, but everyone's happy and healthy.
Your first child?
Second.
Okay, so you're a pro, you're a veteran already.
Yeah, I knew to stock up on caffeine and Red Bull and all that stuff before I got started.
Yeah, fantastic. So give me a little bit of a breakdown of who you are, what got you into trading, and we'll take it from there.
Sure. So, again, you can see gray in the beard, so I'll try to keep the long story shorter. But I actually started day trading equities in a prop firm, a different type of prop firm, way back in 2006. And started because there was a job fair at my university, and they asked questions that had nothing to do with finance at the time. It was, do you play video games, and which ones, and all of this. And because back before then, it was in 2006, there wasn't a whole lot of computerization of the market. So we ended up doing a lot of, I would call them games around market makers and specialists and things like that in the US equity markets. And I did that for a number of years. That firm ended up shutting down because as the market got more computerized, a lot of these games stopped working, and just the scalping, not randomly, but scalping around specialists just didn't work out too well. So then we moved over. I moved over and I started to work in the hedge fund space for a few years, where I worked doing kind of risk management for a bunch of different hedge funds, and kind of helping the hedge fund investors realize which funds would make sense to them. This was all around the Bernie Madoff time for anyone who's watching and remembers that story. So they wanted a third party company to go in and make sure what they were doing was legitimate, and it was above board, and they were actually trading, and they were actually generating profits from their trades. So that's a lot of what I did, which was great because it exposed me to a whole wide variety of different hedge funds and how they trade it, and what they were doing. And then when that company got bought out, I started to work with a company called Trade Ideas. I actually got my CMT, which is a chartered market technician. And ever since then, I've been consulting with them and then trading my own funds. So I've been doing this for a long time. I've just stumbled into this and the Forex prop firm world actually just recently over the last, I don't know, maybe 6 months to a year.
Interesting. Because we do have a sister company that deal with mostly US equities. So it's interesting how you would decide to come over here and do some trading in Forex. What was that decision, and how come you've made that transition to start um going into Forex trading?
Well, actually, I speak with Michael frequently. Actually, Trade Ideas and Trade the Pool have a
Work together.
relationship.
Yeah,
So that's actually how I got started
nice.
thinking about this is uh, I am not a good day trader, and we'll go through some of my failures and struggles to get funded here. And currently, I know that the purpose of Trade the Pool is a little bit more on the day trading and intraday trading style with some swing aspects, and maybe that's going to change down the road, but it's just more of a personality thing. I want to hold trades for a number of days. I find
Yeah,
the shorter the time frame that gets for me anyway, the more emotional I get and everything. So I'm always looking for ways that I can hold for many hours to days on trade. So I did that, and then it comes to strategy diversification. So I trade equities myself with my own capital, and I swing
hmm,
trade those, and I've been doing that for many years. But as you know, there's sometimes that the equity market's really interesting, and there's sometimes that nothing's happening, and sometimes, metals, and you guys have crypto now, and all of that. So I always like to have access to as many different instruments as possible, because then it stops me from over trading something that's just not moving. I can go somewhere else and explore that when it's moving.
interesting. Where have you got or built up your methodology around your trading, your techniques, and for better word, your playbook? How did you first develop that? And is it very different from when you started to what it is today, or do you want to talk about that?
Yeah, it's very different from when I started. As I mentioned, the original trading style I had in 2006 just can't even work anymore, right? You
Mm,
were you were literally we were the HFT traders before there was HFT traders. There's a bunch of college age adults that would play StarCraft and then come and play in the market. So that's completely gone. As I mentioned, I took my CMT, so I'm a chartered market technician. So that's a 3-year designation on just technical analysis and quantitative analysis. It's for those who don't know, it's like the CFA, but instead of looking at the fundamental side, you're looking at the technical side. So that did a lot for having me explore different technical aspects of trading. So that did a lot of it, and then it came down to like most things, reading books and listening to other traders and talking with other traders. I'm thankful enough that I do a lot of this speaking with traders, so I can talk to people that I respect and bounce ideas off them. So a lot of the problems, which again we'll go over, for me was adapting what I do in the equity space where markets trend way more,
Yeah.
and then taking that and then going into the Forex space as well. So like anything, it was trial and error. It was a lot of failures. It was a lot of, getting beat up and getting mad about it, but then reporting your trades and tweaking what works till eventually you find something that works for your mentality and then also in the market that you're trading.
100%. I think going off what you just said, like I used to enjoy trading crypto, and crypto moves a little bit like equities. Whereas when you come into the Forex market, when things start to range and you've got a direction and you're expecting the direction, but you get chopped around quite a lot, it can be quite difficult if this is to adapt from a way of trading to now adapt to more of a range or intraday types of trading as well. So it's super,
Exactly.
super. There's a lot of nuances as well with those types of changing and different types of techniques on different assets. That's interesting to hear. Let's go into your accounts because this is what people want to hear. They want to obviously understand a little bit about, what you've been able to achieve, and then you can tell us just a little bit about what it took to get here, because it wasn't all smooth riding.
Nope.
To be honest, you went through a couple of accounts where it was a little bit difficult just finding your feet, but
Yep.
pull this up.
Yeah, and I think that's important to show people, right? Is to say, hey, it wasn't all sunshine and puppies until I kind of got my feet under me.
Yeah. So you can see here we've got the 100K funded high stakes account. So you've actually got a high stakes account that's 150K, which is been multiplied through hitting the milestones, and also the 125K as well. So this was the first funded account which you passed to then get the extra funds added. So just a couple of these, just looking very briefly onto some of these accounts, and you're just looking at just the best profit compared to the biggest loss is kind of shows to me already that you're quick to cut a loss and you just let your trade kind of breathe and play out, which is very different from somebody that is newer to trading, where they're quite scared to hold off onto their profits and they cut them early. And the opposite when they're actually losing, they tend to leave their trades just a little bit of extra time. So that points out straight away to me. Also, a win rate of 60% with that kind of risk to reward ratio is incredible, to be honest. That's really good.
Lucky, I would say.
Lucky.
When we get to the other accounts,
Yeah,
it's like anything. At some point, you're going to hit your stride. But no, I would say if there's something I do focus on, it is when I have a winner. I put a stop at break even, and I really try to go for the guts, knowing that every now and then, and when we get to my current account, with the 150K account, I think there'll be a good lesson there. Is my job, the way I look at it, is to stay alive until I get lucky and hit one that really makes the difference, right? So even on that P&L graph, you can see just a couple great winners, and the rest is kind of treading water until that occurs.
that's the point, isn't it? You're trying to, like you just said, surviving until you say you get the luck. Obviously, it's a little bit of luck, but it's also that experience that you've probably developed to know when you can be a little bit more luckier than usual, when you can try your luck a little bit more, which is super important. So this is a 125K account, more trades on this account. So you obviously you had it a little bit longer. Again, you've still got your best profit much higher than your biggest loss, still quite a high win rate. You've probably got a range where your strategy is probably, it's worse, maybe around about 45%, 50% to what's your higher range of your win rate on this particular strategy that you use?
I would say if I can get 60%, I'm going to be the happiest guy in the world. I'm going for 50-50, and
Yeah.
then again trying to hold those winners.
Yeah.
And we'll get a little bit more into the details, I'm sure, but some of that is scalping around a core position or a core idea that I developed. So some of those win rates can be inflated a little bit just because I'm trying to just scalp around to make up for some of those losses. That's why you see a lot of, flat-ish periods in the equity curve followed by a couple bumps. So I would say it's between 40 and again, if I can get to 60 and maintain 60 for any length of time, I'm very, very happy there.
But even those flattish periods, it's a couple of days. It's really just it's a
Yeah.
couple of days maybe that you're not actually losing much money at all. You're not going into massive drawdowns, maybe a percent here and a percent there, but it's nothing too big. But would you call yourself an intraday trader, or would you call yourself as more of a swing trader?
I would say it's more of a swing trader. I bet you if you took out the scalping around a core position that I do,
Yeah.
that hold time would be much longer. But
Okay.
so for example, if I'm bearish USD franc, which
Yeah.
I'm in a trade right now, and I've been bearish on that. I may have half of a position that I'm holding for a period of time and then scalping in and out of the other half to try to, generate income or offset losses on something like that. So I bet you that shrinks that number a little bit artificially.
So when you've got a swing position, you'd happily, if you're, let's say, short something, you'd happily get long on lower time frames just to make some money up while you're waiting for that position to work out. Is that what you're saying?
More of if I'm trying to short and I'm okay risking a 0.5% of my account on a trade, I will split that into two. And one I will short and then cover, and then if it bounces, I'll short and I'll cover, holding that other position for, again, potentially, if I'm right on the direction, a longer term move. And, using that scalp around to try to offset some of the losses for when I'm wrong on a thesis on a position, right? To try to smooth out those returns a little bit. I will move stops break even relatively quickly because what I'm trying to do, and I use, and I can show you this, but I use commitment of trader data and I use sentiment data to try to gauge an overall direction. So then for me, it's about, and we talk about taking small losses all the time, is that I need to stay alive. And this is the chart that I think is going to give a perfect example of that. I need to stay alive until I'm correct on it. So for this period of time, you can see a whole lot of chop with a drawdown that's worse. I was uncomfortable with that, and I'm actually making a change going forward where I'm cutting my position size again because that was too much for me. And that was a lot of you'll see betting long the yen or betting short USD JPY. And the idea was exactly what happened on that big spike, which ended up being a very good trade. But the amount of drawdown I had to take to get into or to hold that position was just way too much for me. So that's what I'm trying to do. So at the end of the day, that was roughly a $10,000 profit on a short yen trade. But you can see there's a lot of chop and a lot of mess for me to get to that position. So that's what I'm working on with my trading, is that I want those drawdowns to be less while I figure out this position. So that's what that other scalp around position is meant to do. In this case, again, I just got a little bit too big. It was when that yen did that crazy move overnight. I got caught out a little bit on that.
How many times would you give yourself to lose on an overall trade idea before you say, okay, I'm not, this is invalidated. I'm not going to get into this trade again?
I would say during a day, maybe twice max, but I will then go back to that at some point. Because again, I'm using commitment of traders data, which shows us the positioning of speculators and large and small speculators. So you know where the boat is a little bit too loaded. And everybody on Earth was short the yen or long USD JPY. Like you go, the community data just shows that everybody is in that trade. So at some point, I am very, very confident that the move that just happened overnight will happen. and that will then be a profitable move. The idea is that I have to then time these entries, and then when I get hit, take a break and move on. But knowing that I'll come back to that, it just might be in a couple days once more data has occurred.
Yeah. When it comes to taking a hit, how do you deal with taking a hit? Because I know one of the biggest things with a lot of traders is a lot of overconfidence, except for when they're making a lot of money. And if you had, passing up to these levels, 60% win rate, you were probably ecstatic. You were probably feeling absolutely fantastic. And then once things start to get a little bit more difficult, and you can see here the win rate has gone down by half, it can start making you feel a different type of way. So I just want to understand from you, how do you control your emotions when you're in a different type of mindset? And yeah, how do you get through that period?
I walk away, right? I live in the middle of the woods, so I
Yeah.
go out in the woods. Before that really good trade that brought the accounts back into profit and a fairly good profit on them, when that drawdown, I was down around, I think, 5% at that point, and that was too much for me. It's 10% until the account is gone. I do something where I actually will scale my risk based off the stop loss level. So as opposed to a lot of people to say, I'm going to risk 1% a trade, I look at it as I want 10 trades in a row before the account is lost, and then I will adjust that. So as you get closer to that level, I'll risk less and less. So in that scenario, I completely cleared the deck. So I sold everything. I took a day off. I walked around the woods. I rethought of my positions. I said, okay, I got to come back. I'm just going to trade a little bit smaller and reduce my risk a little bit. And then just lucky enough and crazy enough, the very next trade was the one that wiped out all of those losses and then created that gain. But you're right. If I had stayed in that mode of beating my head against the wall, then that could have very easily crashed that account. So I think um, taking that time, which is one thing that I love about prop firms and why I talk about how I always traded with prop firms, is that kind of forced risk management. Some people hate at the time, but at the long run can really save you, because there was a point there where that daily 5% loss, I was fairly close to that. So it forced me to say, okay, I gotta shut everything down. And I just took an extra day off and rethought about things, and I just came back a little bit smaller, but was just lucky that with what happened with the yen happened the way it did.
So that's on that one side. Now, how do you react emotionally to a trade that you've just got that luck? That $10,000, that's also something that you've got to think about. Did you take a day off or take some time just to look at that and think, what am I going to do now? I've just made all of my profits and some back.
It's the same mentality. I think you have to reset your baseline to zero. I would argue, and again, this comes from the gray and the beer and the experience, and I'm sure you've seen it talking to a lot of traders, is that quite often your biggest loss comes right after your biggest gain. And it does, because you get a little bit of this, I figured it out, I'm immortal, I've hacked the market. And I think a lot of this just with me comes from experience of knowing that I'm in this heightened sense of, I think I'm the greatest in the world. So I did pare down. I've got a couple positions open still, but I actually took another yen position after that, but with 1.5 lots instead of 4, right? So I shrink everything down. I go, okay, trading is very much, I think, knowing yourself. So until I'm back to baseline and I understand I'm not immortal, right? I just have a strategy that sometimes, like now, it's working really well, and there'll be periods that it won't. And once I'm kind of back to that mentally, I think it will be time to, maybe take another couple shots a little bit bigger. But yeah, I think it's always just get away, return yourself back to a baseline mental state, and then come back.
Yeah, 100%. So you're floating now in some nice profits. I did have a look at your accounts before. Do you mind just opening up maybe TradingView and just showing us what made you get into some of those positions, kind of what you were thinking, what you were looking at, and see if we can extract a little bit of knowledge out of you before I let you go.
Sure. So I use three major tools is what I decided on. And again, as you mentioned, I struggled for a while. I blew up a handful or more than a handful of accounts while I was adapting to Forex from equities. And part of the reason for that was I noticed I expected to take what I was doing in equities and just apply it to Forex and have it work the same, and it absolutely did not. So the mentality I had to go with is I had to create a whole nother trading plan. And I have a whole lessons on my website about creating trading plans because I think it's absolutely vital. If I'm looking from the equity side or the metal side, I use trade ideas, which we have the ability to take a look at and show the different ETFs based off what's going on in the market. You can see gold underperforming the rest of the market right now. This is all on a relative basis in which it's showing me the sectors that are the strongest and the weakest at any given time. And with that, I want to use that relative strength. So I want to short stuff that's relatively weak and buy stuff that's relatively strong. And then the other main tool that I use is the commitment of traders report, which I talked about. So if we go to my yen idea, you'll have to flip this because we trade USD JPY as opposed to this is the yen contract. This is something that is now required by law and has been for many, many years. That shows if you are a trader over a certain size, you have to report your holdings in the futures contracts, and the futures contracts being a large market. So this particular, the green line right here is showing the position of all of the large speculators. Everybody, that was what I was talking about, everyone in the world is short the yen and has been short the yen as much as they pretty much ever have been since 2007. That to me is a condition in which I know that they are going to have to flip. Something I do in equities is I look for stocks that are heavily shorted. When those stocks start to move up, I know those shorts are going to have to cover. And that's an equity trading, a swing trading style that I use. So this was the same idea adapted to Forex, where I know that everybody is short the yen or long USD JPY, that if the Bank of Japan starts moving and if I can start to see that in the charts, there is a whole bunch of positions that need to be unwound. And that's what gave me the confidence to hold that winner for an incredibly long period of time. So from there, it just becomes charting and technical analysis in which I use anchored VWAP. Brian Shannon, he's a close friend of mine. We've talked a lot about the anchored VWAP tools that he uses and basic pullbacks, right? So we had this initial push down that happened in the yen overnight, a simple Fibonacci retracement, looking for this, the regular zone, that kind of 38 and then 61, that golden zone, I think they call it for Fibonacci retracement. As it came up in that zone, I'm either looking at the 4-hour or the 1-hour chart. The idea was that if we held this area right here, I want to short and with a stop just over that high. So I'm risking, I believe in that case, I was risking less than $1,000 for that $10,000 profit. Again, this to me is a little bit, this is, call it luck or call it just, being
Definitely
able to hold
not
the right side,
normal
but
price action for
no.
something for currency to go over 1.5% in a session.
Yeah.
It's not normal. So you caught a very nice move.
Yes. No, I expected that hole that I was into. I was fully saying, okay, I'm going to take a good trade after a good trade, and maybe it's going to take me a couple weeks or even months to kind of dig out of it. But, pleasantly surprised when it didn't. And then the trade that I'm in right now on the yen is we had, after that move, I covered somewhere in this area here. As we had that move back up, I have an anchored VWAP marked. So this basically, for those who don't know what anchored VWAP is, it's a moving average that incorporates volume as well, and you choose the point in which to anchor it. And there was two right here, and one was from this major high right here, and the next one was from this major high right here. And this is just showing me that the average market participant in this, and if you think about if you dollar cost averaged into something, this would be your price. So the average market participant from this point, this major high that happened overnight on the yen, And then this high that happened a couple days ago on the yen, that was sitting around in this zone right here. So when we reversed off that level, I took a little bit of short. My initial stop was kind of up in this area. And for this trade, I'm just going to see if we can kind of threaten this low and then take this low. I believe there's more of this unwind to take place. Now, that commitment of traders report comes out every Sunday. So part of my work on the weekend is I will review that and I will say, I will know, did anyone cover? Because if this commitment trader report, we see that a lot of these shorts covered, then I think it's time to move on from this trade and look at the next one. I'm looking at the franc. I'm looking at Bitcoin right now as well.
Yep.
But if nobody covered, then I want to try to hold this position. And this is where trade rounds might start to occur. If we start to get little bounces and bear flags and ranges for me to play off of, I may take a smaller position short and just look to kind of scalp that. And scalping for me is holding for a couple hours and trying to take a trade out around this position while I hold this core position to see if this is something that's going to reverse on a daily chart or even longer, back into some support levels on the daily chart. So that's kind of what I'm looking at. Is the commitment traders report gives me which trades are crowded, and I'm looking for the other side of that crowded trade, and then I'm using anchored VWAP pretty much primarily, and then some Fibonacci's to try to time my entry into those crowded trades. Again, waiting for that moment where everybody needs to exit the trade, and I'm the one holding that while they're exiting. The same idea for the stock traders is a short squeeze. Think of GameStop. Everybody was short GameStop. All it took was some catalyst to get it moving, and then you had this massive pop. And if you were long GameStop, you were able to make a substantial trade there. So that's the idea.
Amazing. Any advice for anybody that is currently struggling to pass? They're in a bit of a boom and bust stage, and they're about to go and get their new challenge because they want to get back into the game, and they want to to see some of the profits that they see a lot of people on Twitter and a lot of people on the internet make, including yourself. You've had some nice profits off these accounts, nearly 25,000. So it's quite a big amount of profits that you've been able to withdraw from all of this.
I will say that those results won't be typical. I don't expect that to occur all the time. I'm not pushing for that because I think the more you push for gains, the more you open yourself up to losses. If you're watching these people on Twitter, just know that they're only posting their best things. That's why I was totally open to talk about all the accounts I blew up to get here. So understand that. And then the other thing that I think is very, very important is that you have a plan. And I think that that's where everyone, and I just don't mean you have a plan of, oh, I'm going to buy here, I'm going to sell here, is that you have a plan that says something like, I am going to enter a trade when these things occur, and I'm going to exit a trade when these things occur. And this is the risk I'm willing to take. And all of that has to be written down. I mentored a trader once who was ex-military.
Yep.
And when I talked to him about this, he said, oh, our drill sergeant always used to yell at us and say, you don't get smarter when the bullets start flying. And I think that's a great analogy for trading, is that when you sit down at your desk and the P&L is flashing up and down, you're not a very smart person right there. That's why when we exit the trades, we always know what we did wrong. But when the trade is actually occurring in the moment, we just lose ourselves. So have a plan, and then understand that most of the things you see on Twitter are just, people's best moments.
Perfect. So thank you very much for everybody for watching this video, and I hope you've taken something out of the conversation I had with Michael. Michael, thank you very much for spending some time with me to give a little bit of your 2 cents and to show everybody your process and your journey as well, and that it's not all sunflowers and daisies and sunlight. It is also quite difficult. And there you go. Thank you very much, and best of luck in the account. Okay.
Thank you very much. Hope to be back on soon.
Hi guys, so thank you very much for watching the video. Now make sure you like and subscribe, and most of all, go into the YouTube and check our other content that we provide here at the 5ers. We'll see you in the next one.
Welcome everybody. We're going to be talking about advanced risk allocation. Just before we get started, and for those of you who don't know me, my name is Saul. I'm the senior analyst here at the 5ers Fund. Maybe at the end, I'll give a few words about what we do, and this is only one of many resources we give to either the open public or to our traders. There's a lot of closed resources. So welcome, let's get started right now. Yes, this will be recorded, and yeah, thanks Alexander. I'll have the chat open for for some questions, but there's a large group, so I'll try to have an eye on that. So what are we going to do today? I'm gonna deep into three topics or three things that we need to discuss a little bit. So first, the risk management cliches. Okay, what we all know about risk management, what we all hear and study and see on YouTube and TikTok about how much you should be risking on a certain trade or a series of trades, and we'll discuss that as an introduction to go into the core of this webinar, which is the scaling in and scaling out of positions, and that will lead us to a risk allocation model, a triangle or a triangle risk allocation model. That this might be the new stuff for a lot of you. And then if we have time, we might go to the charts and maybe give some live examples. Just do know that I will be, or my expertise is on the Forex market. So if we go to the live charts, or if I use words, my vocabulary is, I will be using Forex terminology. But what I'm going to show you, you can apply it to stocks, you can apply it to commodities, you can apply it to Bitcoin, you can apply it to everything. Okay, so use these principles to your own trading and your own activities. So let's get into it. The the cliches of risk management when we're trading, most videos and educators and mentors, they teach you that you should either risk a fixed percentage of your account in a single trade, correct? A 0.5% or a 1% of your account in each trade, or maybe a 2% of your account in a single trade. Or if you're an aggressive trader, maybe you can trade 5% of your account on a single trade. And they explain you what are the advantages of doing this, correct? They explain you that if you stick to this fixed percentage of your account, eventually you compound your account and you grow faster and faster. And when you're on the losing side, sticking to a percentage protects you from losing larger amounts of money. So it has some good things when you're winning and good things when you're losing. Other educators will tell you that you shouldn't be risking a fixed amount of percentage. You should be risking a fixed amount of money. Okay, a dollar amount or a money amount. And they will give you examples and arguments of why is that the best thing to do, or advantages or disadvantages. And this is the basic dialogue, and this is what we hear and what we read in blogs and the internet. And the truth is there's much more into that. Okay, there's, even if you're going to be allocating a certain amount of money or a certain amount of percentage of your account in a single trade, you can allocate your risk differently in each situation. Okay, and before we go to the model, there's sometimes when setup, there's an argument for allocating more money into that setup, and there's arguments for allocating less money in other setups. Okay, each one of us knows a strategy. Each one of us has a we saw a YouTube video, or we paid for an academy or whatever, and we have a strategy, a trading strategy, and that trading strategy works better in some scenarios, in some situations, works worse in other situations, correct? So if we're using a trending market strategy, maybe our strategy will work more poorly in a ranging market, in a sideways market. And if we're using a ranging strategy, it won't work well on a trending market, correct? So each one of our strategies has different setups, high quality setups and low quality setups. So there's no sense of allocating or risking the same amount of either money or either percentage of our account in both high quality setups and low quality setups. If we are taking, for example, a counter trend trade, we shouldn't be taking the same amount of money or risk in that trade than if we're trading, if we're taking a trade in the direction of the trade, which has a higher potential of profit or higher win rate. So our strategy itself has different scenarios and different setups that we need to know differently. So we need to know it. We need to learn our strategy and know it. What are the high quality setups and the low quality setups inside the strategy? And once we know our statistics of our strategy, the different scenarios, possible scenarios, now we divide it into high quality and low quality ones. And we want to risk more on the high quality setups, the scenarios, and we want to risk less on the low quality scenarios. Okay, that makes sense. Let's move a little bit deeper. Okay, so there's two important concepts that we need to know, which is the scale in and scale out. And most of us, we know the scaling and scale out techniques of a trade management when we are on a winning situation. When we're on a winning situation, we know we should or we can scale in. Okay, we can add to a winning situation in order to maximize our profits. Correct? That's very obvious. And we also know this scenario right here, that we can scale out, we can reduce part of our position when we are on a winning situation. Why we do that? Because we can reduce risk. We are maybe in a full position into a winning trade, and we can maybe half profit, or we can take profits or cut half of the position and let the other half of the trade running in our favor, correct? So we have now minimized risk from the trade. So these two scenarios, okay, scaling out of a winning trade and scaling into a winning trade, we know them. But the truth is, we, or most of us, we are not very familiar, or we haven't practiced the scaling and scale out scenarios when we are on losing situations, in losing trades. And actually, when we manage to master these techniques of adding into a losing position or reducing, scaling out of a losing positions, we can make wonders into our strategy. Because let's just imagine we have a certain strategy, and we know our win rate on that strategy is 60%. Okay, win rates, meaning 60% of the times our strategy wins, and 40% of the times our strategy fails. Okay, loses money. So what if using these techniques, okay, adding into a losing position or reducing, scaling out of a losing position, we can fix, or we can reduce the risk on the losing side of the trades in half of the times. Okay, so half of the 40% of the time our strategy fails, we manage to break even on that losing trade, or we manage to fix that trade. Okay, so now we have brought our strategy from a 60% win rate to an 80% win rate, because now 40% or half percent of the 40%, half of the time the 40%, we can now break even on our losing side. So now we're only left with a 20% lose rate, okay, or lose ratio in our strategy. So I know it sounds counterintuitive, and not a lot of people talk about these topics, adding into a losing position or scaling out of a losing position, but I wanna talk to you about these topics and practice them, of course, before going live with these techniques, and you will see we can do a lot of good stuff with these techniques. So let's discuss these ones deeper, and I want to show you the risk allocation model. Okay, the risk allocation model looks like a triangle, okay, like a pyramid, where you add and reduce to your position and to your lot size, and it ends up, or in my mind, it looks like a triangle. Okay, so let's start with the winning positions, which are the ones we know, and they're more, we know them. So let's say we buy here, okay, we buy at this line right here, and our position is going in our favor, correct? So it starts going up in our favor, and at some point we want to buy again. We want to add to that position because we want to maximize our profit, correct? That's the whole idea or whole goal of adding into a winning position. We want to maximize profits. So our buying position, our buying setup starts here, and once we add, our position grows. Okay, so it forms like a triangle, which the top part of the triangle is bigger, it's larger than the bottom one, because at this level right here we added. Okay, we bought a new position, so now we have more lot size, more allocation towards our objective, our take profit. Now, when we reduce on a winning position, okay, this is very similar. A lot of people is familiar with this. Okay, we buy at this level right here with a lot of with our full position. Let's say 0.5% or 1% or whatever percent of your account you allocate at this level right here. And then once the trade is going in your favor, I want to take this one. Okay, once the trade is going in your favor, you actually cut it. Correct? You peel off your win. You take partial profits. So at that point, now your position is smaller. Okay, so you leave less of your position going up towards your take profit. Okay, in your favor. So this is something that most of you know, and now I want to go to the losing side to see the advantages of adding and reducing in a visual way of doing that. So why would we add to a losing position? Okay, let's say we have a buying position right here at the top, and the buying position starts going in our favor, and our stop loss is all the way right here, and we add another position right here, okay, from another buying position. It sounds counterintuitive and sounds like this is something that we should not be doing. But in fact, if there's a reason behind doing this, if there's a reason and a justification of buying at this certain level, and from this point, the trade starts going in our favor, okay, now we have a better entry point at this point that goes in our favor, correct? And of course, if this goes all the way down, so we have a larger loss, okay, looks like a larger loss down here. But again, adding to this position should not be larger. We shouldn't be risking more than the initial risk we were ready to take. So we shouldn't go beyond our 0.5% or 1% or a certain amount of dollars if all of these trades reach the take profit, the stop loss, correct? But so if we buy here and then we buy here and this goes in our favor, now we have a better entry point and we have actually fixed this upper position right here. Of course, there's a chance that this both position goes in our against us and reach take profit, the stop loss. Okay, it's something we will not know that until after the fact. Okay, but once we are in the real market and with real situation, there has to be a reason why adding into this point right here. So that could either take us into the trade in a better entry point, and or it can help us to fix this first entry that was a bad entry, for example. Okay, and reducing on the losing side. Okay, we buy here, and then the market, the trade starts going against us, and we decide to cut that trade. Okay, so the opposite of peeling off a winning position, now we're going to peel off the losing position. So instead of all this money, okay, this large trade going all the way to the stop loss, now we have cut that and we have left a little less of the trade, a little less of the position going to the stop loss. So for example, if we were trading, if we were risking from here to here, let's say 100 pips or $100 or whatever, and we decide here to take half of the losses, so this second half will save us money that we can reallocate afterwards in a new position. Okay, so let me give you an example, and we will jump soon to the charts, and I'll give you some examples. Okay, all of you who have been following us for a while, you know we are big believers of institutional trading and supply and demand zones, and price action. And if you recognize this is called a demand area. Okay, this is how it looks, a classic demand area, where you have a sideways movement, balance between buyers and sellers, and for some reason there's a big breakout of that movement right there. So the way of trading a demand area right like this is waiting for price to pull back and come back to these areas right here, okay, to that zone, to the demand zone, and then wait for price to come to this area, and then a continuation, okay, a rejection. And all of you who trade demand and supply zones, you know you have three potential entry points. The first potential entry point is the breakout line, okay, the moment where the zone, the balance zone, was broken. Okay, so it could be that level. The other potential entry point, okay, with a buy limit order, it's called a decision zone, a decision point or decision level, which is the moment where that candlestick started. Okay, so that would be there. It's usually at the middle of the zone, of the demand zone. And the third possible entry point would be the bottom of the demand area. For all of them, our stop losses should be at the same point, okay, below the demand area. Once the demand area is broken, we should be out of the trade. We shouldn't be holding those buying positions longer. And the dilemma now, the question we all have always is, where do I get into the trade? Do I get in here? Do I get in here? Or do I get in here? Each of those has different advantages and disadvantages. For example, if I place a buy stop order here, I have larger chance, okay, bigger chance to get into the trade, to get triggered, but my distance to my stop loss is larger than these ones here. And in the opposite, if I only take a buy stop here at the bottom part of the demand, so of course the distance to my stop loss is smaller, so I can make it into a better, a better risk reward position, but I have less chances of getting triggered. Correct? Sometimes the price will come and take this, test this level or these levels, and then will reverse, and I might miss the entry. So why, instead of allocating our money in only one of these levels, okay, instead of risking 1% here or 1% here or 1% here, and I'm saying 1% just as an example, that's something you have to know for yourself better, and maybe you risk 2% or 0.5% or whatever, but just instead of allocating our full risk in a single entry point, we apply our triangle method. So I apply, or I set a 0.25 risk here, a 0.25% here, and a 0.50 at the bottom. Okay, now have I just done by doing this? If the prices, it's something we need to explain live, okay? With new information, you can make decisions in real time, correct? But let's say prices come to this area right here, touches my first entry point, and then goes in my favor. That's fine, okay? I can now wait for a pullback and add the rest of my position to maximize my profit, okay? Then I have to scale into a winning position. But if I get triggered into this one and price goes lower, okay, in a sense, I'm adding into a losing position, correct? Because I'm holding this buying order here into drawdown, into a losing position. But this one here, that's also a valid entry point. So there's no reason why I shouldn't be getting in also at this point here. But I have to be careful, just not over leveraging my account, not over allocating. That's why I start small, okay, as the pyramid, and then I add another position here. And now if this position goes in my favor, so now I have 0.5% going in my favor, or I can maybe close this one right here and only stay with this position right here. And if price goes against me, triggers me in here, triggers me here, and triggers me in here, and then reverses, then bounces in my favor. So now I have my full 1% in my favor. And if it goes against me, well, it doesn't matter, okay? I'm only exposing 1% of my account, which I could have done that. I'm taking like a shotgun approach instead of a sniper approach. So I'm giving the market and myself more flexibility where to get in and get out. Questions getting into the chat. So I'll go in a moment to review the questions. So and now I would like to go to the platform and show you some live examples. So just give me 1 second. Okay, so please tell me if you can see my my trading platform. Yeah, great. Okay, now I'll give more examples, and I think it will be clearer. Okay, so this is the 1 hour chart on the USD franc, and you can apply this really to any time frame and all all assets. I just have some demand areas here, and you can apply this again. You can apply this to all your strategies. Okay, I'll give you examples with demand and supplies, but maybe I will bring some random strategies and I will give an example with them. So we have some demand areas here in the chart. Okay, I see these 2 demand areas. So usually the way to trade demand areas, I told you, is placing a buy limit at the breaking point, a buy limit at the decision point, and a buy limit at the bottom part of the demand area, or waiting for price to come into this area and then be in front of the charts and taking the trade manually. But if you want to just set and forget, you can place buy limit orders. Same here, we could place a buy limit on the breaking point, a buy limit on the decision point, and a buy limit on the bottom part of the demand areas. For all these positions, the stop loss needs to be below the demand area, maybe there, or maybe below this pivot here. Okay, so it doesn't matter where I place the entry point, the exit point is always the same. Okay, so all my exits needs to be here. No matter, it doesn't matter if I get in here or here or here, I need to get out there. Okay, that's the last that's the stop loss level. So now I need to do some number. I need to run some numbers. I need to measure. Okay, I have From here to here, I have 35 pips. And from here to here, I have 27 pips. And from here to here, I have 16 pips. So let's say I want to risk, on this account, I want to risk $100, okay? So instead of placing here a buy limit, risking the $100, the complete $100, I will place here let me switch that. I'll just text it here. Okay, that first entry will be risking $34. Okay, that one right there. The second one will risk another 34. Reduce the size. I'll do this 24. And the last one will be a $42 risk. Okay. Now, if all these trades fail and 1, 2, 3 entry points take profits, I will lose the $100. Okay, that I was willing to risk at the beginning. So instead of risking here at the top the $100 and then missing these entry points, or the opposite, just leaving only this bottom position on with $100, I will use the pyramid method. Where I risk a little bit here, and a bit more at the bottom, okay? And if all of that fails, then I'll get out losing $100, okay? Now, allocate that or adapt that. If you're trading Forex, so that would be in lot size. If you're trading stocks, that would be a certain amount of contracts. So you will have to do your tuning and adapting to your own strategy. Okay, so you can see the logic behind. Now let me see. Okay, there's a lot of questions. I'll go to the chat. And now what happens? Let's do this exercise together. Okay, what happens if price goes down, triggers me in only in this position, and then bounces? Okay, how do I overcome the fact that I have left pending orders here and that weren't triggered? Now I have a small position going in my favor, and I want to maximize my profits, correct? So now I need to inverse the triangle. I need to build my opposite triangle, and I need to wait for an opportunity to add into my winning position. If that trade goes in my favor, maybe I can wait for a confirmation pattern or whatever. I can wait for a pullback, and then an opportunity to add, okay, the rest of the money to that position, to that winning position. Okay, now I've made an inverse triangle. Okay, now I'm adding into a winning position. Okay, so I hope these guys, this makes sense. Let me go to the chat and see some questions, and I'll look another example, or maybe a different strategy to give you an example. just wait a second with me, please. Some profitable regularity, a true personal strategy, using more tools, some release points. Thank you. Okay, thank you. Thanks for the compliments, guys. All good. All good. Okay, let me go into a the equity show on chart and adding into a winning trade. Okay, let's doing like in live. I would have to go to to lower time frames, maybe to the 1 minute chart, and hoping for that to happen. But let's just imagine we bought, okay. No, let's imagine we got into a buying position here that went into our favor. Now it has pulled back, and we identify there's a new consolidation or whatever, okay? And then we can add to this position, which is in our favor, we can add new money or new trades in order to catch the next run, okay? Because we know there was a breakout and then the pullback to the breaking zone, and maybe demand has become now, resistance has become now support or whatever. Okay, this is just an example and a back testing example. And then here you add to catch the next leg. Okay, the next leg run here starts moving in a sideways movement. Okay, now this is a rally, and now it's spacing, it's consolidating, and then this might break either to the lower side or to the higher side, and you can place a buy stop right there, and that movement triggers you in, okay, to the upside. So now from this initial position or this initial position, after a consolidation, you add into in the same direction you are on a winning trade. Okay. For all of you guys that are part of the 5ers and you trade with us and you come to the trading rooms, you can see us using these techniques very frequently. I use this a lot. Trying to think of okay, let me give you another example. This is the Euro USD on the daily. Okay, the Euro USD has formed now a reverse or inverse head and shoulders. You can see the left shoulder, the head, the right shoulder, and and the neckline somewhere there. So in real time, and a lot of people were doing this, a lot of people were anticipating this kind of formation, and we're adding position, we're buying right here. And that movement went in their favor, but actually the break of the neckline, correct, this is a classic head and shoulders trade, that level right there, it's another valid entry point. So either if you're holding these buying positions here, and you are in profit right here, there's nothing from holding you or keeping you from adding new buying positions at the break of the neckline. And this candlestick right here would be triggering you into a winning position on top of these winning positions you were holding already. Okay, that would be another example. Where I put my take profits, yeah, the take profit has to be depends on your strategy, correct? This is only risk management techniques or trade management or risk allocation techniques. But if this is if you're trading these head and shoulders right here, so your stop loss, they need to be here, and maybe you can trail them to the right shoulder, and your take profits, same. They should be either here, or you can maybe leave them run if you think there will be a break, okay, if the context tells you there will be a break of those highs, so you can maybe leave them running. Or you can play with the different methods, okay? Let's say you are in a winning position here and winning position here, and now you find that price come all the way here. Now you can maybe reduce, okay, scale out of a winning position. If you're in profits here and here, once it reaches your first take profit here, now you can maybe take profits from this one, letting this or letting the remaining position breaking, okay, to see if this breaks to the upside. Okay, so it's not like you have to do one technique every time, all the time. You can play with them and mix them with every new information you receive from the markets. Have I backtested this method and found it more profitable than a static 1% entry model? Yeah, for sure. We all know the static 1%, okay? And I was speaking 1%, but it could be 0.5% or 2% or whatever, correct? We all know that principle, okay? The fixed risk allocation, and we all know strategies, or we were taught strategies that they should be meeting a high win rate or a high risk reward ratio. So if that was that simple, everyone would be making money, correct? Of course, there's the psychological part of trading or whatever, but all strategies have the potential to give you high statistics or good statistics. The reality is, when you maximize into trading profits and when you scale out from losing positions, you make your statistics even better. Okay, there's no reason. For example, if you see, I will clean this. Okay, let's say I was short here. I entered a short position. My stop is right there. After a movement like this, that sharply against me, I'm now in a losing position. There's no reason why not to cut part of the losing trade. Okay, we are always very nervous and very anxious about cutting our winners, okay, to secure profits and to reduce risk and to try to let our winning trades run for longer in our favor. And we're never willing to do the opposite, which is cutting our losses. So instead of losing a whole 1% from here to here, I will cut that, okay? I will take partial profits right there or at some point. And now instead of losing a whole 1%, maybe I will lose 0.70% or 0.75%. So now I have saved 0.25 or 0.3 of my money, of my account, to allocate that in a new and a better setup, okay, a quality setup. Chris, that's for you. So yes, I find these active managing techniques to be very, very profitable. Okay, especially the cutting your losses, okay, taking partial losses and adding into winning trades. How do you know if you should be scaling in or scaling out of a position? Okay, for me, it's like a map. Okay, I'm into a trade. Now the trade can either go in my favor or against me, correct? A losing position or a winning position. And depending on how the market is forming or how aggressively it's going in my favor or new information, with every new information, I have to make the decision if either to do nothing, to scale in, to scale out. Okay, it's something I cannot tell you right now what to do every time. Okay, it's something you have to decide on every single setup, and depending how the market is moving. So if the market is moving very, very aggressively in your favor, so you want to take advantage of that movement in your favor. If the market is moving very aggressively against you, so you want to cut that loss, correct? You don't want to hold that loss for longer. So you want to maybe consider scaling out of the losing trade. If the market goes against you, but very slowly, maybe giving you, it might reverse in your favor. So you might consider now adding into that losing trade. If you're in a drawdown, you can add to that position because you identify and you have signals in the market that will eventually go in your favor. Okay, that your setup is still valid. So that would be the answer. Guys, we're getting to the end of the time. Just let me show you one last thing. If you have any question, guys, don't hesitate to send us an email to the support team, help@the5ers.com, and I invite you to visit the website. Especially if you trade Forex, go to our website and join us. We trade Forex here, and we're a fund. We want to welcome traders to take part of the fund and manage it and grow it. You can keep part of the profits, and the fund grows with you, and you grow with the fund. And besides, in addition to the account, the funded account you will get once you join us, look at the huge amount of resources we have available for you. So you will get trade ideas. A lot of good traders will post their ideas here, and you can post yours, and you can get feedback and interact with the traders. So you can get some signals from here, and we have trading rooms every day, 3 times a week. We hold live trading rooms with our traders. So we chat with them, and we trade live with them. We have videos and courses, and you get all these once you join us and trade part of the fund. Okay, guys. So thank you very much, guys. Thanks for joining. Any questions, just send us an email. We'll try to be in touch with you. Thank you, guys, and have a nice day.
All right, welcome everybody. Glad to be with you in this webinar. My name is Sol. Glad to have you here. Thanks, Mo. Just before we get started, if you want for everyone to see what you type, just change your settings on your chat, so all attendees and panelists see what you type. That way, everyone will see your messages, and we can create a conversation. Edwin, thank you. Hi from the Netherlands. Okay, let's get started. We're gonna spend maybe half an hour, 40 minutes here together, and I want to tackle and discuss in depth a topic that comes very, very recurrently, and a lot of traders, Forex traders, but I guess all traders suffer from. And more importantly, I'll try to give you some tools to try to fix those challenges. So with that in place, and for all of you we haven't met or we haven't spoke, my name is Sol. I'm the senior analyst at the 5ers Fund. We are an online prop company where we fund Forex traders so they can manage funds and capital from the fund, and then we split the profits. And we try very, very hard to deliver a lot of resources and a lot of tools and a lot of webinars and training rooms in order to help our traders to succeed. And here you can see the large list of resources you will get access once you are a trader with the fund. So nice to meet you all, and let's just start. And we will start with something that might seem a bit basic, but I'll try to go deeper and deeper and deeper. So just hang with me a few minutes, and we'll discover some things that might be useful for all of you. As part of what I do here at the fund, I get the opportunity to talk to many of our traders. I hold one-on-one calls and talks with our traders, and I get to hear what are their challenges, what they suffer the most from, and what are the challenges they're facing. And I've spoke to hundreds of traders, and I've heard a lot of traders, and I've tried to help a lot of traders. And there's two things that traders externalize the most. Okay, if you want to guess what are those two symptoms or what are those challenges that I just hear over and over and over again, that would be over trading and over leverage. Now, the problem with traders thinking that these are their problems is that over trading and over leverage, they are just the edge of a much larger problem. These are just the actions. Okay, they are like the symptom of the illness that we need to identify. There's something behind this conduct causing traders to eventually get into overtrading or over leveraging, and that's what we want to understand, because they start the meeting with me and they externalize and they tell me, yeah, I overtraded or I over leveraged and I shouldn't have, or whatever. And then when we keep digging and trying to get deeper into what's causing that, then we discover what is really causing and triggering this conduct. Okay, so I'll try to give you a lot of perspective to this topic, and I'll give you some tools and some tips to try to overcome this symptom. Okay, because as we said, they are not the problem itself; they are just the final action. Okay, the final conduct of our deeper problem. So let's start with that. Okay, before we move on, I just want to show you some examples of charts from some of our traders, and every chart tells a story. Okay, so for example, I want my. Okay, so we have a chart here. Let's look at this one, for example, and this is a 80K account, meaning this is a trader who already passed successfully the first level. Okay, this is a level 2 account, and we can see very small profits, very small profit, very small profit, very small profits, and suddenly after a while a huge stop that ends stopping out the account. Okay, so this is a clear over leverage or revenge trading or over trading that caused it to this. Okay, what is it? I don't know, maybe lack of patience, and the trader was feeling impatient and wanted to profit quickly, or something that ended up taking big losses. Something similar here. Okay, a level 2 account, a 10K account. You can see here the dot line is the equity line versus the balance line. So you can see over these little gains, there was a huge drawdown on the equity. Okay, even if after closing the trade, the balance was positive, this trader was taking a lot of drawdown in order to get small profits, and getting disciplined enough in order to maintain a strategy that it's giving you and taking so long in order to give you results. That might be frustrating, for example, that might trigger some emotions that ends up wanting the trader to get bigger results or bigger returns, opening up a trade that eventually was a big loss that you can see here. And then maybe, the rest is history. He wants to recover fast, or he wants to revenge trading or something, and he blows the account. Same here, we can see a nice balance, but you can see also the equity, how it's in drawdown a lot of time. And look how close was this trader to the target, to get to the target. He was just a few $100s away from the target. Maybe at this point, he or she felt overconfident, for example. Okay, he were overconfident. He wanted to get to the target as quickly as possible, and that was a big loss. He wanted to recover that big loss quickly, and you can see the rest of the chart. Something similar here. Okay, we can get our thoughts about it, but it's something similar. Something here, a trader who's in drawdown and recovers from drawdown, recovers from drawdown. He's doing fine. He wants to get quickly to the target, opens up a bigger or increases lot size and big loss. Okay, or same here. This looks to me like a martingale system or something, but you know, many small profits, big loss. Many small profits, big loss. Big win. Okay, overconfidence. I want to get quickly to the target. Bigger trade, big loss, and stop out. Okay, so every chart has a story behind it, but you can see here different causes or different triggers. Might be an emotion, might be an expectation, might be lack of discipline, lack of consistency, lack of trust in the system, greed, maybe overconfidence, that they lately or eventually cause or trigger either over leverage or over trading that leads to losing the account. Okay, so let's move on with those thoughts. So let's talk about possible cause causing over trading or over leverage, which is unrealistic expectations. And if we go to explore that a little bit more, let me just go back a little bit. Okay, unrealistic expectations, I think of those in three aspects. Okay, unrealistic expectations about success, about results, and about time. Okay, so let's start with success. First, as human, we think of success, or we might be entering the trading world thinking of success in a linear way, when we will just improve, and eventually we will get to the top of our career or our skill or our trading career. When in trading, success really looks like this. Okay, it's a very hard way and very long way, partially because we as humans are used to do some action and getting some result of that action. Okay, so if I don't know, if I like mathematics, so 2 + 2 is always 4. If I play an instrument, so every time I play the piano, certain note or something, it's always the same note, always same sound. And here in trading, sometimes we think we're doing the same action. Okay, we're following our system, our strategy. We have a signal in our strategy, and we don't get the same results. Sometimes those trades result in a win, sometimes results in a loss. So it's very hard to measure success or progress when we don't have that feedback or positive feedback from the market. Okay, so our expectation about what success should be in the market, it's very different from what we experience in life. Okay, we feel that we're not progressing. So here at The5ers, and we speak a lot about that, and I agree with that. We speak about shades of success. Okay, when we talk about success, we really think success is a constant progress. Okay, it's a constant progress towards a better trading every time. Okay, and I would like to give you the first tool for this webinar. Of course, at the recording, you will have it on the YouTube channel. But here you have a quick blog post we wrote about it, where we need to auto-define what's success for every one of us, and we need to be aware that we improve every time and constantly. Okay, the fact that we all have different backgrounds, different account sizes, different skills, different time availability. So it's a very different path that every trader has to go through, and you need to be and start measuring yourself against yourself. So you need to start comparing yourself to your past self, and then to see if you have made any progress or not. Okay, so you need to be your own benchmark. I think that's the thought, that you need to stop comparing yourself to others, and you need to start comparing yourself to your results from, I don't know, 100 trades ago, or 1 month ago, or 1 year ago. Are you a better trader or a worse trader? Okay, and you need to acknowledge that progress. So that's very, very important. when we think about success, it's very relative in trading. If you were a losing trader and now you're a break-even trading, so that's kind of success. Of course, if you're a break-even trader and then you get to consistent trader, that's better. And from consistency to profitability, that's even better, but that will take time, okay? Now, when we think of results, of course, there's the money and there's the returns, and we need to think about what's realistic, okay? What's our account size and what we can get from that. We cannot expect from a very small account to get a lot of money, okay? That's something just not realistic. You already know that. So we need to think about our outcome results in a realistic way, okay? And not thinking of trading as a profession that can give you millions of dollars very quickly or with a small account, because that's just not realistic. And same thing with time. You might hear when we think of a career, university, a degree, we need to invest years of our life in order to get professional at something, okay? And for some reason on trading, we want to get immediate returns and immediate success. And we need to remember that trading will require years of preparation. So you need to commit time, okay? You might have heard of the 10,000 hours to get to master some skill. So maybe you need to get 10,000 trades in the market to get, professional at it. And of course, you need to take into account your available time. You may have another job, so you have to trade off the larger time frames, and you will have less setups and less opportunities. And if you have time available to practice, so you will have more available time for practicing, and maybe your path will be shorter, okay? But again, we need to understand what's our reality and then what's our available time for practicing to commit time into trading. And we cannot expect to get successful in trading in less than 6 months, 1 year, 2 years, okay? Anyone who offers that to you, it's very unrealistic. So let's go back to our presentation. So that might be one source, okay, causing over leverage or over trading, because suddenly what we thought about trading giving us a lot of money is not getting there, and we start over trading or over leveraging to get those big outcomes we thought trading would give us. And we start with this, okay, and we get disappointed. Another thing that we see and I talk to a lot of traders, they have the wrong focus, okay? They focus a lot in the outcome instead of focusing in the process. They cannot distinguish between lucky strikes they had and consistently. So they have a lot of weight, and they give a lot of weight to good trades or profitable trades that they had here and then, instead of trying to get consistent over time. And I don't know if you saw the Moneyball movie, guys. I don't know if you saw it, but if you haven't, just go and watch it. It's a very good movie, and you can see there how they are trying to recruit baseball athletes, baseball players, based on their statistics, on their consistency. Okay, so we need to really focus on our process instead of focusing on the outcome. Because if we focus on the outcome of trading, on the money, we will focus on over leverage. We want to take one single trade that makes a lot of money instead of trying to focus on the process, on developing the skills and the consistency that eventually will give us outcome. Okay, but the focus has to be in a good process, not on the outcome. And surrounded and all the way, okay, we have emotions involved. So at every stage, okay, we have a correlation of emotions being involved here. We fear frustration, so we might revenge trade. We fear greed, okay, so we might over leverage. We might fear fear. We might fear a lot of I don't know, we might fear fearless, okay? We might feel fearless, so we go and over leverage, over trade, and our emotions are involved during the whole process, and we need to acknowledge those ones as well. So for all that, let's try to find some solutions to that, okay? So what we need is to basically to get to an integral solution. We need to break this vicious cycle and start developing good habits. When we try to when we want to change bad habits, we have to have something in place in order to replace those ones. Okay, so unless we develop good habits, we will have no chance to just erase or delete our bad habits. So we have to have the good ones in place in order to replace the bad ones. Okay, so let's start with some ideas. There's no more important or less important here. The most important thing is to take one of these ideas and start today with one of those. Go back later and watch the recording, and once you have one of those checked, then you can take another one of these good habits and start developing as well. And once you have all these habits we're going to cover right now, you will be able to get rid of your bad habits, and you will have some progression, okay, a shade of success, some success in order to become a better trader. So the most important thing is to choose one of the ideas I will throw you now and start with that one, okay? And then just continue picking a new one and continuing with that, okay? So let's just start. A good idea for improving your trading is to reduce your lot size. And I've told you in some webinars or talking to some traders, I have gone in depth to this idea. If you were risking just $1 single in every one of your trades and you lose that trade, that $1, you wouldn't feel the need to revenge trade in order to make back that dollar, okay? $1 would not be a painful loss for you, okay? So that wouldn't trigger in you the need to overtrade or to over leverage in order to make that $1. Of course, this is just an analogy, but the best way in order to develop consistency and to not focus on the outcome, but focusing on the process, is to really reduce your lot size, to start to focus on improving your statistics, your ratios, your win ratio, your risk reward ratio. And once those are positive, then you can start increasing your lot size in order to get outcome, in order to get money of your good process. But you really need to reduce your lot size so you don't get emotionally attached to any one of your single trades. So that would be a good exercise to do. If you feel that many times you are over leveraging or over trading, that might help with that, okay? Unrealistic expectations. Why not developing a trading plan? But a trading plan is not only writing down your strategy. Okay, writing down your strategy is super important. It has to be like your map to follow. But a trading plan has to include what are your expectations, and what are your expectations based off your own situation. What's the time you have ability? What are your own life objectives and the lifestyle you want to live? What income you need? So for that income, what kind of large account size you need in order to make that in a consistent way. So you really need to have a real and a complete trading plan in place, and you have to have the discipline in order to follow it, so you don't go thinking of trading in an unrealistic way. So I'll give you another tool for that. If you don't have a trading plan in place and you don't have one, let me give you one here. It's a short version of a very complete trading plan we have. So if you fill in your email in this link that I just gave you, you will get to your email a reduced version of a trading plan that will help you start with something. Okay, but it's very, very important. I think traders, and especially I don't know if especially Forex traders, but traders, they really think they can just get into the market, out of the market, and they don't follow a plan. They don't follow something written down, and it's very, very, very important. I cannot stress that enough. So make yourself do yourself a favor and start writing down things and journalizing your trading routines. Okay. We spoke about focusing on the process and not focusing on the outcome. You really need to be your own benchmark. You need to improve every day, every week, every month, every 10 trades, every 100 trades. You need to honestly put yourself in a starting line, and after 1 month to compare yourself, compare your ratios, compare your results, and then look at what you have to tune in your strategy, on in yourself, your emotions. And if you had break-even month after a losing month, that's progress, correct? And if afterwards you have a slightly better risk-reward ratio than the previous month, that's also progress. You need to acknowledge that, and you need to stop comparing your results against other traders, because we are all different worlds with different skills, different time, different I don't know, family, whatever, okay, depths or not depths. So we all have different lives, and we need to compare. We need to compare to ourselves all the time. Of course, doing that slowly will achieve. You will slowly achieve consistently. That's like the goal, and the money will follow. Okay, and just focus on the process, on taking good trades, following your trading plan, following your strategy. Remember that even when you follow your strategy, you will have good trades that will end up losing money. But that's fine, because you're focusing on the process and not the outcome of the trade. So as long as you did your job and took the trade you needed, the outcome, it's something that the market will decide. Okay, you have no control over that. So focus on taking good process, taking good trades. Backtest. Okay, maybe you're just starting now. I don't know, the background of all of you guys, but you need to be able to trust your strategy. And in order for do that, you need to first backtest it to see if there's some potential in that strategy, then adapt it, tune it to yourself, and then forward test, okay, or real test that strategy, not to make money, but to get trust in your strategy, to know that in the long run your strategy makes money. So if your strategy is working, it has a potential of, it's a profitable strategy, then you only have to work on the other side of the system, which is the trader, which is you. Okay, so we have in a system, we have a trader, and we have the trader, and we have the strategy. So back testing and forward testing, we can have no emotions in place in order to make sure our strategy works for us. And once we know that, then we can trust it, and the trader part of the equation of the system can feel more comfortable taking those trades and those signals, and will be easier. So back testing, demo trade, and then forward trade, and get trust in your strategy. Okay, build confidence in your strategy. Find a mentor or a community to stay accountable to. Okay, the key, from all these talks and meetings I have with these traders, with all the traders, hundreds of traders, the most valuable thing here is to externalize their thoughts. Okay, once you hear yourself thinking or saying what you think, or saying what you think is your problem, and you stay accountable to someone, okay, because many times I have follow-up meetings to someone, so they know right now they have to stay accountable to me. Okay, but when you go to the gym, or when you go to a nutrition or something, and you will meet your coach or your mentor or your group or whatever the next week or in 2 weeks, you have a compromise. Okay, so you need to find a mentor or a community to stay accountable. There are plenty of forums. We have a trade ideas page where you can try to find a match or a friend or something to be your mate. And the key message here is to stay accountable to someone that will help you with the discipline. Okay, once you have to take a trade or not to take a trade, and you should not take the trade, once you think you will have to explain that to someone else in the future, you won't take the trade you shouldn't. Okay, so it's very, very important you find a community or a mentor to stay accountable to. That will help you with the discipline. Meditate. I don't know if you connect with that. You don't have to go to mindfulness or any specific thing, but just breathe. Okay, that's the key. Relax your mind. Breathe before your trading session. Breathe during your trading session. Breathe after the trading session. Okay, keep your mind relaxed, so you don't have you don't have to. That will help you with the emotions. Okay, trying to trigger in. That will help you a lot. I was very skeptical of this until I tried it. I heard of Ray Dalio saying that he he started meditating. So if Warren Buffett and Ray Dalio and all of those big traders, they meditate constantly, so why shouldn't I? So I started, and I really connected to this. I don't do long meditations, but just a few minutes of breathe, okay, exercises before my trading has really helped me out. Maybe last, it's hard. I know it's hard. It's part of our lives, but you need to drop social media. Especially you need to stop social media when you see, flash fancy cars and traders showing profit months of $100,000. That's something that's, again, unrealistic. Most of those are fake. Most of YouTube videos or TikTok videos or whatever, they're just looking for SEO, and they're looking for traffic into the channels to get revenues from YouTube or TikTok or wherever. And those really cause you to think you can get those same results. And again, we don't know, even if they're real, their strategy or their system might not be the one you need. So you really need to, or you guys really need to stop creating or comparing yourself to what you see on social media. That only causes a lot of stress. And again, going back to compare yourself to yourself. You are your own benchmark. I'll take, if there's some question, guys, I will be glad to take that. Again, the message here is to start developing good habits in order to get rid of the bad habits. Sholani, does the 5ers have a trading community? We have a lot of channels when you can create community or a mate or something. We have a trade ideas page where you can find traders that maybe trade like you, and you can contact them. We have a Facebook page when you can throw ideas and get some feedback, or find someone who's willing to get into a Telegram or WhatsApp group or something. So we are trying all the time to get to create a community of traders, and we have some projects in mind that will be very disruptive to the industry. So we're really working hard to get that in place. So yes, I would like to think of the 5ers as a community of traders. Edwin Jansen, how do you handle emotions during a trading session? How do you detect them, and how do you cope with them? Are emotions always bad during trading or not? Those have a mentor coach we can talk to. Yeah, John, if you join the 5ers, you can get with a portfolio analyst. Sometimes it's me. There are other guys here that do those stocks, and you can have some help with that. The slide before, of course, let me go back one slide. Okay, so you have it. Handling emotions. Again, ideally, we do have this emotion, and we have to recognize them and acknowledge those, but we have to have a plan of what to do once we detect those emotions. So ideally, you have a trading strategy or a trading plan where you feel comfortable, so the emotions or the need to do something is not triggered. And once in your trading plan you have to have that path, okay, or that plan. If I take a trade and I feel uncomfortable, then I will close. Or if I feel if I'm feeling overconfident, I will stay out of my computer. Or okay, you have like a map to follow once you identify those strategies, those emotions. It's not something, we cannot erase our emotions. We're humans and we have the emotions, but certain circumstances in the market trigger certain emotions which are different in all of us. So I don't have a clear answer to give to you because my emotions are different to yours. But once you feel that emotions, write it down, and for the next time, decide what are you going to do once you feel that same emotion in place. Okay, emotions, they are not always bad in trading, but again, we don't want our emotions to interfere to our trading. So we have to have a plan, an emotion and a plan for our trading routine and our trading session. Okay, it's realistic to reach the 6% target when I risk only have 1% per trade. Of course, we have many traders risking less than that, risking less than 0.5% per trade, and they get to the target. If you have a good risk reward ratio, then one trade would give you more than 1% of profit, and you would be on your way to the 6%. If I was asking you to make that 6% in 2 weeks, maybe that was unrealistic. But that's why we have, we try to not pressure our traders. And when you have 6 months to get into the target, and if you need more time, just request it, and I will give you more. Okay, as long as you're profitable. We don't want to put pressure on our traders. Yeah, it really is an invitation to research your emotions. There are plenty of books, trading in the book, trading the zone, markets, what's the name? Market games. Oh, I'll throw that in the description. There's a lot of books on emotions. It's very helpful to read. Gulden, how can we understand we are over trading? Backwards, you can see your chart. Okay, I show you the charts, how they look in real time. I guess you will. The problem is not realizing you are over trading. The problem is to stop. Many times it's too late to. Once you realize you're over trading and you stop, that's too late. The damage is done. So the first time that happens to you, that's fine. Just remember that and write that down and commit to not do that mistake again. Okay, all bike riders will fall off the bike at some times. All traders will blow accounts at some point. That has to be a lection and something you get message of and something you learn. Okay, you learn of. Manu, can I give features for a good entry point? No, it's not. It really depends on the strategy and the system you're following. It's not something I can give you. I know for my strategy what's a good or bad entry point, but it's something that will depend on your strategy. Okay. Yeah. Thank you, Leon. Market minds game in this show. That's the one I was looking for. Market wizards. Okay. Yeah. Great. Thank you. How do we access our progress chart to the 5ers? You have, if you go here, so you have the dashboard, and you go to your chart. Okay. Guys, has been a pleasure. Almost 40 minutes here with you, spending this time with you. If you have any question, you know how to reach out to us. Send us an email. Samuel, what's your question? Maybe I missed it. Okay, just leave it here again. I guess I missed it. But if you retype it, I will. Time frame for consistent in trading. Again, Samuel, is something very individual. There's no better or worse time frame. My advice is, if you have less time in front of the chart, go to the larger time frames. If you have a lot of time to spend in front of the charts, then you can go to lower time frames. But the market behavior is timeless. Okay, time frame is something we know from our trading platforms. The market does not respond to those time frames, so the time frame is really not the issue here. Okay, you can get consistent at all time frames. You need to find the one you feel comfortable with. Okay, and that suits your lifestyle. Audrey, yeah, you can feel free to email 5ers if you need more time on your evaluation. Just do that. Guys, thank you very much. We'll get the YouTube recording, and you'll have the resources there as well. As always, happy trading, and see you next week. Bye bye, guys. Thank you.
Good day, everyone. Thank you so much for showing up for the first webinar, our in-house webinar, and we see a lot of participants. Thank you so much for coming here. My name is Gil. I'm from the 5ers Trading Fund, and today we're going to talk about supply and demand. This is the method of trading and market analysis that I mastered in the past decade or so, even more. And I truly believe that the whole concept of supply and demand is very, very valuable for anyone to understand. Well, let's start dive in, and just give me your write me on the chat how much you are familiar with supply and demand, and so we know how to run with this with the content and how much we can go in depth. Okay, so supply and demand is actually a way of reading charts and understanding the market forces. What it means is that, hold on a sec. Okay, so today what we're going to cover in terms of supply and demand is, first we're going to discuss the theory and how we can really understand and clear out all the noise and all the misunderstanding of looking at or glazing at charts that don't tell us anything. I promise you that by supply and demand theory, you will be very much understanding why price is acting the way it is, why it's moving in a zigzag way, why are the zigzags are, why the turning points are where they are. A lot of information can be told just by understanding the very core concept of supply and demand. So we'll cover this. That will going to give us a lot of understanding about price action, like I said, and then we'll see how we can take this understanding and create trades, actually build a trade structure with a stop loss, with the entry, with the profit target. And if we'll have enough time, we will dive into more advanced concepts of supply and demand, because it's really, it goes from the very core basic into a very complex understanding and methods that you can apply. One thing that you should know about supply and demand, it is mainly made for working for very liquidate markets like the Forex, the main commodities, the indexes, the top stocks that are very highly liquidated. So supply and demand really works on these assets. If there's the thin liquidity assets that are very exposed to manipulation, it will not work. So just bear in mind that the supply and demand theory works where there are masses, huge amounts of liquidity. So these are the markets that it's going to work. It's a timeless method, and we'll talk about this. So now let's just take a look at this chart. There are no indicators in it. There's nothing. For most people, before they actually get familiarized with supply and demand, this kind of charts look like a noise, look like very much like a random. I really hope that within this very seminar, within just 1 hour, we will be able to create a lot of logic into what happened in this chart in terms of the micro moves, all these little spikes. They all have reason that can be explained by the theory of supply and demand. And the breaking points, the respecting or the turning point, the where price is breaking levels, everything can be explained with a very simple understanding of what is supply and demand. So I really hope that this got you intrigued, because once you can take a look at a naked chart with no extras mathematics applied on it as indicators or different black box solutions. Once you will have this understanding, this will be a priceless add-on to whatever you already understand about the market. So the first thing to understand, and people tend to forget, that the market is a presentation. It reflects a real living, a real life behind the matrix. It's not just prices moving. It's not just about manipulations. Everything is being reflected by true events that are behind the market. The market is just presenting to us whatever happening in the globe. So just remember that every tick that you're seeing in the chart, every new price coming into your platform is actually a trade made somewhere on this globe between two sides. One is a seller, one is a buyer. They both agree upon price and quantity, and then there is a match. Then the central exchange will be matching these two incentives into one deal, and that will be broadcasted to our platform as a tick, as a new quote that comes in the market, and it will be added to our candlesticks or whatever we are looking at in terms of graphics. So just remember, every piece of information that comes in, it's a real trade, okay? And what we are actually trying to figure out in the market every time is, what is the balance? Right, we have a trade made by a seller and a buyer. And just imagine, try to illustrate this image that we're looking at. One side is a buyer, one side is a seller. If they agree on price and quantity, they would be shaking hands and not trying to push each other to the other side. Now, just try to imagine what happened in terms of the masses that coming with different intentions into the market. One side are wanting to buy the market, one side is wanting to sell. The very person from the last slide, from this slide, one of them bought the asset, and now he wants to push the market up, and once saw the market, he expects the price to go down. Okay, so the supply and demand is the actual balance between buyers and sellers. As long as the buyers and sellers having the same force pressed on each other, we will see that equilibrium situation like we're seeing now. Both hands at the same place, nobody is out winning the other. But if somebody presses harder than the other and one side become weaker or more tired, the other side will win. This is exactly what happened in terms of supply and demand. It's called order flow. And once one side will win the other side, price will move the very same way that the hands will move to one side or another. So there are more ways to illustrate this, but just think of what is actually happening at the exchange, and I will refer to your question, Edwin, in a moment, that the Forex market is not centralized one, but what happened in the market, in every market, is that at the same very price, we have many participants with different goals. Some want to buy, some want to sell. So imagine at a very certain price, they are broadcasting their orders, their desires to what they want to do in the market. They are sending their orders. So they would send a buy order or a sell order for the same asset at a specific price. With this illustration, we're seeing a situation where so many participants will be sending sell orders, and slightly more people will ask to buy the asset. So what will happen now is that I'm sorry, is that the market, the exchange will start matching from bottom to top all these files, and imagine that each file is the same quantity request. A buyer and a seller are matched, a buyer and a seller matched, a buyer and a seller match, and every time there is a match, another 2 files are disappearing from the table. Eventually, at one point, we will have the last buyer meeting the last sellers, and there are going to be no longer sellers while there are leftovers of buyers in the market with no sellers to fulfill their request. Okay, so this is the time where price is going to move somewhere, because if now we don't have any sellers at specific price, what do you think will happen to price? The exchange will drive price a little bit higher until they will find new willing sellers to sell at higher price, right? At higher bid. Okay, so every time we have this situation where we have more buyers than sellers, price will move up. If the opposite would happen, if there are going to be more sellers than buyers, the exchange will drive price down until they find more buyers willing to buy at cheaper price. Okay, so this is the very core mechanism of how the market works. And if you think about this, it's every market. It's not just the very high-tech markets of the financial markets. It can also be the tomato markets. It can also be real estate market. It's just about what's happening in people's mind. If you're about to buy a house in a certain neighborhood, in a certain street, and you know that the last deal on this street was at specific price, you would not be willing to buy it at higher rate, or and the seller would not be willing to sell you at less price, right? So everything is derived from the last events. But if at some reason somebody will say, and on this neighborhood, somebody very, let's say a big celebrity bought the house, now everybody wants to buy, not depending on the market price. They are willing to bid more for the houses, then price will rise. Everything is derived by the balance of supply and demand. How much people are demanding to buy versus how much people are willing to sell the asset. So this is the order flow, which is equivalent phrase for supply and demand. Okay, so now when we look at the market, we are trying to read a story of the market and try to understand what happened. Where is that situation where a leftover orders were not fulfilled? Because we know that when price will come back to this price, there are certain amount of orders with high probability laying down there to be executed. So we want to know where was that situation where we have these leftover orders, because if we are going to sell where we know there are buyers in it, we will definitely get our execution, right? So when we going to look at the market, we are going, it's very easy to take this image and figure out where was that place, where was that line on the chart, and where was that? Right where price origin a drop or a rise. We see that price is ranging at a certain zone, and then suddenly price pushing upward. What happened here is there are more buyers exceeding the sellers. There are no sellers anymore, and therefore price will rise up. Okay, so that point is for sure where we know there are buyers willing to buy, and there were no longer sellers to give them orders. This is why the market had made price going to higher places. Okay, it's only when new sellers came into the market where price will start ranging, and then when price was coming back to this area of the decision to break higher, we have seen reaction and another balance situation between buyers and sellers. So what we're going to be trying to look at is the story of where buyers and sellers were agreeing, meaning range, or in terms of the supply and demand, we call it base, and where buyers and sellers didn't agree on price and didn't find fulfillment, and one side won the other. So that will be wherever we see price drop or price rise. Okay, so it's that easy. This is why we don't need any indicators to tell us what is happening in the market. And while we're looking at the history, we will make some illustration of what happened in the history, and we will see how we can forecast with a bigger probability for the outcome in the future. So we will use historical charts to try to prove that, and then we can do this in live. So we are looking to find the decision points. The decision of the decision are where price, where one side had won the other. Okay, so how we do it? First, we are going to look for the impulses in the market. Every time we see price dropping or rallying up, this is, we know for sure that there was a decision. One side won the other. Very simple to spot, right? So here we saw the sellers won the buyers over and over, and therefore price is dropping. Okay, so we see a very strong impulse down. We know there are more sellers than buyers around here, but where would that be the very accurate place for them to time our best and accurate entry? We'll discuss this in a second, but let's see more impulses. Every time we see price dropping and after a price basing, this is where we can look up for the second stage to decide where is the decision point. Okay, so every time we see an impulse, a base and an impulse, that is where we are going to drill in and look for a decision point. So see how many impulses we have, and that's the only thing that matters in terms of charts. Okay, so now drilling in, and we see price was climbing up, basing for a while, and then dropping. Okay, where will be the decision point that we're looking for? Where will be this situation where there are no longer sellers, but there are buyers, or in the chart that we're seeing now, where will be the sellers that didn't have enough buyers, therefore price went down. So we see price pacing, and then from this bar and on, we see price is dropping and never coming back to this area. So the first breakout that we can see, it's right about below this pin bar candle. So that will be, here will be our decision point, and we will mark the supply zone, the full range on top. So everything and above the highest price would be the zone that we call supply. Okay, and that is the decision point. Okay, when then we stretch that line all the way to the future, and we're going to look what is the outcome for when price at the first time approach and hit this this decision point price. Remember that illustration again. At this situation, we had more sellers files on the desk of the exchange more than the buyers. That means that some of the sellers files were not fulfilled. They are waiting there because they didn't have any fulfillment. They are waiting to be executed. So next time price is coming, a reaction is happening here in a very accurate way. Okay, now we're looking at copper commodity. So when a decision point is hit only for the first time, we have the highest probability for price to have a reaction at this very price, and see how accurate it is. Marco is asking, they wait for a week? Yes, they wait for a week. They can wait for a year, for years. It doesn't really matter, because this decision is not just orders that are there at the table on left. There are also mental pricing that institutions are considering. It's there are a lot of reasons why this this decision point would be active. But yes, they are waiting for endless amount of time. It can be very quick, and I will show you that, and it can be very late in the future. But bear with me on that. Don't consider time, just consider if the decision level was never being tested before, it will provide a high probability reaction, not yet a reversal, but a reaction. If you see all these different wicks and turning points while price is progressing to some direction, they are all have reasons in terms of supply and demand in order flow. These are reactions that occurs upon order flow waiting to be fulfilled. Okay, so that explains everything. So in order to explain these, we will have to drill down into different time frames. Now we're seeing H4, but we can go all the way to to 1 minute or tick chart to really understand why this price is actually reacting. And you see price is reacting to this decision. We have here a decision for price to go up, and if we'll mark this price, I hope it's horizontal, we see that price had created had made a reaction in this. It wasn't a reversal, but the very first time it hit a fresh demand zone, a fresh order flow of demand orders, a reaction was occurring on the market, and then price continue, and the next time price is testing the very same level, it crushes in, and then it finds a lower level where demand could be found. Probably we could see the decision. We will probably be able to see the decision on a lower time frame, not H4 like we're seeing now, but this explains, would explain, if you drill down, you will see the reasoning for why price is reacting. So every spike you see on the market is a reaction for something, for order flow, okay? Okay, let's continue. Okay, same thing for demand. We see that demand is was created here, and then when price was moving up and then returning to this demand very quick, it made a reaction. Okay, so this is also explained if you're familiar with support become resistance and resistance become support after a breakout. This is exactly what explains it. Okay, we have a decision point for price to go higher, and then price immediately turn and touch the very first time, and then a reaction and continuation. Okay, at this specific situation, price was visiting the third time and made a reaction, and then at the fourth time it created a reaction, but not because of this zone, but because it was there was a new zone created on top of this one, and this first time visit is a reaction for the new zone just created and moved up. Okay, and another thing to observe and to understand is that after we were hitting a fresh supply, like in this situation, just imagine these files being now consumed by these sellers. Okay, we have a buyers, we have sell orders waiting at the desk, and more buyers are coming, and now the sellers create a reaction, but the pile on the desk there is getting lower now. So now with more force of buyers coming up, price was managed to push further inside the zone and find a new resistance at higher place, probably because we see H4. If we will drill down to lower time frame, we will probably see the decision point made on a lower time frame that was actually creating this reaction, okay, on the very top. So few things to understand about supply and demand. First, we are looking for the impulses, then we're looking for the decision from where price was originating that impulse. That will tell us where is the decision point, and where are those order flow packets waiting to be executed in the future. Then in our trade plan, what we're looking for is only to take the very initial and first time that zone was tested, whether it was a very long time after, like a week or a month or a year, or at the very instant after price made that decision. So that will deviolate the zone for good once it was tested, no matter what the time is. Okay, so if we are looking for our trading plan checklist in terms of supply and demand, we know only for sure that not for sure, nothing is for sure in the markets, but we will know with high probability that the very first test of a decision point will give us high probability reaction. That's it, just a reaction. We don't know more than that. Okay, we don't know if it's going to be a reversal or not. A reaction will happen. Okay, another thing about reversal, a lot of traders are trying to anticipate and forecast reversals. Even if we have a reversal at some point, usually the price will struggle for a while at that level before it will turn out to a true reversal. So at first we'll see a reaction and then more push into that zone and more retesting before the reversal evolve and actually going to be accomplished. So so even if you are looking for reversals in terms of supply and demand, you don't really have to take the very first initiative on the fresh zone because we will have more price action formats to tell us if we have a confirmation for reversal once we were hitting a fresh zone at the extremes. So don't expect to take a reversal from the very first test of a zone. A reversal require price action confirmation, and that also can be derived by the order flow supply and demand theory. Okay, so how can we build a trade? So we are going to buy the decision point, and our risk will be just below the lower swing of that zone. Okay, so that will dictate us the risk unit that we're willing to take. So just mind that if you're on a higher time frame, the zones will be much wider, so you will be risking more pips, but you would probably going to look for higher swings range. Edwin asking, does confirmation provide higher probability then? Yes, confirmation will provide higher probability, but with higher probability, you will also get less entries because if you're waiting to confirmation, not always the confirmation will come in the formation that you're looking for. So therefore, you will be missing some trades. But I advise everyone that coming with solid discipline to be able to afford yourself to miss out opportunities by sticking to your plan and not be tempted. So whether you use confirmation, you will have less entries, but if you don't use confirmation, you probably will have less win rate. So you will have to compensate that with a better risk management or a better entry profile. So these are things to consider. It really depends on your personality or how you are approaching your trading in general. Okay, so just look at what happened when price had created a demand, and then demand was executed, and we have our risk unit that had created us 3-to-1 potential. Okay, I'm not saying that we know how to take the full 3-to-1 for sure, but just to show you that as much as we buy the dips and sell the peaks, as much as we do this, we will naturally going to improve our risk reward ratio. Okay, so eventually, remember that new demand that was created here, it's probably more or less the same risk. Now the full swing had provided us a potential of 5-to-1. Again, we can't really be sure that price will go there, but since it's a fresh supply there, that would be a very wise place to end a buy order right there. So that had provided us 5-to-1 risk reward ratio. Okay, so that's only the potential. All I want to show you. For the sell order, we have a decision for price to go lower, so that would be a sell. Okay, the entry will be at the decision level. The stop loss will be just above the swing high. That will be the whole zone, and the whole zone will be the risk unit. Okay, and that risk unit, that is one risk unit. And let's see what was the potential reaction on this. Okay, so we have 3-to-1 risk reward ratio that had happened there. Okay, so now I'm not sure I understand the question, Edwin, but I really resonance by your willing to understand the why. This is exactly the reason I like supply and demand, because supply and demand really provides why price is doing such and such. Okay, so diving into the supply and demand order flow theory will give you a lot of explanation for why price is doing whatever it's doing, why it's spiking, why it's breaking levels, why it's not. So with just the things that we've just learned today, we would know that once a fresh level was touched for the very first time, we can expect a reaction. Okay, so we can scalp this reaction or take a few pips from that reaction. We can also expect that if a price was already testing a zone, that it's no longer a valid zone, and therefore there's a higher probability for this zone to be broken. So that gives us another new information about this zone. So there's and we see this example for price pushing up into the zone, and maybe later on, if price was testing again, it will penetrate more inside. Okay, so now we have like 20 minutes, and let's just hop into charts and see how we can actually analyze more supply and demand situation and try to learn a few more concepts on top of this. Let me switch to the charts. Okay. Everyone is seeing the charts now? Richard is asking a question about 6-to-1 leverage. It's not relevant to supply and demand because the leverage, you say you use 200-to-1, but I bet you never use actual 100 to 1 trades. If you did with just one slight percent against you, you'll be wiping your account. So that's not really a good risk management. But anyway, 6-to-1 leverage is not, it's not risk reward ratio what we're discussing here. I'll be happy to explain to you the leverage issue if you contact us on support, and we can also set up a call, and I can explain to you in specific regarding to that. Okay. Okay, so we're seeing a chart now. We're looking at euro, dollar, yen. Okay, and now we're looking at a naked chart, and what we want to do here is try to read the narrative, read the story of what happened on this chart based on the hourly candles. And you see that I'm usually using very condensed charts, because I don't really care for the candle formation, if it's harami or pin bar or whatever. What I really care is about the extremes and what was the effort versus the results of these extremes. So all I care are just horizontal lines, okay? So we see here price coming from the top, and we see price is flagging. We see it's a pull and flag, and this flag is actually what we call a base, right? Okay, so that creates, so that is a demand of its own. And when price was turning, going back, it was actually reacted to this supply. Okay, next we have, let me just see if we can, okay. Now price is basing and creating a decision right about here, okay? So that's create another supply right here on this here, and this is the swing. And then next time price was testing this supply, we see a reaction. So we got the reaction already. So now, once we got the reaction, this one is no longer valid. Let me see if I have this. Never mind, I don't have that X, this thing. I wanted to, this one, okay? We have no longer have this zone. So this zone is already being taken, okay? So it's no longer exists. Now let's continue. So we see price is dropping, and another base and a decision made right here. Okay, so let's take our, so decision was made right here. Okay, now price was penetrating very strongly into the zone, but it was not really violating this, and it did create a reaction. Not a great reaction, but it did. But it also didn't take our stop after it was making our reaction, okay? And then when price was coming back to this zone, it's no longer a valid supply zone, therefore price can break it up. Okay, so just see how much information it gave us, so we can take for a high probability this reaction to scalp. Maybe it didn't made it to a mature trade, but it did give us a reaction of some way. And next time price is testing this, we know this zone is no longer valid, so we know to stay back from selling this again, okay? Because price was pinching very, very deep inside, okay? Next thing, price was dropping. We have another decision right here. Okay, and then when price was breaking down, it was touching here, and then it disqualified this zone for good. So we have this reaction back down, and it's no longer exists. Same thing on this decision right here, and then a very fast reaction, and it's no longer exists as supply. Okay, so next time price coming in to this zone, it's no longer valid, so we know to stay away, and we're not going to take a sell from these levels any longer because we had our first touch. Let me just read questions. Some price action gurus teaching fake out stop loss hunting strategy, and it seems to be valid theory. My question is, do you think it's compatible to trade supply and demand like you do and trade a fake out? Okay. Well, the funny thing about stop loss hunting is that when you are being taught about these fake outs, is that they're not actually giving you a reliable price to say, let's sell from it. If you going to learn supply and demand in more depth, you would understand that when price is faking out, let's say it's faking out this level, it will fake out until it has a good reason to bounce from. So if you go always to the left, you will see there's another low time frame decision point up here, and that would be explaining why price was actually pushing through, breaking out, and reacting at a slightly higher level on this instance. So if you want to add more reasoning to the stop loss hunting so-called strategy, just look further to the left and see what more levels of hidden waiting packets of orders up there, and you will understand why price is faking out a specific level and then dropping. It's not just because they hunt stops. It's because the ignorant traders would put stops right here, so that would be also stopping this their trades, but and creating another packets of resistance on top of the swing. But also because there is historical waiting packets of orders waiting up there. So there is always a reasoning why price will be turning, whether it's a fake out or not. So so supply and demand will help you to understand where was that exact reason and price for the turning point. Hope I gave you a good answer, Nathan. Richard. Edwin is a bit confused. So if it hits the second time, it creates a new base again at the same spot. I guess you need a trailing stop loss then beside the 3-to-1 target. Two things I must correct you, Edwin. First, 3-to-1 target is not a definite. It's price action will tell you what is the potential range that you can ask from your trade. So there's sometimes it's going to be 2-to-1, sometimes it's going to be 10-to-1. It really depends on what price action is providing you, on what is the approach range that it's coming from. So that's one misunderstanding, and I hope you will fix this. The second thing is we will discuss this in a moment, or if you will attend my trading rooms, I really discuss this a lot, where I try to analyze the effort versus the result, and that also will show us where we have a valid supply and demand that we can play upon, and if we see a fresh supply or a fresh demand that we can play with. So that's a few rules that will help us to leave out misleading zones that can be seen visually, but with adding more logic into it, that would be helping us to avoid risky trades. Richard is asking, what do I recommend if we see stacking zones on top, one on top of each other? So there is a very simple rule to that. If we have, like we see here, supply and then another supply really stacked one on top of each other, I would tend to take whenever I see a fresh one, okay, a fresh zone. So if we see that price was hitting this supply, this supply is no longer valid as from this test, okay? So I don't consider this as a supply. And now I just eliminated one supply from the equation, and I don't have to really debate which one give me better probability. Then the simple rule is if it's a fresh, never tested zone, therefore I can take it. So even if it's in a lower position, a lower price, it's still fresh, so I can expect a reaction, so I get the reaction from it. So that's the only thumb rule I can tell you. In terms of Quasimodo level and patterns, we'll discuss this in more depth in our trading room. I think it's too much for this session. We already an hour inside this this webinar. Anyway, so continuing with the supply, we have another price. Let's okay, got this. Okay, so we have price ranging down, and now we have another decision. Now the decision is to come up. Okay, so the decision is right here. We're going to stretch the whole swing right here, and the decision here, and stretching it for the very initial approach. So we got this retest on this test on this demand, and therefore this demand is no longer exist after this price. So we see in that sense, here is another, I'll get to the point in a second. So we have another range right here full range, price is ranging, and a decision made about here. Okay, so we stretch this. So now price was almost touching my decision point line, and there's two lessons to be discussed here. One, we can ignore this attempt and the fact that it didn't touch, and just stretch it wider, and it will provide somewhat, but it will be wrong to do so, because now we have different views of price action, and we don't really know where is that precision decision made. Okay, so if we have this decision point on H1, maybe on M15, we will see a lower decision that was made this effect. And we also see that price in terms of lower time frame, price was going down, flagging up, and continue. So we have this whole structure of pole and flag right here. So that's the one, and this is the reaction for this. And you see that it's within the decision of that flag that it was already reacted. So the lesson to be learned here is that, and I know it's a little bit confusing, but I'm sorry, that's a fact about the living daily of the supply and demand. If that's, we can draw supply and demand by the decision point like I'm drawing, but we can also be more conservative and taking the whole range from the lowest swing, the up, and the breaking of the lowest swing. So this is what I did with the pole and the flag formation. And that was the reaction for this. So in that sense, this decision point is the same structure of this pole and flag. It is actually the same packet already being consumed. So yet we didn't get this as a trade, but it did this valid that supply right here. Okay, so we didn't get a trade because we were looking for a higher entry for our short sell, but it's still taken the orders out there. I mean, the price action had shown us that the packet was waiting a little bit lower. So that's a miss of a trade, but still the logic is there, and it tells us to avoid taking that trade at the other attempt. Eventually, if we did ignore it, we would get a reaction and a bailout opportunity from a bad trade. And even if we were holding this, price went only halfway into the zone, into our risk zone, and that was okay. And we would get a reaction. So we wouldn't been busted on this trade, but this is the logic behind this thing. So it's another lesson to be learned from this situation. Okay, so now we have this demand, reaction to demand, and then price is trying to push up and breaking this formation, this supply. Okay, let's just leave it out so it's going to be easier to be seen. And now price is pushing back. So now we're looking at a situation where I call it effort versus result. We see that price was not able to break higher by um, by um, finding support on demand. And so we see a demand respected, but not being able to break supply. So, and then price was going to lower places. So we still, so this is the forces that we're going to be looking at all of the time. We want to see that price is being held by one side, the supply side or the demand side, and we want to see that price manage to break the opposite side. Okay, if it can't, it tells us something. Okay, at this situation, price was making a deeper push that is eventually turned out to be a fake out of some reason. If we want to understand why it is so, we usually take a full horizontal line and put it on the swing extreme, high or low, and then we go to the left and see what was the reaction for. And we see we have here a fresh demand, right? A fresh demand that price was actually reacting from here. So every time we go left, we have a way to understand why price had decided to stop here. I'm not saying that every time we would know how to forecast ourselves into buying this or to have this as a trade, but having this in mind all of the time and having the ongoing practice of always trying to explain yourself, why is this swing high just stopped here, and why this happened, why the turn that happened here, and go to the left and see why it was like that. This is the practical, the routine practice that will help you truly understand price in the naked form of supply and demand. So I see a lot of people are losing patience. So I suppose we will have to schedule another meeting with more, with discussing more advanced stuff. So thank you so much for being here today. And yeah, we'll set more webinars like this so we can discuss more in-depth stuff on supply and demand. Remember, supply and demand is something that you have to practice yourself. It's a reading concept, and it's complementary to any other strategy, whether you're using any indicators on your charts. It doesn't conflict anything. It just gives you another view for understanding the price, and maybe to keep you out of trouble or to have more confluence to your decision making with your other strategies. So that's on the tip of the fork, the supply and demand theory. And the same way we've discussed supply, and we've discussed in some cases no supply, no demand zones after violation. There are more theories derived from this very core understanding. So we'll set up, schedule more events like this so we can dive deep inside. Meanwhile, we've covered these topics in few different occasions, so you can hop into our video area on our website or on our YouTube channel and learn more about this. And there are also a lot of information about supply and demand with different approaches from mine on the internet. So I hope that intrigued your imagination and the things that you can apply from it. And thank you for showing up today. And we'll see you next time, next Thursday. We have another webinar by Sneer or by Saul. I forgot the schedule, but make sure to come along and learn some more different views on the markets. Okay. Thank you guys. Have a good week ahead, and we'll see you next Thursday, and next Monday we'll have another trading room. Take care, guys. Bye-bye.
Okay, guys, welcome. Thank you for being here. What I'm going to do is I'm going to send through a link into the chat. This is a Google Drive folder that has, first and foremost, the presentation from today. Now, I'm going to go through and give as much value as I can in an hour presentation. You guys may choose to take notes on that. Let me just send this in the chat. Now, you may choose to take notes from the presentation. I encourage you to. And then that way you also have the notes from the presentation as well. But I'm going to be going on slight tangents throughout the presentation. So I think it'll be wise to also take notes, pen and paper. And the other thing you have in that Google Drive is a toolkit that we're actually going to be running through today. So to just give you an idea of the next hour, we're going to do about 30 minutes of theory. I'm going to blitz through some theory, give you guys some ideas to think, really pass on some transformative ideas. We're going to spend about 15 minutes working through a tool and exercise together so you guys get actual practical value to your trading and your lives in the next hour. And then for the last 15 minutes, I'm going to answer questions from you guys on all things trading related. Any questions on, you know, how to help gain consistency in funding or deal with emotions and that type of stuff. So have a look through that Google Drive, get that open, get the tool out. But for now, I'm going to get started on the presentation and we'll bring that up very, very shortly. And we do have time for questions at the end, but if you have questions throughout, be sure to fire them through. I'm just not 100% sure I'll see them immediately, but I'll eventually get them. I'll eventually get to them. Okay. So let's get started. Okay, good. So I'm assuming you guys can see this. I don't really have confirmation. Okay, excellent. Great. So welcome to today's presentation. We're going to be talking about how to thrive in uncertain times. Now, this presentation will be related to trading specifically, but I'm going to be branching into the other 7 areas of your life as well, and passing on a presentation that won't only help you improve in your trading, your consistency and bottom line in your trading, but it's also going to help improve all areas of your life. My name is Pat Baylooney, by the way, and it's great to have you guys here today. So thank you for being part of this presentation. Now, really quickly, I wanted to go into a little bit of detail about who I am and I guess why I'm here today and what value I'm going to be sharing with you. I've been trading for the last 5+ years now, nearly at my 6th year of trading. I'm going to trade a range of markets, but predominantly FX markets. And I have experienced the ups and downs in my trading. What I mean by that is I've had good results. I've also had very poor results in my trading. I've gotten funded. I've also lost funding. And I've seen both positive and negative repercussions of being a trader in society. So I think I'm in a good position to give you guys an objective overview and objective insights in how to improve your trading and what it's really about. Now, it was early on in my journey, probably year 1 or year 2, where I really recognized that after I knew my strategy, after I knew where to put my entry point, my exit point, and my take profits, the one thing that would stop me from executing on that strategy flawlessly and gaining consistency, getting funding, all that type of stuff would be myself. I would be the only thing stopping me from going off and doing that flawlessly. So it was about year 2 of my trading career that I went off and I put a big focus on studying psychology and human behavior. And there's one particular, I guess we call a mentor or a teacher that I gravitated towards and I learned a lot from, and that's Dr. John DeMartini. Some of you guys may or may not be familiar with him, but I pretty much took a lot of his principles, his DeMartini method and DeMartini values, and I implemented those things into my trading to, at the end of the day, just improve as a trader. And it very naturally moved on to me helping people here and there. And then it very naturally moved more into a coaching role where I started to coach other traders. And that also naturally moved into me consulting for trading education companies and doing things like this, helping guys and girls to improve their trading results. So from my own trading experience to my own learnings of psychology and human behavior, to then consulting and coaching. And I really am, I guess my mission as a consultant is to progress serious traders. I really want to work with traders like, I know a lot of you guys and girls in here are very serious about your trading goals. I want to work with you and pass these insights on to you to help you achieve your goals and overcome the challenges. And I know today's presentation is really going to be the start to help you guys think a little bit differently and achieve your trading goals. Now, very quickly, I'm sure a lot of you guys recognize this is why you're here today, but I also wanted to give my overview of why I believe trading mindset is so important. Your psychology will take you from a good to great trader. And what I mean by that, like I mentioned before, once you know your entry points and your exit points, the one thing that stops you from executing on that flawlessly is yourself. It's the emotions, it's the fear and greed, it's the procrastination and lacking of discipline. It's all the psychological components that stop you from executing flawlessly on what it is you know you need to execute on. So going in and mastering your mindset, so to speak, which is I'm going to show you some principles today, will take you from a good trader to a great trader, one that consistently and persistently executes on their setups and as a result has great results. Now, mastering your mindset is also going to help you lower your stress and emotional volatilities in the market. And every single trader knows that trading can be stressful. It can really take and be extremely draining. And as a result, if you're stressed and emotional in the markets, you can have poor decision-making and be making a lot of mistakes. So mastering your mindset and lowering your stress and emotional volatilities is also going to help improve your decision-making and lower the mistakes you make in the market. And as a result, it's going to help you maintain consistency in results. It's all about bottom line and funding. I know a lot of you guys are either funded or looking to get funded. I assure you, if you don't already pay attention to or work on your mindset, implementing that principle into your trading is what's going to take you to the next level, either to help you get funded or to help you maintain the funding you have and continue to grow that. Now, every trader also recognizes that when you have a poor trading day or a poor trading week or a poor trading month or year, that can really influence and impact the way you view yourself, the way you view your life, the way you view the other 7 areas of your life as well. So mastering your trading mindset, having tools and principles in place, is also going to help you increase the appreciation for yourself and your own life. And as a result, because every trader knows that when they have poor trading results, that can impact relationships, it can impact health and fitness goals, it can impact business and work, it can impact your learning, it can impact all areas of your life. Being able to master your trading mindset and take on principles and have those in your life is going to help you improve in all areas of your life. Because if you don't put those things in place, trading is going to impact them negatively. So this is why I believe trading mindset is so important and why I'm really glad that you guys have come here today so I can pass on some principles to help you empower that part of your life. Okay, good. And good to see more people have jumped on. So welcome, guys, those of you just jumped on. Now, today's presentation is all about thriving in uncertain times. And I very much recognize that now, 2021, is very much an uncertain time for many reasons, for things going on in the world and for things in the financial markets as well. It's very much an uncertain time. So what I would love to start this presentation by saying is, irrespective of what happens in the external world, things like COVID, poor trading results in your own trading, market crashes, market booms, no COVID, irrespective of what happens in the external world, we only have control over three things. We only ever have control over three things. Firstly is our perceptions. We have no control over what happens out there in the external world. We have no control over what happens in the market, but we have full control over how we perceive what happens out there and how we perceive what happens in the market. We have no control over what happens out there in the external world and the markets, but we have full control over our own decisions when we go off and trade and when we go off and make decisions in our life. And so too with our actions as well. We have full control over our actions. So we have control over three things only: our perceptions, our decisions, and our actions. And today's presentation is really about taking full advantage and mastering, in a sense, these three things and taking full control over what you have control over. So when everybody else is going around blaming the external world and getting caught up in a lot of the noise, you're consistently and persistently chipping away at what you have full control over and building momentum. And I know, and I've seen this with clients over and over again, those who are focused and focused on the things they have full control over are the ones who build momentum when, in a sense, the rest of the world is, really struggling. So what I would love to share in this particular presentation is how you can take full control over what you have control over and really build momentum to achieve your goals in your trading, especially, but in other areas of life also. Now, I would love to start this presentation with a little bit of a principle that we're going to build this presentation off. Every human has a truly unique set of priorities. Every single person here in this room, we've got about 50 people in this presentation so far, has a truly unique set of priorities. It's fingerprint specific. And what that means is you live moment by moment with a set of priorities, something that's most important to you, an objective that's most important to you, and it goes down a list to what's least important to you. And the big challenge and the big issue I see with a lot of people is that people are comparing themselves to other people, expecting themselves to live inside other people's priorities, not honoring their own. And they have a lot of issues like procrastination, hesitation, frustration. They don't excel, they don't build momentum. And I think Albert Einstein summarized this perfectly when he said, if you judge a fish by its ability to climb a tree, it will live its whole life believing it's stupid. And 90 to 95% of the challenges I see with traders and just people in general life when I coach and consult is that there are too many fish expecting themselves to climb trees like cats and too many cats expecting themselves to swim like fish. Just an analogy there, but there are too many people expecting themselves to live outside their true set of priorities, and they're expecting themselves to live inside other people's priorities. You're not designed to excel in other people's priorities. You're designed to excel in your own unique set of priorities. So what today is going to be an opportunity to do is to really get clear on what are your priorities in all 7 areas of life, but especially in your trading. What is most important to you in your trading? What is it you would love to accomplish with your trading? Not what you think it should be, not what other people are doing, but what is it for you? What is it you would love to do? And I'm going to hold you guys accountable through a quick exercise we're going to do to get clear on that. So in this next time, in this uncertain world, you're focused on what you would love to do, and you're really building momentum towards that. And you're progressing and you're accomplishing your goals. I'm going to show you a really great, in a way, goal setting and achieving structure that you can implement. Now, let's do a little bit of theory on this, because I think it's super important for people to understand. And I promise you, I'm not going to bore you with too much theory. We're going to go through the theory because I think it's essential to have that background understanding. And then we're going to go into the practical application, the tool. And for those of you who just joined and haven't been here from the start, we're going to do a little bit of theory now. We're going to get into a practical tool, which is in the chat. And then we're also going to get into some Q&A at the end. Okay, and I'm going to resend this link now so you guys can have a look. So this link here, for those new people who have joined, this is a link to access the presentation PDF cheat sheet. So you can review this later after the presentation. And there's also a tool there that we're going to do the application on very soon. So go in there and make copies of both of those. Have those saved to your Google Drive so you have them for life. They're very important. Okay, good. So the big problem that I see with traders especially is that they don't necessarily know what's truly most important to them. It sounds a little bit crazy, but it's true. When we dig deep, people think they know what's important to them, but when we really dig deep, they're not 100% clear on what's truly most important to them in their life. And that small percentage of people who are clear on what's most important to them, majority of those people don't ever give themselves permission to live congruently and follow through with those things. So today is twofold. It's an opportunity for you guys to get clear on what it is you love to do in all areas of your life, especially your trading, and almost a bit of a kick or a push for me to follow through with that and start building momentum and start giving yourself permission to live congruently with that. And as a result, because people don't know what's most important to them, and because those who do don't give themselves permission to live congruently with that, they end up procrastinating, beating themselves up, and not achieving. If you're finding yourself beating yourself up or procrastinating or lacking motivation or discipline or just going in circles, not achieving, these are all symptoms of not identifying what's truly most important to you and structuring your life around that. And this is, again, what we're going to be covering today. The single most important thing you can do in your life is to identify and live according to your true set of priorities. Identify what's most important to you and live congruently with that. When you're congruent, you're automatically inspired, disciplined, focused, energized, resilient, and as a result, you're most likely to achieve. So being able to tap into what's most important to you and structuring your life around that, you're going to find yourself more inspired, disciplined, having all these things here. And as a result, you're going to be most likely to achieve. And having these things, the inspiration, the discipline, the focus, energy, resilience, these are all essential characteristics to be a successful trader. So once you can identify what's most important to you, if trading isn't at the top, that's fine. You can link the trading to that. But if it is, you can then start structuring your life around it. That's what we're going to talk about very soon in the application. Comparing yourself to others and trying to live according to someone else's priorities will only lead to suffering. You'll be a fish expecting yourself to climb a tree like a cat expecting yourself to swim like a fish. Doesn't make any sense. I said this at the start, but you're designed to excel within your own set of priorities, not within someone else's. Now, your priorities are created by what you perceive as most missing in your life. Perceived voids become things of value to you. Voids become values. You will pursue whatever you perceive as missing. So if you perceive money missing in your life, you're going to go off and pursue money. You're going to go on to fulfill that void in your life. This is why it's super important to get clear on what's most important to you, because you're designed to go off and fulfill the voids. Every decision you make and action you take is for the advantage of your highest priorities. You will procrastinate and lack discipline if you don't see a task serving your highest priorities. This is all feedback telling you that you're not congruent. So I see a lot of people who come to me and they say, I'm procrastinating, I'm lacking discipline. And I tell them that's great. It's great feedback that whatever you're expecting yourself to do just isn't as important to you as you think. If you think about it, think about someone in your life, just do this little thought exercise now. Think about someone in your life that it's really important to you. Maybe it's a child, a son or daughter, maybe it's a spouse, a partner, a parent. If that person that was incredibly important to you was in trouble or someone was attacking them or something, you wouldn't say to that person, I want to help you, but I'm just procrastinating. I'm just lacking discipline. I'm lacking motivation to help that person. It doesn't make any sense. If something's truly important to you deep down, you're going to go off and pursue it. So motivation isn't the problem. Lacking discipline isn't the problem. Procrastination isn't the problem. People are just not congruent and not sticking to high priority things. So this is where I say it's so important. This is what the whole presentation is based on today, to get super clear on what's most important to you, because you'll find yourself excelling if you can identify your highest priority actions and identify what it is you love to do. And you'll also find yourself really struggling if you're doing low priority things. And that's all feedback trying to get you back to high priority things. You will spontaneously act if you see a task serving your highest priorities. Your language will determine how congruent you are with your priorities. If you're using language like I should, I need to, I have to do this, it's an indication that you're not congruent. You're expecting yourself to do something low priority to you. It's out of desperation you're doing it. Or another thing that could have happened is you put someone up on a pedestal and you're injecting their priorities into your life. The word I should is an indication of what's called a super ego. Sigmund Freud talked about a super ego, where we have parents or people we admire or idols we put up on pedestals, and we're rejecting their priorities into our life, and we use language, imperative language, like I should be doing this, I need to be doing this, I have to be doing this, it's all an indication that you're expecting yourself to live inside someone else's priorities. You're a cat expecting yourself to swim like a fish, and vice versa. When you use language like I would love to do this, and when you're congruent with what's truly most important to you, you don't say I should be doing it, you just go off and do it because you love to do it. So language like I would love to do this and spontaneously acting towards a task is an indication of congruence. You're congruent with what's most important to you. Now, when we talk about the application, which we're going to get into now, about implementing this theory, you have 7 areas to your life. You have your health and your physical vitality. You've got your wealth and your trading. This is trading, investments, that type of stuff. You got your business and vocation, that's your work. Maybe it's a 9-to-5 job for some of you guys. Maybe it's a part-time job for some of you. Maybe it's a business for some of you guys. Maybe your business is just your trading. Maybe you're managing money, that type of stuff. You're funded money. You've got your family relationships, intimate and non-intimate relationships. You've got your mental expansion and your learning, things like reading, things like attending presentations, courses, that type of stuff. You've got your social leadership and influence. That's the impact you want to leave on planet Earth. And you've got your spirituality. Now, if you're not a religious individual, your spirituality is whatever is most important to you. Your spiritual mission is the fulfillment of your highest priority. That's how you're wired. So those are the 7 areas of life: health, wealth, business and vocation, family relationships, mental, social leadership, and spirituality. Any area you don't empower, you're subject to being overpowered in. So for example, if you don't empower your wealth and create an independent source of wealth, you're going to be told how much you're worth by a paycheck at the end of every week or every month. If you don't empower yourself and your family and relationships, they're going to be extremely distracting when you go off and pursue your chief aim. If you don't empower your mental and your learning, you're going to be told what to think. If you don't empower your social leadership, your influence, and your spirituality, you're most likely going to subscribe to someone else's mission in life. Because priorities go from those who have the most power and certainty to those who have the least. So what I'm going to get to you guys to start thinking about is what's most important to you, and get certain in that so you can start being the author of your own life. You don't need to subscribe to other people's. And I really think that the start of that is getting clear on what it is you would love to have, what it is you would love to be, and getting clear on your true set of priorities. Now, on top of that, before we cover this point, the other thing here is that any area you don't empower is also going to be a distraction to your chief aim. So for example, majority of you guys in here would have a very high priority in your trading, probably your learning as well. Otherwise you wouldn't necessarily be attending an educational presentation, right? So if you just focus on those 2 areas, that's fine. You can do that. There's no right or wrong around this, but recognize that if you focus on that and you don't spend time with your family and relationships, and you don't empower that area of your life, that area can then become a distraction that's going to impact your trading and your mental expansion. So this is why I'm so big on empowering all 7 areas of life holistically, because any area you don't empower, first and foremost, subject to being overpowered in, and secondly, it's going to be a distraction to your chief aim anyway. You have a lot of challenges in that area you don't empower, which is going to impact the area you want to excel in. Now, on top of that, I'm a very big believer that it doesn't take much more energy to empower 7 than it does just 1. Because you can link all those areas together. And this is maybe something you want to write down, because I haven't put this in the presentation. You can link all 7 areas to your trading. Let's say, for example, you have a very high priority in your trading. You want to be an exceptional fund manager. You maybe even want to start your own fund one day. You can then link all those 7 areas to that one area, or the other 6 areas to that area. You can get a lot of your health and vitality and energy from trading and learning about trading, because that's what's most inspiring to you. Your wealth is obviously your trading. You can then go off and create a business and a fund around that. You create a positive sum business from that. You can have a lot of your relationships within your trading. You can then go off and study about trading and learn about trading. That's your mental empowerment. You can then go off and create some sort of philanthropic pursuit. That's your social leadership and your influence. And you're doing what you love most. That's your mission. That's your spirituality. So you can, and this is what I encourage you guys to think, identify which of those 7 is most important to you and link the other 6 areas to that. but at least consider how doing one is empowering all other 6. And that's what I love to think that I do. I mean, I love what I do. I mean, I wouldn't be at 11:30 p.m. doing a presentation if I didn't. So I think I'm very clear that I know what's most important to me, and I've in a way linked the other areas to my life. I know it's possible, like my health, my wealth, my relationships, my mental expansion, my impact, and my spiritual mission all around my business. And I know it's possible, and that's what I'm going to encourage you guys to think. How you can empower all 7 areas, but if that's too overwhelming, link all of them together, link them all to your top priority, which is probably around your trading. And the thought exercise we're going to go through, so that's a little bit of a side note, the thought exercise we're going to go through today is getting clear first and foremost on what it is you would love to be, or rather who you would love to be in the 7 areas of life. Who is it you would love to be in terms of your health, your wealth, your business, vocation, so on and so forth. What are you going to do to get there? What's the highest priority action you can focus on to become the person you'd love to become in the 7 areas of life? Because once you set an intention or a goal, this is another key concept here. You say, for example, you're here, whatever that means, but you're here. If you go off and set a goal that you perceive is out in the future, this gap here is stress and depression. That's the gap. Because what you're doing is you're comparing your current reality to a fantasy of how you wished your life was, but they don't match up. And you're going to be associated a lot of pleasure to your goals. And you're going to be looking at your life and thinking, I don't have that right now. I'm stressed, I'm depressed. So what we're going to do with the second step is we're going to identify the highest priority actions you can be doing on a daily basis to get there. So you see the pathway laid out, and this isn't any longer stress or depression. What it is it's inspiration. You see the path laid out. You know every day what you're working, you're inspired to do that, and you're progressing, building momentum towards your goals every day. So what is it you would love to be, or who is it you'd love to be in the 7 areas? What are you going to do to get there? What are the highest priority actions you can do on a daily basis to move you closer to your goals? And then finally, what are you going to have as a result? Because every human being has a narcissistic need. They want to get something, but every human being also has an altruistic need of wanting to give something. And you need to keep those in fair exchange. You need to keep those in balance. Because I know there's every single one of you guys in here. How many do we have? We've got 47 still. So we've got 47 people in here. I'm certain that every single one of you has been in the situation where you constantly did, you put work in, you did something for someone else, you kept working on a goal, and you didn't get anything in return in your perception, and that burnt you out. And you wanted to move on because you didn't feel like you got remunerated for that. So when you go off and set goals, a very key tip here to ensure you can sustain that and maintain that in the long run is to reward yourself incrementally on a daily basis for doing the high priority actions daily. Reward yourself to keep yourself in fair exchange so you don't burn yourself out. Okay? The do and have must be kept in fair exchange. So you're identifying who is it you'd love to be in the 7 areas of life. What are you going to do to get there? What's the highest priority actions you can focus on to get there? And then every day when you work on those high priority actions, what can you have to reward yourself to keep yourself in fair exchange? Do and have must be kept in fair exchange, these two. Okay, hope that makes sense. Any questions, by the way, drop them in the chat or ask in the Q&A. Now, we're going to go in and do that exercise in a second, but I want to continue on with the presentation and just show what to do next. So once you've identified your highest priority actions, what it is you'd love to be, you then want to go in and schedule the high priority actions into a Google Calendar. You want to take the do section specifically and schedule that into a calendar. So you've identified who you'd love to be in the 7 areas of life. You now want to take the highest priority actions and schedule those into a calendar. So every day you're building momentum towards those. So remember, you have no control over what happens around you in your life. You have control of your perceptions, decisions, and actions. Right now, you're getting clear on what it is you love to be in all areas of life, and then you're structuring the highest priority actions every day, putting them into a calendar, focused on those. You're going to build some serious momentum in your life. You want to execute on the high priority action steps. Your brain is designed to do high priority actions only. Do not expect yourself to do things that aren't important to you. Once you go through the exercise and structure the way I'm going to show you to structure it, you're going to see everything lined up. You're going to see the why and the reason behind your action steps. So you're going to have a level of motivation, discipline doing them. You will self-depreciate and beat yourself up if you do things that aren't important to you. This is a way to associate pain with doing low priority actions so you can get back to doing high priority actions, because your brain is designed to do high priority actions. That's how you're set up, that's how you're wired. So every single one of you, what I encourage you to do after you do that exercise, go through, get clear on what it is you'd love to be, what are you going to do, what are you going to have, and then take the do's and schedule them into a Google Calendar like this. So you can structure your day, you can structure your week, you can structure your month, every day focusing on the highest priority actions to help you build momentum towards your trading goals, towards your health goals, towards your relationship goals, your mental goals, etc., etc. Okay. Journey begins with a single step and is progressed daily by a single step. So you're going to build some serious momentum. I always say that consistent and persistent action on the highest priority actions is what will lead to great results. And Albert Einstein said that compound interest is the eighth wonder of the world. And when you identify the highest priority actions, like we're going to do in a sec, and schedule those into a calendar, you're going to build some serious momentum on a daily basis. Okay, so we'll come back to the Q&A in a second. But what I'm going to do is I'm going to bring up this tool on the Google Calendar. So jump into that link in the Zoom chat, and you want to jump onto the Google Drive and then click on the Google Drive tool. Okay, great. Good to see some of you guys in there. Let me know if you don't see that or you struggle to get into that. I'm going to share my screen. Now, this is very important. You want to come to File and make a copy. You want to make a copy to your own dashboard so you can then edit the document. You won't be able to edit this document. You want to go to File, make a copy so you can make your own copy of that. Okay, hopefully that makes sense. Let's go File, make a copy, click OK, and you'll have access to that document for the rest of your life. It's your own, nobody else can see it. You can go in there and edit it as well. Okay, good. Now, oh, we've got something in the chat. The link is right above your message. I'll send it again. Maybe you guys joined a little bit later, so you can't see it. See? Okay. Okay, I've sent the link again in the chat. Go into that document, go into the Excel spreadsheet tool. Go File, make a copy of that. I'll give you guys 10 seconds to do that. Okay, good. So you just probably couldn't see it. All right. Now I want you to think as much as you can while I'm here, because everybody knows themselves it's going to be a lot more difficult to find the time to do this when we finish the presentation. So let's all do it together. Let's all go in there and start working towards this. Probably not going to have time to finish the whole document, but we'll get a little bit done. The main thing I want to focus on is the trading related stuff anyway. So, okay, good. So bring that up, make a copy. And what you can see is that I've broken up the 7 areas of life: your wealth, trading and investments, health, family and relationships, mental learning, business, leadership and social influence. I've left spirituality out because your spiritual mission is your highest priority, which will most likely be encompassed in one of the other 6 areas. Okay. So you can see there's some tooltips here. That's a question you would love to ask yourself. What would you love to be in terms of your trading? Or rather, who would you love to be in terms of your trading? So you want to come in here and write down who it is you'd love to be as a trader. Maybe, for example, the big goal for some of you guys is being a funded trader. Okay, and you might want to write in how much, what accounts, that's the goal. And then you also want to associate a time thing to that as well. So maybe the start of 2022. Okay, crazy to think it's nearly 2022. Then the next thing you want to come in, you want to keep writing who it is you love to be as a trader. Maybe a funded trader. Maybe some of you guys have a goal to be a full-time trader, so you have time to work on other projects and build other businesses, so on and so forth. So you can write that in there as well. Maybe you can set that goal for January 23. Okay, who else would you love to be as a trader? I'm just going to go through and prod with with questions and ideas that may be useful to you guys, because I've seen a few people do this. All right, Paul, welcome. What I'm going to do is I'm going to send through the link again, just in case those of you who've joined late don't have access to it. Okay, good. Now, the next one, it could be also I know a lot of people are going to write down this, consistently profitable trader. Okay, now let me just pick out this. You don't have any control over what the market gives you. So being consistently profitable to a degree is outside your own sphere, but it's outside of your control. But what you do have full control over, your perceptions, your decisions, and your actions, like we talked about at the start. So you have full control over consistently executing on your trading plan and processes. And if you have an edge with your trading plan, you can expect results in the long term because of that. Okay, so be aware that you're setting realistic things in here. Consistently profitable trade is a little bit of a tough one, because you don't have control over the market, what the market's going to give you. But yes, you have full control over showing up a certain time every day, reading your trading plan, executing when your setups come along, not executing when your setups don't come along, doing your review, doing your forecasting, so on and so forth. Okay, so instead of consistently profitable trade, I'm going to encourage you guys to think from consistently executing on your trading plan and processes. Hope that makes sense. Good. So go in there and get clear on who it is you'd love to be as a trader. I think funded trader is a great goal. Full-time trader can be good for some people, not necessarily for all people. Consistently profitable, consistently executing on your trading plan and processes, I think, is an excellent goal also. Get clear on who it is you'd love to be as a trader. Don't write it down because I'm writing it down. Write it down because you have a yearning to do that. Some of you guys may be thinking bigger than this, and you may be thinking about, some of you guys may be thinking about going in and starting your own fund, right? I don't know. Go in and get clear on who it is you'd love to be as a trader. What are your goals there? And associate a time horizon to that as well. Okay, now, what is the single highest priority action? I want everybody to think about this now. Take one of the B's. Let's say, for example, you guys have funded trader there. What if you could only do one thing, only one action step? What would it be to move you closer to getting funded? If you could only do one thing, one action step. Now, a lot of people are going to write down broad general things. Someone's going to write down just backtesting. Okay, it's too broad, it's too general. Someone's going to write down forecasting. It's too broad, it's too general. I want you guys to get very specific on high priority actions that you can focus on to become a funded trader. For example, backtesting is too broad, but you can also say something like 30 minutes of backtesting every single day, but there's an intention. So maybe turn it to intentional backtesting every single day to refine and clarify my setups in my trading plan. I see backtesting as an incredible tool to build a successful and solid trading plan. So what's the highest priority action you can do to get funded start of 2022? Well, dedicating 30 minutes of intentional backtesting, going through my trading plan and ensuring all those components are refined and clarified. I think that's a great high priority action to focus on. It may not be relevant to all you guys, but I'm just giving ideas here that would probably be relevant to more people than not. Feel free to send through your B's and questions, by the way, so I can answer them, give you more specific tailoring if needed. Okay, good. What's another high priority action? Well, another great one is reading or reviewing trading plan or trading plan cheat sheet, and then forecasting for 30 minutes every weekday morning or afternoon, wherever you are in the world. It's a little bit different. Okay, so two great high priority actions that you can focus on to get funded, become a funded trader by 2022. 30 minutes of intentional backtesting, refining, clarifying your setups in your trading plan. Now, obviously, what you put down here is dependent on where you are in your journey. If you have no trading plan, put a template on a Notion document or a piece of paper. Entry, exit, risk. where are your entries, where are your exits, how much you're risking, and fill in those criteria there and start building out your trading plan. Okay, what else? Maybe you could be doing 30 minutes a day of reading / watching trading education content. Okay, but again, that's too broad. What type of trading education content? You want to get clear. I really want to hold you guys accountable to think specific and high priority. Highest priority actions. Your brain's designed to do high priority actions. If you're procrastinating or hesitating or frustrating, it's an indication that whatever you're expecting yourself to do is just not as important as you think. Okay, excellent. So go in and get clear on the highest priority actions you can do to become a funded trader at the start of 2022. And then we go on to the next one. What's the highest priority action you can do to become a full-time trader? Well, let me make a few suggestions here. The number one highest priority thing I believe every full-time trader should have is a level of cash savings. And more specifically, 6 to 12 months of expenses in cash. Why? Because the moment you feel the need to have to make money from your trading, and the smaller the time horizons become about, I need to make money to cover bills in a week's time, the greater the emotional volatility, the greater the fear and greed, which means the more likely you are to move away from your processes, the more likely you are to make mistakes or forced trades. So having cash in the bank and cash savings is a cash cushion that you can then use to ensure that you're executing consistently on your processes if you need money. You're not forcing yourself to have to trade to make money, but you're just sticking to your trading plan and you're just executing on that. So that would be number one, a high priority action, starting to build up those cash savings. That can very easily be done by stashing 10% of every paycheck you get. Remember, high priority actions done persistently and consistently is what you need for great achievement. So you want to identify the highest priority actions you're doing consistently over a long period of time. There's no reason why you can't achieve what it is you want to achieve. Okay, so I think that makes sense. You want to go in and get clear on the highest priority actions you can be doing. Again, ask yourself, if I was to do just one thing to become a funded trader, what would it be? And then ask it again. I'm allowing myself to do another thing, what would it be? Until you have everything you know you need there to become a funded trader, and you're certain in that. Okay, excellent. Now, going in and back testing 30 minutes a day intentionally, and going in and reading your trading plan, forecasting and executing the markets, and then 30 minutes a day of reading and watching trading education content. Doing that will result in you getting funded at the start of 2022. That's correct. You will get a funded account. But I also believe that it's crucial to reward yourself on a daily or weekly basis also. Because yes, getting funded will be a reward, but you also want to keep yourself in fair exchange from doing the high priority actions. You want to reward yourself for doing high priority actions every day, because it's almost like a little bit of like Pavlov's dogs, where you're training yourself to do the highest priority thing you can be doing at any point in time. And it creates a very great positive feedback loop in your psychology to stick to the highest priority thing, execute on that, get rewarded, go again. Highest priority thing, execute, get rewarded, go again. So rewarding yourself, something as simple as a TV show or a favorite dinner or a snack, these are all very basic yet effective rewards that you can have to keep building that momentum. Okay. So who is it you'd love to be? What are you going to do to become that particular person? And what are you going to have as a reward and as a result? Get clear on that. And what that will do is will help create an idea or a system in your brain of fair exchange to accomplishing your goals. A lot of people fall off track because they're not rewarding themselves in fair exchange. They're doing too much. They're burning themselves out, right? A lot of people aren't achieving because they're not doing high priority things to them. They're injecting priorities from external authorities, from super egos. They're expecting themselves to live inside other people's priorities. These are all challenges that you avoid by doing this exercise. Who is it you love to be in your trading? What's the highest priority action you can do to get there? What are you going to reward yourself with on a daily basis? Okay, doesn't get much more simple than this. yet it's the most effective achievement system that I've come across and I've used in my life. And don't stop at your trading, because remember, you have 7 areas to your life. Any area you don't empower, you're subject to being overpowered in. Go and do it for your health. Who is it you love to be in your health? What's the highest priority action you can do in your health and physical vitality? Maybe it's drinking 3 liters of water. Maybe it's going for a 30-minute walk. Maybe it's doing strength training 3 or 5 times a week. And then what are you going to reward yourself with? Same with your family, same with your learning, same with your business, same with your impact and social leadership. Encourage every single one of you guys to have a purpose behind your trading, because money with meaning tends to lead to philanthropy, and it tends to you leading to have a vision and a mission that you then go off and make money, and then you have a reason beyond that money, and you go off and lead to some level of philanthropy, and you make an impact on planet Earth. Whereas money without meaning tends to lead to things like debauchery and doing things that aren't necessarily good for your health and necessarily productive to society. So this is why I'm giving you this exercise to think broader and to think bigger, to really start putting these components in place. So hopefully that makes sense. If you have any questions, drop them in the chat. We're going to jump back to the presentation now just to run through a couple of things, and we'll do a bit of a Q&A. Okay, so let me bring this presentation up. All right, let's have a look, share screen. Okay, so you've gone in and you've gotten clear on who it is you would love to be, and then you've identified the highest priority actions. Now, again, you want to take the do, so that middle section, just the do, and schedule those high priority actions into your calendar. You've identified who you would love to be. Now, all you need to do is just focus on your calendar and focus on doing the high priority actions every day. Maybe add your rewards to that calendar as well. And you just forget about who you'd love to be. You probably won't be able to get off your mind, but you don't need to think about it every day. You just execute on the high priority actions. And then, like I put here, the consistent and persistent action every day, you're going to build some serious momentum. You're going to look back in 1 month, 2 months, 3 months time. You're going to realize you're at your goals. You've achieved them. So this is the power of identifying the highest priority actions, identifying what it is or who it is you'd love to be, high priority actions, and scheduling those into a calendar. Now, you may choose not to use Google Calendar. You may choose to use a different system, maybe just a checklist or a notebook and a pen. I personally use a Google Calendar. I use a Notion checklist, and I also use a piece of paper and pen. I love having everything organized and having the highest priority actions there for the day. So go in and do that for yourself and get clear on that, because I assure you it's going to be what helps you achieve your goals. Okay, so that's it from me. That's enough talking from me. So I appreciate you paying attention and taking those principles on board. What I'd love to do now is take Q&A, take on some questions. Okay, thank you for your comment, Paul. Thank you. Thank you. Any questions on either the presentation or trading mindset in general? Do you guys have any challenges you're facing or any goals that you would love to accomplish? Thank you. Appreciate the kind words. Okay, I'm unable to hold the trade. Do you want to expand on that, please? Okay, good. So in terms of trading edge, to strip it down to its principles, to its roots, get clear on your entries, get clear on your exits, and get clear on how much you're risking. Start with that template, strip everything down, entry points, area of value and higher time frames. And then once you're in that area of value, what's the specific criteria you'd love to see to execute on that? So area of value, entry criteria, and then exit points. So your management, initial stop loss placement, break even rule if you have one, trailing stop take profit, so on and so forth, and then what your risk is. Okay, good. In the beginning, you're speaking about gap and mental reality future. How can I work on that? How can you work on that gap between your reality and your future? Get grounded in your reality, set true objectives and goals, understand your future objectives have drawbacks to them too, and identify the highest priority actions. If you identify the highest priority actions every day, you won't be impatient. You're going to be inspired to act on those high priority. You're going to see the path laid out and you're going to be executing to that. The impatience is probably a symptom of not getting clear on the highest priority actions. Low confidence to hold the trade. Okay, well, that's usually a symptom of not being clear on your setups and your trading plan. If you're certain in your trading plan, you have an edge in your trading plan, the confidence is going to be what you need in that trading plan to hold trades and follow through with your system. So there's low confidence in to hold trades. I would be going back, getting clear in your setups and doing more. In a way, you can do back testing, you can do going through previous trades to build certainty in that data. Traders talk about hard work. What is hard work? I'm a new trader, I want to get funded. Okay, I would encourage you to go through this presentation and just do exactly what I ran you through. Hard work is, see, a lot of people work hard on low priority things. This is why there's a huge culture of grinding and clawing and working hard. But truth be told, if you identify the highest priority actions and you're consistent with doing those, then you can get your trading stuff done in 2-3 hours a day if you're just consistent with that. I would much rather be consistent over 10 years than work 24-hour days and burn myself out in a year. High priority actions, can't stress that enough. Okay, that's a great question. What's the hardest moment in your trading experience? How'd you deal with that? The hardest moment that I perceived was losing funding. It's actually happened a couple of times to me, both through private investment and through others. And what I did to deal with that was I ran through certain processes that I teach clients. Obviously, my understanding of human behavior and psychology, that helped to have principles to be able to deal with some of those. But the other thing that I would love to share with that is that there's always a hidden reason behind things. There's always a hidden motive behind things. And the moment I brought that to surface and I realized that, losing those types of fundings was actually pushing me to, in a way, do more with my coaching as well and do more with my consulting. And I could see that, that pushed me in a sense to create what I'm creating now. It wasn't necessarily it was perceived as a hard and challenging moment in the moment, but when I took a step back and saw the hidden meaning behind it, it was perfectly on time. It wasn't that hard when I saw it from a different perspective. Okay. What's the best trading edge you think a trader can have? Identifying the highest priority actions and executing on those. Thanks, Pat. You indeed control your spirituality. Okay, I'm not quite sure what that means. I have a terrible habit of getting out of trades too early. Get clear in your setups. If you're getting out of the trades early, there's an unconscious motive why you're doing that. So getting clear on your trading, it's any sort of related things to getting out of trades and not having confidence in trades is all a symptom of not being 100% certain in your trading plan. So that's feedback to go back to your trading plan and have an idea. Maybe it's your management rules that you need to refine and get more certainty on. Because if you're certain in your rules, then you're very unlikely to go outside your rules. Yep, work smarter, not harder. Exactly. Identify the highest priority actions and stick to those. Here's the next level to that. Identify the highest priority actions and spend an enormous amount of time throughout the day focused on those. What do you think? I'm just told that setup is enough. Okay, good. This is a really great question. What do you think? I'm told that one setup is enough to give me the earnings I expect. Okay, start with what you know and let that grow. Start with the one setup and master that. And what you will start to do is you'll start to find variations to that and things around that. You're going to start to build that. And you're going to start to build a trading plan. But if you try and do so many things all at once, you're going to burn yourself out. Start with what you know and let that grow. My thoughts on discretion and intuition in trading, a lot of the times it's not discretion and intuition. A lot of the times it's impulse and instinct of fear and greed. Traders who think they're trading on discretion are actually trading out of fear or greed. The gut instinct isn't intuition, two different things. Your intuition is trying to integrate things. Your gut instinct is trying to avoid pain or seek pleasure. So a lot of traders who think they're trading on discretion aren't actually trading on discretion. This is why I always encourage traders, 99.9% of traders, to build a process-based system, to build a process system, step-by-step checklist system in your trading plan, because you can then build levels of intuition and discretion on top of a system, because you're dealing with a lot of the emotional volatilities that interact and influence your intuition, but you can't build a system on top of discretion. So start with a system-based and checklists and pictures and that type of stuff. Start with a system and you'll build and you'll find intuition on top of that over time. But I wouldn't necessarily agree that most traders are trading on discretion or intuition. They're trading more on trying to avoid the pain of loss and trying to seek the pleasure of winning. Okay. Excellent. Any other questions? So you guys got some value from the presentation, which is great to see. What I would encourage you guys to do is to go and finish the rest of those exercises, and then the other be do's and haves in the important areas of life, and then go in and take the do's and structure them into a calendar. Get that done ASAP and start living according to that. The way you thrive in uncertain times is identifying and focusing on what you have full control over. I showed you how to do that today. Go off and execute on that. Can you give me your notes and materials from Diamartini shared with you, or mentor you? I'd love to continue to help you out. Yep, absolutely. Can you, okay, good. Great presentation, thank you. Where am I from? I'm from Australia, Melbourne, Australia. Neither Israel or Europe. Perfect English. Yeah, I try. Okay, great, thank you. Great. Excellent. So this will be uploaded to the The5ers YouTube, I believe. And then you'll be able to find my details underneath that if you want to get in contact with me. And yeah, I really appreciate you guys being here today. Continue to implement the principles, reach out. What do you mean by DA Nick? Reach out and yeah, I'd love to work with some of you guys, especially if you got value from today. Okay. My pleasure. Got my website, patbailuni.com. Contact me through there. But like I mentioned, my details will be underneath the YouTube video that's going to be placed on the YouTube. So just my name, patbailuni.com on Google. Do they still say fair income? Not from where I'm from. I think I'm from a little bit more of the city, but I'm sure someone says fair income in Australia. Okay, great. Thank you so much, guys. I appreciate it. And I look forward to speaking to you guys soon. Take care.
Mark, welcome to the webinar. Glad to have you.
Thank you very much.
You've been around on YouTube channel UK spread betting for forever. I remember myself, I don't know, maybe 4 years ago or 5 years ago, I was trying to understand a little bit more in depth what leverage is. And I came across to your channel and I learned from you what was leverage and how it's calculated and the relationship with margin. So I've been learning from you a few times. So, I mean, you are, one of the few reliable YouTubers out there. So I really appreciate the work you do out there. Your work is so valuable. So thanks for
appreciate that. Thank you for those kind words. And has it really been for 4 years? I can't believe it. There's a lot of videos out there, but yeah, appreciate that.
You used to do those. You used to use those, the papers to draw on them.
Yeah. Back in, I remember. I think I've done a full circle with my haircut as well. It was longer. It went short. It went really short, and now I'm kind of getting a bit longer again. I'm feeling a bit more of a length. So,
So yeah, very, very pleased to have you. So yeah, from now, just take over, introduce yourself, and I'll be here and I'll be in the background. I'll be back.
Brilliant. Okay. Thank you. Well, I'll share my screen because I've got one introductory slide because I know some of you don't know who I am. So let me get started with a quick screen share. I'll share that. I'll put that on slideshow. I'll move your face over there in that screen and we should be good to go. I don't know what, every different country and jurisdiction has its own rules around risk and stuff. I just like to say, listen, if you're new to trading, just understand that it's high risk, right? Most of you here, I guess, know this by now, but I hate to see people coming into trading thinking, oh, this is so easy, I'm going to make money, and then they don't understand there's a risk. There's good rewards, sure, but there's risk as well. So just make sure you understand that this is a serious game we're playing ultimately, and we're trying to be the best we can. So today, what time are we on? Yeah, so we're at 2:00. So you guys are probably watching the CPI number. Markets all over the place. Nasdaq's back to where it was, a little bit higher. I know you guys are trading Forex, but yeah, we're going to 30, 40 minutes or so. I want to talk to you about something different today. And by the way, I hope you can hear me. Some genius has just started construction in the office above, just in time. But this microphone's pretty good, I hope. So hopefully you can guys hear me. Any questions? Fire them in the Q&A section or in the chat. I'll pick them up at the end. Definitely have time for that, so we can look through that. So today I want to talk about 5 steps to building unwavering trader confidence. So, when I spoke to Sol, say, okay, what I want to talk about? I'd like to kind of talk and share something of value, something that's going to be really useful to you guys. And strategies are one thing, and sure, strategies are super valuable. Obviously, you have to have an edge to be able to trade. But I think that confidence is something that's so overlooked as a trader and something that's so important as a trader. So we're going to dig into it and give you 5 steps that I think are really, really valuable to help you build the confidence. Some of the traps, some of this and some of the other things. So I'm really going to give you as much value as I possibly can in the next 30 to 40 minutes. So I appreciate your attention, especially when there's a big data number just sort of sitting there and chugging away in the background. I know you guys have all got one eye on the screen. Little quote from Mike Tyson there. I think he probably nicked it from Muhammad Ali. But anyway, you've got to believe you're a champion before you become one. I think that's a big ethos to have. Okay, so a very brief overview of who I am. I don't want to waste too much time on this, but I kind of want to show you my journey. Started trading in 2001. I was trading mining shares on the London Stock Exchange. There was a real kind of opportunity at some point as well when we switched from, I don't know if many guys are from the UK, but years ago we switched from this thing called CQ to sets. Ultimately, it was just a fully automated trading venue rather than this market maker-led model. And that was a real kind of opportunity for short-term traders to take advantage of it. So I guess without going too much depth about that, the point was edge can show up anywhere. And that opportunity really kind of, gave me a good kickstart in my trading career. I changed edge as conditions change. I became very much focused on reading the tape, supply and demand, and as kind of price action trader. When then we shifted to that fully automated type of trading on the London Stock Exchange, some of these algorithms back then were just so primitive that you could kind of spot them a lot easier. Obviously now algorithms are smart. But the concept of supply demand, of reading the tape, of kind of understanding these things still applied. And I kind of shifted my edge as that sort of edge diminished over time. I started putting on videos on YouTube literally to stop me over trading. That was the thing. I was like, right, I've got a position on, don't want to touch it. What can I do? So many trading books you can read. You can see I've got a few behind me there. So many trading books you can read, so much journaling you can do. I thought, okay, I want to do some videos. And I put them on YouTube, and here we are. I think we've got 370,000 subscribers later. Some of you guys like what I have to say, so I'll share what I think is of value. And I'm always honest with what I'm talking about. I don't sugarcoat things. This is a difficult game. It's a tricky game. It can be very, very rewarding if you get it right. It can be super challenging. It can be the hardest thing you'll ever do. But I think that with guidance and with structure, you can kind of make some progress. Quickly, I'm not promoting myself, but I created a Traders Mastermind community. There's also a podcast. You can search for that. At the moment, I'm building a new piece of software called Trading Plan Pro, which I'm absolutely super excited about. It's going to have discipline, kind of streaks. It's going to be, you better have your trading plans in there, strategies in there. That's really going to help me and building it for me. And I'm also going to be offering it out to people as well. So that's me. So that's in a nutshell, very, very quickly, if you haven't seen me already. Okay, so I'm on the right slide. Okay, so building confidence. So most people think that it's like chicken and egg. Have you heard of that phrase? I can't get any confidence until I make money in trading, and I can't make money until I have confidence. You're like, well, what do I do? I need to make money first, but I can't make money because I'm not confident, so I can't move forward. And traders, especially early traders in the early start of their career, think that profits equal confidence, and that's I believe that's wrong. So let me tell you why. Let me ask you a question, right? If you'd never had a green year, right, but this year you made 700 grand, would you feel good? And I'm pretty sure that everyone say, yeah, absolutely, 700 grand would be a very nice year if I'd never had a green year. Now, if there's maybe some traders watching, and listening and tuning into this who have had 7-figure years and they might be upset with 700 grand, but I imagine if you had never had a green year, going from nothing to 700 would make you feel pretty good, right? Now, let me change the question slightly. What if you made that £700,000, but you'd also broken all your risk rules regularly, had a few close calls with a blow up, and just traded sloppily? Would you feel good and full of confidence? You wouldn't, right? You'd be like, yeah, I made some good money, and I wasn't making money before, now I am. But, I really got close to the wire. I nearly blew up an account. I got away with this. I did this and did that. You wouldn't feel full of confidence, right? So by that definition, profits do not equal confidence. Confidence comes from a separate area in trading. It's your actions, your process, and the standards you operate from. Now, sure, I'm not going to stand here and say that profits don't play a certain role. Of course they do. You have some experience, you have a kind of few years behind your belt, you have some profits, you go, hey, listen, I can do it. I've proven I can do it. But it's not the core, right? It's not the core. It's not necessary to move forward. And so we need to shake this belief of like, I must get profits, get confidence. It comes from this different area, and it's something you can control. That's the good news, right? You can control your actions, you can control your process, you can control the standards that you operate from. So with that in mind, let me share with you this 5-step system that I've got for kind of creating and cultivating confidence. And it's perfect if you are doing, an online prop firm challenge, because you are in that level where you're trying to get to a point where you're funded. You're trying to get to a certain goal. And by definition, you're starting from zero effectively to build that account, to pass it, and then you're funded and you're trying to move on. You're trying to keep within the parameters. So it's important to have that level of confidence regardless of where your P&L is. I think that when we stake our identity as a trader on our P&L, that's a mistake. We need to stake our identity on our actions, process, and standards. Okay, so let's get straight into step number 1. Now, before I carry on with this, some of you are going to be like, this is really, really golden. I like the idea of this. Some of you are going to be like, oh, this doesn't, I'm not so sure, but just trust me on it and give it a little bit of time and think about it and think about what I'm saying here and really, because at the end of the day, right, look at it this way. I remember years ago looking at myself in the mirror and going, I have to change my behavior. Yeah, whatever year, 2002, 2003, something like that, first couple of years in, I need to change my behavior to get what I want from this market. I have to make a change, and I'm prepared to do anything within reason, of course. I'm not talking about insider trading or anything like this. I'm prepared to do anything internally to move forward, anything kind of from a mindset perspective. So I knew that it was my mindset, my discipline that was holding me back. So step number 1 is clarity. You need to become crystal clear on your vision of why you are trading. Crystal clear. You want to know, what are you trying to achieve in your trading? What's the goal for you? What are you doing it for? You doing it for money, freedom? Do you want to change your career ultimately? Most traders come in and go, I want to make some money. I want to make some cash. That's not clear enough. You must have a crystal clear vision. You'll see why this fits into where we're headed in a moment. A crystal clear vision is I want to make £500,000 by 2024. I want to make 2 million by 2028. I want to pass my funded program by the end of 3 months. I want whatever it may be. There's a specificity to that that's required. It's not, I want to do this, I want to do that, because you'll end up just not treating it with the respect it deserves. So being crystal clear on the vision of what you're trying to create. And you can go and dream as big as you like and say, hey, 10 years time, I want to be that. That's out of reach now, but let me then reverse engineer it. First step is to become funded. Next step is to get the first payout, then this, then that, then the other. Whatever the steps may be, we don't have to go crazy and start to analyze it yet. Having that clarity on where we're headed is so important, because here's something that many traders do, right? And you think of a big oil tanker kind of running, churning away through the sea. Put a little bit of rudder on. I'm not a nautical guy, but imagine you put a bit of rudder on, or whatever the terminology is, and it slowly kind of veers round to the right, doesn't it? Rears round, what's the terminology? Starboard, I think is right. Someone can correct me. You kind of veer around. It takes a lot of time. You still think like you're going ahead, and you kind of think, yeah, I'm doing all right, and time goes by, and fuel gets burnt. And imagine that in trading. It's like time goes by, and equity and stuff, and all these challenges. But actually, if you keep that rudder on to the right or to starboard, eventually you're going to have a big circle, and it's going to take you all the way back to where you were. You've done a lot of energy, you've burnt a lot of fuel, spent a lot of time, but you're exactly back to where you were. Think of yourself in your trading. How many times, I don't know how many experience you guys have got, but you've had some experience and listen to this, you find yourself going through the same process again and again and again and again. You feel like you're moving forward, but then you look at where you are, you go, I've just gone round in a circle. I have done absolutely nothing. So you need to lock your destination into your sat nav, into your satellite navigation. You go, right, I'm headed there. That's my vision. That's where I'm going. Chug, drive. Now, how long it takes me to get there, I do not know, but I'm heading that way. Just like if you were setting a heading on a plane, it's like you were setting a heading, in a boat. I did my private pilot's license a while ago, and one of the things, you get taught is, listen, set your heading and just keep checking you're on that heading, because it's very, very easy to drift. A lot like life in trading, right? It's very easy to drift. You feel like you're getting in the right direction, you're distracted elsewhere, your concentration's elsewhere, and you're not moving in the direction you want to direct move to. So be crystal clear on your vision. So important, so important. Step 2, visualize. That's the UK spelling. For you Americans, it's going to have a Z in there, or a Z. Visualize. Okay, so what does that person look like? And this is important too, okay? And you might be, this is the point where I might lose a few of you, like, oh man, this is a bit of a stretch, but just listen to it and just see what you think. So you've got that crystal clear vision of where you want to go. And maybe you sit down and write, no distractions, no market, no this, no that. Just get pen and paper and write, get that vision. Then you're going, okay, what does that person look like? And I mean physically. Imagine them sitting, he or she, whatever you're looking at, on the desk, sitting in front of the trading screens. What does he look like? How does he act? How does she act? What trading habits they possess? Just imagine them there, sitting there, managing the account size that you have got in your vision, or whatever that is. How do they behave? What does their pre-market prep and journaling routine look like? How do they respond when they break rules? Are they so angry? Are they not bothering with their journaling routine? Are they not bothering pre-market prep? Are they breaking rules? Of course they're not. You know they're not. You know that they are adhering to the plan and the structure they've placed in for themselves. They have that pre-market prep. They're trading, they're taking a loss, they're shrugging it off, they're moving on, they're adding to winners, doing all the stuff that you know is right. They're cool, they're